Good morning, NABE colleagues. So good to see you all, your smiling faces. If you don't have a mask, if you do, I can't see your smiling face, but that's fine. We have such a great schedule today, so I'm very excited to kick it off with a long time NABE supporter, and I'm not saying you're old, but a long-standing supporter of NABE, one of the longest standing members of the FOMC. I guess I am kind of making it sound like you're old, but also a highly influential member of the Federal Open Market Committee, somebody who's put forward ideas that have resonated and changed the way the Fed conducts monetary policy. He's been an innovator and active supporter of achieving the Fed's mandates for many, many years, and we are so honored to have him kick us off this morning. So with no further ado, Chicago Fed President Charlie Evans, people, please welcome him. And just a reminder, when you, after his remarks, we're going to do a Q&A. And so if you have questions, whether you're virtual or whether you're here, you submit them through the app and I will be able to see them on my iPad. President Evans.
Thank you. Thank you very much, Julia. It's great to be here. It's great to see everybody here in person after so long. Thanks for that very nice introduction. And I guess before I begin my comments, I should note that these are my own views. I think that'll be apparent once I start, and are not necessarily those of any of my colleagues on the Federal Open Market Committee and others in the Federal Reserve System. I have had the privilege of regularly attending FOMC meetings for nearly 20 years. First as Director of Research, and for the past 14 years as President of the Chicago Fed. During that long span, the economy has faced significant challenges. The dot-com bubble, the uncertainties of 9/11, the great financial crisis, and now the COVID pandemic. Each situation presented unique difficulties that we monetary policymakers grappled with in pursuit of our dual mandate objectives. The challenge I want to discuss today is one I never would have suspected dealing with when I first started going to FOMC meetings, that we have not been able to hit our inflation target on a sustained basis, and that for the past 15 years, those misses have been because inflation has been too low, not because it has been too high. This comment may seem a bit odd to you, given the surge in prices we are seeing currently, but it is precisely because the policy response to today's events is so important that I want to talk about this topic today. Before we turn to that discussion, I'd remind you that the primary reason for these inflation shortfalls is the fact that, for a variety of well-known reasons, the equilibrium real rate of interest, or R-star, has fallen to historically low levels. In a low R-star world, the effective lower bound on nominal policy rates presents an asymmetric risk to inflation that, under our old policy framework, led to a downward bias in inflation, as well as downside risk to attaining our full employment mandate. Last year, the FOMC adjusted its long-run strategy to emphasize that monetary policy should seek inflation outcomes that average 2% over time, and acknowledge the desirability of allowing for periods of overshooting 2% inflation. The European Central Bank also recently adjusted its long-standing goal of seeking inflation below but close to 2%. They now aim for symmetric 2% inflation and will allow for periods of overshooting. Both central banks noted that the challenges that low R-star presents were key factors in moving to their new monetary policy strategies. An obvious question to ask about the Fed's new framework is, how much overshooting is really being contemplated? Today's combination of accommodative policies and sharp price increases due to supply bottlenecks heightens the importance of this question. Does the strong imprint these factors are leaving on inflation today satisfy the overshooting criteria contemplated by the Federal Open Market Committee? Many have said yes, but I'm not so sure. To answer that, we need to consider what the overshooting is trying to achieve. The new long-run framework is pretty specific here. Overshooting is aimed at anchoring long-run inflation expectations at 2% in order to enhance the committee's ability to hit both our price stability and maximum inclusive employment targets. To be sure, inflation expectations are somewhat of a black box. But it seems to me that expectations are more likely to become realigned with our inflation objective by an intentional policy-generated overshooting of 2%. The implications are less clear following an accidental supply-side generated spike in inflation, followed by a quick, deliberate retreat to 2%. I would think this latter tactic risks falling short of cementing inflation expectations at 2%. So in my remarks today, I'm going to argue that the inflation we've seen to date does not yet satisfy the FOMC's overshooting criterion. Instead, we should be focused on producing sustainable inflation that aligns longer run inflation expectations with our 2% goal. Furthermore, because the ELB risk imposes such a substantial inflation undershoot bias, I wonder if it is possible to average 2% inflation over time without a constant long-run aim for inflation above, but close to 2%. Let me repeat that. That's a very unusual phrase. Without a constant long-run aim for inflation above, but close to 2%. Would explicitly following this approach do a better job of achieving 2% average inflation, and hence more strongly anchor inflation expectations at 2%, even during episodes at the effective lower bound, as well as during mature expansions? I think such an approach might strongly reinforce expectations at 2%. So the key word when discussing today's inflation outlook is sustainable. Many of us at this conference forecast the economy for a living. After a shocking burst of relative price increases and attention-grabbing year-over-year headline PCE inflation above 4%, how many of you see that unacceptably high inflation being sustained into 2023 and beyond? The survey of professional forecasters tells me that most of you aren't writing down those kinds of numbers, and it's because most don't expect sustained momentum in inflation. Well, according to the latest summary of economic projections, neither do my colleagues on the FOMC. In September, the median SEP projection for PCE inflation in 2023 was 2.2%, and for 2024 was 2.1%. Though one can't be sure from the report what drives the individual forecast, this anticipated reduction from 4.2% inflation in 21 to 2.1% in 3 years cannot be due to restrictive settings of the funds rate. Looking at the dot plot, that most important and valuable piece of Fed transparency, one can see that even the most aggressive path only has 2 25 basis point rate increases next year, and the funds rate just returning to near its long-run neutral level by 2024. Because monetary policy acts with a lag, this removal of accommodation likely has only a modest effect on inflation. And the rate path described by the median dots is clearly too low to have much of a restricted impact. So something else is dragging down the inflation forecast. Could anticipated high unemployment be weighing on projections of inflation? This seems unlikely. The median SEP forecast sees the unemployment rate falling below its longer run level of 4% by the end of next year, and then to 3.5% in 23 and 24. With the current unemployment rate at 5.2%, this would be a highly welcome development with regard to our maximum employment objective and would support more inclusive labor market outcomes. But it also means that there wouldn't be any downward pressure on inflation coming from labor market slack. Indeed, to the contrary, one would think that such low levels of unemployment would be associated with a higher, not lower inflation rate. How much higher inflation we'd expect is an open question. Most of us used to take as dogma that such low unemployment rates would generate higher or possibly accelerating inflation. However, for more than 20 years, unemployment falling below estimates of the NABE has not been a reliable signal of higher inflation. Simply put, the Phillips curve appears pretty flat, so this 0.5 percentage point unemployment undershoot isn't going to produce a lot of inflation. Strong fiscal policy actions gave important support to the economy during the early phase of the crisis and over the course of the recovery, but on net are unlikely to provide an outsized impetus to growth as we move forward. This is because many of the current payments and programs are behind us, and the future actions currently contemplated by Congress will be spread over a number of years. So unless you subscribe to an independent role for deficits on inflation, fiscal policy should not be an important factor in the inflation outlook. Quite importantly, the lower long-term inflation outlook reflects a consensus view that current supply-side disruptions are unlikely to leave much of a lasting imprint on underlying inflation. Markets work, and higher prices will eventually bring forth increases in supply. Now, to be sure, risks remain. As many have noted, the pandemic continues to drive economic developments both here and abroad. Notably, the resurgence in the pandemic could mean sidelined workers do not quickly return to the labor force. And even though the US economy has found ways to power through shockingly high levels of public health distress and deaths, emerging market countries with low vaccination rates and protections may continue to struggle with the pandemic. That could fuel the spread of other variants. This could add to supply-side headwinds. Eventually, though, these disruptions should pass as COVID becomes more manageable both domestically and abroad. The supply chain disruptions we've seen will resolve. It's hard to know the timing of this, but I expect most of the supply problems will be largely resolved as we move through next year. This brings me to a very important factor in the inflation outlook, especially for 23 and 24. The lesson of the inflation of the 70s and 80s, and articulated so well earlier by Milton Friedman and Edmund Phelps, is that to generate higher inflation in the long run, you have to generate higher long-run inflation expectations. We're not seeing that today. Importantly, in my view, the current surge in relative prices due to supply factors is not leaving a worrisome imprint on long-run inflation expectations. Now, as the minutes to the July FOMC meeting indicated, there is some disagreement on the committee as to whether long-run inflation expectations currently are in ranges that are consistent with our goals. And several of my colleagues indicated they saw survey-based measures as signaling a risk that expectations could be moving above 2%. But I don't subscribe to that view. I think long-run inflation expectations are still likely somewhat below target. Important for me in this judgment is the fact that inflation break-even rates in financial markets over the 5 to 10 year horizon are still below the levels we saw in 2012 and 13, period when they were arguably better aligned with 2% PCE inflation. Let's face it, a 10-year nominal treasury rate in the range we've seen recently simply can't have a whole lot of expectations of long-run inflation built into it. I think the FOMC's own actions and communications are playing an important role in restraining long-run inflation expectations. After the Paul Volcker era, during which the Fed established its credibility as an inflation fighter, people reasonably expected that the Fed would not allow inflation to exceed 2% for very long. This interpretation seems consistent with many policymakers' public expressions over the years of great discomfort at the prospect of inflation above 2%. But they had a more relaxed attitude whenever inflation was below 2%. Correcting too low inflation often invoked talk that modest policy monitoring will eventually solidify inflation closer to 2%. But there was no sense of urgency in those communications and little sense of alarm at undershooting the inflation objective. It's almost like policymakers were following the ECB's old policy goal, that is to aim for inflation below, but somewhat close to 2%. This could create a downward bias to inflation, which has now been intensified by the heightened effective lower bound inflation undershoot risks. So today, a policy mantra such as above but close to 2% inflation seems appropriate. Such an approach would naturally mitigate the downward bias by producing inflation above 2% during normal times in order to offset the periods of below target inflation that occur when the economy is at the effective lower bound for extended periods of time. In any event, our new framework requires some kind of different operational model than we've used in the past. And today is the first test of our commitment to this new view. It's not surprising that the public may be thinking we've not really changed our ways and will rein in accommodation with the aim of a quick return in inflation back to 2%. If so, we have more work to do to convince them this is not the case and that we will tolerate a more sustained inflation overshoot. Here I have to ask if the median projected SCP inflation path is sufficient to solidify inflation expectations and inflation at our longer run target. Though the modest overshooting projected from 2022 through 24 is an improvement, there's no doubt about that. I don't think it's a strong signal of sustainable inflation above 2%. I feel we need to go beyond trying to thread the needle by a couple of tenths in order to be assured of a sustainable moderate overshoot. Taken all together, I'm more uneasy about us not generating enough inflation in 23 and 24 than the possibility that we will be living with too much. My concern is that when the COVID distress ultimately recedes broadly around the world, we will not have been freed from the downward bias on inflation imparted by the effective lower bound. Of course, the ELB risk would be smaller if R star eventually rises. Is this in the cards? I don't think so. The factors we saw underpinning low R star prior to the pandemic still remain, with the possible exception of the larger fiscal debt and borrowing that are clearly ahead of us. But if the rising debt load is boosting R star, why is the 10-year treasury rate so low? Markets see that debt coming, but pricing remains calm. So I don't see fiscal deficits as providing monetary policy with more space. What does all this mean for my views about more immediate questions surrounding balance sheet policy and potential upcoming interest rate moves? For the balance sheet, I see the economy as being close to meeting the substantial further progress standard we laid out last December as the bar for beginning to taper our asset purchases. If the flow of employment improvements continues, it seems likely that those conditions will be met soon and tapering can commence. Future decisions regarding the path of short-term policy rates, federal funds rate target range, seem much less clear to me at the moment. Recall that the criteria we laid out for funds rate liftoff are that 1, labor market conditions need to reach levels consistent with the committee's assessments of maximum employment, and 2, inflation needs to rise to 2% and be on track to moderately exceed 2% for some time. If unemployment decreases in line with the SCP projections, I would view that as excellent progress and a very good outcome. However, by itself, a low unemployment rate would not dictate a change in policy rates. Unless 3% or 2.5% unemployment were associated with an undesirable rate of inflation, I would be hard pressed to be convinced that some kind of labor market dysfunctionality was at work. It would be unlikely to offset the benefits that very low unemployment brings to many American households. For me, I still expect the key dual mandate issue governing liftoff will be inflation and whether we are on the way to a sustainable level of inflation high enough to offset the downward bias created by the effective lower bound. Now, I know the new long-run framework says our goal is for inflation to average 2% over time. And given the surge in inflation we are seeing today, it's easy to pick a reasonably sized time frame over which inflation averages 2%. Some might see this arithmetic as justifying liftoff under our new framework sometime soon. But I don't subscribe to such an approach. Our new long-run framework was deliberately vague on the operational specifics of the period of time over which we were looking for inflation to average 2%, as well as the size and persistence of the overshooting we were seeking to generate. But the reason given for these operational tactics was clear: to anchor expectations for inflation over the long run at 2%. This anchoring should be the determinative criteria for the path of policy rates going forward, not whether inflation is mechanically averaged 2% over some particular time frame. Furthermore, even once we see a welcome rise in long-run expected inflation measures, we still have to follow through on policies that would validate those expectations. Otherwise, we could see expectations falling back, as occurred in 2010, 2011, and 2018. So this will be an important consideration for my policy views going forward. To conclude, let me circle back to my original question. How much overshooting should we be contemplating? My answer is this: enough to appropriately align long-run inflation expectations with our average 2% inflation target, taking into account the likelihood of future visits to the effective lower bound. I do not think the supply side induced transitory surge in inflation we are seeing today will be enough to do the trick. I expect that we will need a period of sustained monetary policy-induced overshooting of 2% inflation to boost long-run inflation expectations enough to deliver on our mandated goals. Now, of course, I could be wrong about that, and I will be attuned to alternative data developments. The risks, however, are not symmetric. After all, one can handle an undesirably large overshoot with somewhat higher policy rates, but the effective lower bound constrains what can be done to address undesirably low inflation. In my view, to anchor long-run inflation expectations at 2%, we must be willing to accept inflation reasonably above 2% during the expansionary phase of a cycle. Such an overshoot would offset the underruns that would almost inevitably occur when the economy is at the effective lower bound for extended periods of time. This would make any conservative central banker uncomfortable, but it is the lesson that has emerged from my 14 years of experience as an FOMC member. Perhaps this is why I am drawn to operationalize our long-run framework using a tactic, something like aiming for inflation that is above but close to 2%. Would this be sufficient? I don't know, but some such change in the mentality of central bankers along such lines would probably go a long way toward more effectively achieving our policy goals in an economic environment permeated by the risks of the effective lower bound. Thank you very much for your attention.
Thank you very much. What a provocative speech. So just a reminder, if you have questions for President Evans, submit them through the app and I will be able to see them. There's a few already, but I'm going to start with a few of my own.
Okay, very good.
I believe you just proposed a new inflation target.
No, I spoke quite a lot about the operational side of this. And I think that our long-run framework is a very good one. The long-run framework explicitly mentions that there's a risk that comes from the effective lower bound.
Right.
And we have experienced that. I mean, we didn't know it back in 2003, but we were at the effective lower bound. Nobody thought they could go below 1% at that time. Then we got down to 0.25. Now we're back down to 0.25 again. So we visited it, we recognized the risk, and we contemplated periods where we would have to overshoot in order to make up for underruns. My own emphasis here is I think the underruns have proved longer than we expected. When you're at 0, you have to aim for inflation above 2%. Just getting up to around 2% isn't enough momentum. And so, I think Ethan Harris said this very well at a gathering or a couple of times, which is if you had this period where, you're at the effective lower bound, you're under 2%, you should have a period once you can get up to 2%, above 2% probably until the next time you go down. Right. So it's kind of a two-tiered kind of thing. I think that's consistent with averaging 2% over time.
No, fair. But it almost sounds like you're suggesting that as a sort of communication device, the above but close to 2% would get you where you want to be better. That there's almost a hawkish bias in communication, sort of a innate central banker knee-jerk reaction to kill it when you see it.
Well, I mean, let me share with you that as I discussed this with my staff, we kind of paused over another kind of line. I was kind of saying, would this be small potatoes or would this be a seismic shift? And by that, I meant, I think it ought to be small potatoes, because if you're trying to average 2% and you always have trouble, you've got to go above 2%.
Right. You
can't be the Lake Wobegon, central banker who is able to average 2% without ever crossing 2%. So I think I'm describing, the way you need to think about it. And yet, I think a lot of people would view this as a seismic shift. You said I'm a new target. A new target. I don't see it as a new target. I see it as an implementation and a communication strategy. But it's
almost
different.
A commitment device as well.
Yes.
Maybe.
It's an important communication opportunity.
Yeah, and it sounds like because in communication has, of course, gone in the other direction. So you noted that you're happy to see the overshooting now in the summary of economic projections, but it has come along with a higher rate profile as well. Despite growth, it's averaging more or less the same relative to the March forecast, unemployment rate same. The difference is higher inflation and tighter policy. So I guess I'm taking from your remarks that you haven't changed your dots since March.
Oh, no, we, you know, I submitted a forecast where I did have
A somewhat higher rate.
inflation lifting off in late 2023.
Okay.
My previous submission had it kind of early-ish 24. So it's, you know, you can't see this the way that we present the submissions, but it was a relatively small change. But if it crosses a calendar year, it, you know,
Right.
has that effect. I think
Yes.
but.
And
yeah,
and
no, that's
then
right.
another.
Now you say we've seen high inflation,
Right.
which we have, the CPI
Yes.
and all of that. But, you know, of course, what we've seen are high relative price increases, right? I mean, the supply shocks, used car prices going up, how much in 3 months, you know, 10,
Right.
7, and 10.
Right.
Those are relative price increases that find their way into the inflation index. It is inflation, but it's got that different feel to it. It doesn't feel like a monetary induced inflation.
Right.
It's a supply shock. So the real question is, what's it going to settle out at? What's it going to be sustainable inflation? And that's really what, you know, I'm trying to drive home.
Right.
Is we're locked into this language of calling everything that goes up and down inflation or disinflation, but, you know, the pieces of this are really
The
relative
details
price.
matter.
You know,
The details matter. And yeah, because I mean, as it stands, your projections, which you pointed out, are sort of the opposite of what you would expect from the Phillips curve, right? You've got moderating inflation as unemployment comes
Yes.
down, which sort of underscores that it's a different kind of inflation.
yes, that's right.
Okay. And so, you know, one of the developments in Fed communication in recent months has also been that most on the committee see upside risks to this even higher profile. Do you see risks to inflation to the upside or balanced?
You know, so again, I think that the supply bottlenecks that we've experienced weren't anticipated until we actually saw them, right? I
Right.
mean, I don't remember early commentary before, when was it, March or April, that, you know, we've got semiconductor shortages that the car companies are struggling with. The shipping containers are spread all around the world because they were out of use or they use very differently. So how do you get them back, and unloading all of those things? And so, you know, we've had these almost unbelievable series of supply bottleneck challenges, and logistics are unbelievable and all of that. Could that lead to persistently high relative prices to make this clear and bring forth more supply? Yes, it could. Yes, it could. Would that be inflation? Well, I don't think that's going to be of the sustainable, you know, monetary policy kind. I mean, after all, even if these relative prices stayed high and they stayed at that level, you wouldn't be seeing ever increasing
Correct.
inflation,
It would
right?
level off,
And
yes.
so, and then any down, you know, so
Right.
the mechanics of the price indices are undoubtedly going to be afoot to deliver lower inflation along the lines that most people have in their forecasts.
Right.
And it's not because of monetary policy actions.
It's more just a natural healing of the economy.
I kind of see it that way, but
Yeah.
of course we'll have to see how it plays out.
Right. Yeah, and like one of the, you know, things that many people cite, and you cited it several points in your prepared remarks, the role of inflation expectations.
Right.
There was a paper that came out Friday that generated a lot of attention that called into question that whole framework. Do you feel like it's a good, reliable framework? Do you feel like the clues that you need to determine whether inflation is becoming more persistent can be found in measures of inflation expectations?
Yeah, I thought it was a very interesting paper. I think it was a paper by a senior Fed economist, Jeremy Rudd, who Julia and I both know quite well. He's an inflation expert. You know, we lean on his expertise to understand a lot of, you know, unusual details in all of that. And I think you have to take, you know, that paper very seriously, and because it's very deep.
Yes.
It's deep at a very economic theory fundamental aspect. That's one part of it. So when you ask, are inflation expectations still important? It's kind of like, well, one part of what his paper talks about is how did inflation expectations find its way into the Phillips curve? That's a very particular question. I paused over my own citation of Milton Friedman and Edmund Phelps because Jeremy in his paper did as well, but not as kindly, because that's part of the issue. And it's a fair question. Our models have lots of implications which don't all fit the data. As a researcher myself, I understand how that works its way out, and you try to make improvements or something, but there are real questions. Now, but you still have to ask, which I think is not exactly the point of the paper, what is it that monetary policy is delivering for inflation? And how does the Fed need to think about it?
Right.
That paper had so much in it, it couldn't possibly cover things like the effective lower bound,
right,
and how you implement policy. So there's a lot of questions, and I think it's something to try to digest. So
okay.
I do think that's interesting. Now, I will say that in that paper, I found it very interesting how he highlighted the declining nature of the stochastic trend in long run inflation, and made a point of saying that's not necessarily inflation expectations, or is that inflation? What is that animal, and how do you measure that? It's a latent variable in all of those things. There are a lot of tendencies that drive the economy that we don't see, that government agencies and private groups haven't been able to get their handle on in terms of measuring, but are unbelievably important, I still believe.
Right.
And so I think understanding that reduction in some underlying inflation process, I think, is actually very important. And it is below 2%.
Right.
And so if it has stabilized at a level that's lower than helps support what we're doing, and you have the ELB risk downward bias, not risk, but downward bias, there's still a lot of scope for rethinking how you do this.
Right, right. So, and that sort of takes me to the other side, which is the labor market side. There have been some critiques that by having a very defined target on inflation, but no defined target on employment, maximum employment, that then it just sort of leads to excess focus on inflation and understanding every piece of the inflation dynamic and projecting it in great detail. Whereas the labor market is sort of like, yeah, we'll kind of know it when we get there. How do you respond to such a critique, and where do you see the labor market right now?
Well, I see the labor market. I mean, the labor market is very complicated right now because there are a large number of people who are not in the labor force who have moved out. There's a shortage of workers that a number of firms, you talk to business people and they will tell you they're running into worker shortages issues. A good chunk of it is in the leisure, hospitality, entertainment area, where workers were released from their attachment to firms and now you want to bring them back. And it's kind of like, well, that's sort of a different dynamic than if it was a long time tenured worker at a manufacturing plant that got released, and maybe they would come back sooner, or they brought them. They
Right.
kept people on. So it's very complicated. And yet
attachment is last, you're saying, yeah.
Yeah, but there are a lot of workers presumably still out there who can come back if we solve things like childcare issues, better scheduling, health, maintaining that.
So
and all the
implicitly
things,
in your
and all the things,
forecast, you expect some of that to come back.
Oh, I do. I absolutely do. I mean, I see unemployment going below 4%, before too long. And but I think the larger point on the framework is I view the employment mandate as we're supposed to be, facilitating the attainment of maximum and inclusive employment. And so if it's clear that employment is too low, we should be using policy to encourage higher employment. Now, what if employment is too high? Can you have employment that is too high? I mean, again, this is the economist getting caught up in the idea that, well, if employment is too high, then inflation risks are going to be rising. Well, let's focus on inflation. So I kind of view this as more lexicographic, which is, when employment is too low, then we definitely pay attention and worry about it a lot. If it's too high, what's inflation doing? If inflation is low, why would I fight 3% unemployment, even though you kind of go, wow, is that sustainable? Well, what's inflation doing?
Right. Right. So you have optimism for labor supply, and so you think that will be still a disinflationary fundamental force in the next couple of years. Is that fair to say, that there's enough slack in the labor market that we're not going to see?
Well, I think to get our output forecast. We're going to need workers coming back in.
Right.
And so you put that all together, and I think that you're going to see unemployment rates below 4%. And I think they could go lower, 3.5%. And I think that that could be consistent with inflation still struggling to stay around 2% or 2.1, because you've got to offset the effect of lower bound risk. And so it's a question of how the setting for monetary policy and everything else is going on. What's going on with fiscal policy? Is it helping or providing a drag? Things like that.
Right. And so in terms of the framework, you don't see not having a specific, some people have proposed the prime age employment population ratio as a metric that's nice and clean, and it includes both labor force participation and unemployment, and you wouldn't favor sort of solidifying focus on a metric like that?
Well, I mean, I think it's good to have different, a wide array of measures of what success looks like in the labor market. I think we should be striving to achieve labor market vibrancy. I can't see a good reason why we should try to shut down labor market vibrancy. And so, if we've got a good measure and it's kind of like this value tells me we're doing really well, and it's kind of like, great, now what's next?
Yeah.
If inflation is low. Now, of course, if inflation is, on the wrong side of 2 and you're experiencing inflation that's undesirable and that, then of course you would, realign things.
Right. So some of the questions that are coming in from the audience, also key to your sort of assessment of these inflation risks and your not new target of above but close to 2%. How confident are you that R-star is still low? And what do you think are the forces that keep it low?
R-star is something that's evolved over a long period of time. Has come down. I think that there's probably demographic reasons for that, aging of the population. I think that the global savings glut that Bernanke pointed to quite a long time ago, led to that. Larry Summers' secular stagnation is a close cousin to that. Has that been repaired? Is inequality in income and wealth also contributing to this? Is that turning around? I don't see any evidence of that.
Right.
Is the U.S. still a safe haven for this global savings and all of that? I think that as you look around, the world, it's always easy to sort of say, I really wish in the United States we'd correct this problem and do this better and all of that, but it's really a relative investment game, isn't it? And it's like, where do you feel safest? And I think the U.S. still has, so many of those attributes. So I think it's hard to argue that R-star is increasing. I think the 10-year Treasury rate, with all of the fiscal debt that we have piled up and will continue to, and it's still very low, even if it's been going up the last few days or whatnot. I kind of go, I don't see it yet.
Yeah. Okay. And sort of, we're in the midst of this big policy experiment, right? The shift in the framework from the Fed, a shift in orientation from fiscal policy to go big and go early. When the crisis hits, you don't wait around to fine tune. You go big and go early. And, for zero lower bound reasons, for flat Phillips curve reasons, et cetera. What do you see? We focus a lot on the high inflation and inflation risks. What are some of the wins that you see? What are some of the good things that have resulted from that new strategy already? If you can cite some, or if you see any, what has it done that's worked well?
Well, I think it's still early days for the new strategy. I mean, I think that we've been talking about the looking over the last 5 and more years at monetary policy. How would it played out? This is something that Jay Powell and Rich Clarida did in the early part of their terms. And so we had work streams thinking about that, and then COVID hit.
Right.
And so then COVID hit, and Jay displayed tremendous leadership and pulled out the playbook from after the great financial crisis, and then innovated more. And once we started, buying assets, and we, acknowledged that it wasn't just market functioning, but also to support the economy, and you kind of go, so, it's always going to be hard to turn that off, isn't it? What is substantial further improvement? And back in 2012, we had substantial improvement in the labor market outlook, so it's in the eye of the beholder, and you have those arguments. Did the framework help us extend the period of asset purchases? I don't think it's, I think we would have done it this way anyway.
You do.
The asset purchases, yes. It still would have been hard to raise rates. So I think it's still too early to kind of say, but the follow through on what we mean by inflation overshooting, and we're going to average 2% over any window you want to measure, right? Yes. And so it's kind of like, hey, Charlie, you talked about that window and how it was going to be hard unless we got some 2.5%. So why are you now talking differently? Fair point. And it's all about, you can average 2% and then you kind of go, now we're inflation what if inflation expectations were 1% after you average 2? Well, that wouldn't be a win, right? So it's got to be an in combination kind of assessment. And I did not see the supply shock, bottleneck, logistics problems, workers not coming back, and high inflation price spikes. And I think I was in good company not seeing that.
Yeah, lots of frictions.
But we're trying to work our way through that. And it challenges every perspective everybody has.
And I mean, so I wanted to ask a little bit about the outlook and risks to the outlook, which you cited, continued risks to the outlook. Mostly it sounds like stemming from the pandemic lingering and creating more bottlenecks and more sort of frictions in the recovery. Is that your main risk?
I'm certainly concerned about that. I, am extremely optimistic that the science of, the vaccines, and we have it in our ability to provide as much protection as everyone is willing to take on and around the world. And so I think that there should be ever smaller waves, hopefully, unless some variant comes along, which is even more, gruesome. You can go back and look at the 1918 flu and realize that sort of in the second wave, there was a virulent strain that hit young people, healthy people, because their health system recognized that there was a virus and it over-responded, whereas people who were older and not quite as good with their immune system, like myself, it was like, well, we'll have to take this easy. And that turned out to be a better outcome. I mean, it's just, so there's uncertainty there. But, fundamentals in the US are very strong. I think that keeping people employed as much as possible, keeping people in their households to protect has been successful. Getting them back on the job in a safe way with childcare and assistance and all that would be hugely beneficial. Being on track to do that, we could stay on potential. There are many positive things, and
is the fiscal negotiation that's happening this week and with great intensity, is that a key input to your forecast, that some of what's being discussed gets legislated? Would you sort of alter your forecast if it doesn't pass?
So I'm sure we have some positive contribution from an infrastructure type of bill. The spending will be over a long period of time, so it won't be in the same order as the three previous programs, but it'll be a positive. Paying for all of that in a timely basis will be an important part, of that too.
Right.
So as long as there are no, kerfuffles or something like that, I'm optimistic.
Kerfuffles, yes. Like debt ceiling kerfuffles?
I mean, things that are, avoidable.
Right. So fiscal is sort of a moderate influence on the forecast.
Remember, we've got the waning of the COVID packages too, right? So that presents a downward,
sort of
push as all. Yeah, no, that's right.
Yeah. Are you concerned about that headwind? It seems like people are not really terribly concerned about the fiscal impulse going from positive to negative next year. Is that something you see as a material risk to the outlook?
I mean, it's factored into our outlook, but we've still got, good above potential growth for the next, few years. And so,
So that's good. We've got a very low unemployment rate, which I take to be a very good thing. I don't see the upper inflation risks unless something gets out of hand that I'm not, thinking about. But we're all going to be looking at that,
Right.
So
Right.
I think that we still have time, and it's still early days to be calling the relative price increases something that's going to work its way into long-term inflation expectations, even if the response to supply bottlenecks and logistics issues is raising wages for workers in ways that were not expected or even imaginable for so many businesses. Just a year or two ago, the decline in labor share of income over recent years has been really substantial. Some reversion of that would not be out of historical norms, or, businesses are able, not every business model is going to work. That's what we're going to hear a lot about.
Right. Right. So we still have some of that typical recessionary dynamic or recovery dynamic that some business models still have to fail.
And they're just business models where you might be relying on the ability to hire lots, the turnover in your business establishment might be just fine because the, skill requirements are of the kind that most any type of worker could, meet, and turning over your workforce a few times during the year. That might be your business model. Maybe that doesn't work so well in the current environment.
Right.
Maybe people don't like working part-time, and they actually, 2 part-time jobs, now they can find 1 full-time job, right?
It pays more. Yeah.
And if you've been relying on those part-time workers being available and then playing around with your schedule because of, there are just all kinds of things at work.
Yeah.
And, that's entrepreneurial savviness, and it works as long as it does, and things happen.
And then you have to restructure.
Yeah, that's right. Well, you have to be nimble too.
You have to be nimble.
Yeah.
The strong will survive.
Well,
How much are the developments in China on your radar screen in terms of the property sector deleveraging and any type of risks, either acute financial risks or just more generalized global growth risks from these developments?
A lot of business activity takes place with suppliers over in China. And so your ability to get product from them, whether or not their financial situation with what's going on there is impacted, would be a question mark. You talk to business people doing a lot of business over there, they tend to be extraordinarily savvy. They've got a strategy. One would hope that they, have thought about this. Certainly a lot of companies, in response to the tariff issue a few years ago, moved some operations to other countries that weren't exposed to the tariff, like, Vietnam, and all of that. And so businesses adjust. They're not, nimble is a question. We learned that after Fukushima,
Right.
Earthquake, tsunami, and flooding in Thailand. And, businesses realized their supply chains were extended. And in some sense, we're finding the supply chains are extraordinarily extended now. And so how does that fit with your business model? I think that's capitalism, is businesses figuring this out and responding in a way that allows them to be the best at what they do and supply the consumer with good quality, affordable products.
So we have only a couple minutes left. Let me just close by asking you about climate change and what you see. We see it having an impact with supply chains and repeated sort of disruptions from more frequent weather events. There's the issue of bank regulation. How do you see the appropriate role of climate change factoring into monetary policy?
Well, so that's a big question, isn't it? So monetary policy,
Got a minute,
it's like,
20 seconds.
well, it's always like there is this factor, Z out there. How do you think about that, right? Fiscal policy, all these things. And it's kind of like, we're kind of looking at how that factor affects the economy and our forecast, and whether or not that pushes us further away from meeting our objectives, or not, and whether or not, monetary policy can have any effectiveness at improving the employment side of that if it's a real thing. Inflation is always our issue. And so even if it has some kind of structural effect on employment, well, then even we really have to be paying attention to what it does for inflation. For climate, I mean, there are a lot of questions. It's very clear that the effect of climate change is real, and just to look at the ice caps melting and that implications, it's hard to sort of convince yourself that nothing is really afoot. So do financial firms take that properly into account? Do they understand their risks? They certainly have every incentive to do that, and you would hope that markets would hold them accountable in a risk sense and have risk premiums priced into their market transactions. So on the one hand, you kind of go, if I think markets work and I think everybody sees this, that ought to be the case. On the other hand, you want to make sure that the safety net system and however we, are regulating them doesn't, induce certain types of, not so good behavior for the economy. So on that side, I think people are having useful discussions, talking about strategies with firms, and lots of people trying to get our arms around that. I think that's appropriate, and I think that's what, anybody would do. I mean, I do worry that if the climate temperature goes up, continues to do that, and if you talk about insurance products, well, how about an insurance product for this? There's not some natural entity on the other side of this where when the temperature goes up 2 degrees centigrade, I'm going to be a gazillionaire because that activity. Right. Therefore, I could offer true, risk sharing. Type of products and things like that. It's more about rearranging losses and things like that. So that alone makes you wonder about, financial market products and how they solve it, and whether or not they sort of solve it here, but then there's something else. And so good public policy is complicated by all of this. You need to, be thinking about it, talking to everybody, and trying to get to the best solutions. It's hard.
Yeah, excellent. Well, we're sure you're up to the task.
Thank you.
All right, thank you so much. Please join me in thanking President Evans.
Very pleased to have on stage Sara Johnson of IHS Markit, John Leer of Morning Consult, who are going to join us to talk about the U.S. economy and macroeconomic update. I'm Dave Altig. I'm Director of Research at the Federal Reserve Bank of Atlanta and the current NABE Vice President. So my job here is to frame the conversation from John and Sara and talk about a little bit about the NABE Outlook Survey, which is hot off the press, as everyone knows. So, do we have the slides up? I want to start by thanking the committee who put together the survey. You see their names there: Holly Way, Greg Dacko, Mervyn Jabarij, John Hofgraffa, Jack Heinhens, Kathleen Navin, and Ken Simonson, who did a fantastic job of collecting the information and collating it. Here's the message. And I'm going to show you several slides that compare the May survey to the September survey. You've heard some of this already. My graphic there may be a little bit overstated, but May actually feels like it was a really, really long time ago. And in fact, there was a substantial change in the GDP forecast and a downgrade, as has been mentioned, from 6.7% for 2021. That was the median in May to 5.6%. Now it's probably worth noting that that's still higher than the beginning of the year projection. So despite the fact that we've softened some throughout the year, we don't see these numbers all that often. Here's where I think the real change in the message is. Back in May, 56% of the respondents indicated that they believe the weight of risks were to the upside for GDP growth. That's flipped And as of right now, 58% of the respondents in the survey are weighting the risk to the downside. And of course, not too surprisingly, it's all COVID. So when asked what's the greatest downside risk to the US economy through 2021, considering both the probability of occurrence and the potential impact, and they had a list of, I don't know, 10, 11, 12 options, 63% said a variant of the virus against which vaccines will be ineffective is the biggest risk. And the next highest item noted was other at 16%. So individual items, of course, much less than that. So it's a COVID story. It's actually sort of a COVID story into 2022 as well. Some of the loss in expected output that we see in 2021 reflected in this survey actually comes back to us in 2022. So relative to May, the 2022 GDP forecast has been upgraded some. And again, though, the story is really a COVID story. Asks about the upside risks to the economy. 44% identified vaccines, not the ones being ineffective, but ones being effective as a source of upside risk as we go through 2021 and 2022. The fiscal policy programs actually don't really register much among our respondents. Then there's the inflation stuff. And of course, for this year, that has, we've changed our mind quite significantly about what the year is going to look like. The rate of inflation is now anticipated to come in over the year at 4.3%, but notably, and I said in our board of directors meetings yesterday, indicating the incredible credibility of the Federal Reserve. For 2022, we get just over 2%, and that has not budged over the course of the year. So I don't know if I want to get into a conversation about what's transitory or what that might mean. But even though these short run expectations of inflation have clearly risen because it's almost arithmetic at this point, not much has happened with respect to the forward looking expectations. For what it's worth, the current NABE panel projections for inflation measured by the PCE price index are right on course with the Federal Open Market Committee's median projection in the Summary of Economic Projections for both this year and for next year. So we're aligned. Pretty similar and unemployment rate with some softening of the economy. We get a slightly higher projection for the unemployment rate in the latest survey relative to last May. Going into next year, a somewhat better unemployment rate projection for 2022. Also consistent with some of the upgrade for GDP growth next year relative to the last survey. It's pretty much in line with what the FOMC is looking as well. The FOMC appears to be a little bit more optimistic about the unemployment rate than the NABE panel, but we'll call that close enough for government work. The labor market is, there were some interesting results in asking about the labor market, and in particular, this question of when employment will return to its pre-pandemic level. 84% now say they expect recovery by the end of next year, compared to 66% in the May survey that anticipated full recovery in the labor market. So that feels like people are becoming more confident, but there's a pretty substantial caveat to that. Only 12% expect full recovery by the end of Q2 in the latest survey. In May, 37% expected to see recovery in the first half of this year. So, and there were in fact no respondents in the current survey who thought we would be complete by quarter one, I think that should be of next year. So even though there are more people in the survey, greater fraction of respondents in the survey convinced we're going to have recovery, full recovery by next year, it got pushed back in time relative to the May survey nonetheless, which puts a little bit of an element of risk, I think, in that outlook. One thing I do want to point out is this combination of higher inflation projections and improving labor markets has ramped up over the year projections of labor compensation per hour. If I were to add the March survey into this, we would see this sort of steady increase throughout the year. This came up a little bit yesterday that, well, hey, this looks like a good thing. Wages are advancing, things that we always want to put into the win category. But I'll point out when you line those up against inflation, those numbers don't actually look so good. And I think it's worthy to keep in mind that the positive growth in nominal wages over the course of this year the corresponding real wages have actually declined. And that's completely sort of consistent with the survey results in expectation. Although next year it will look better. So one final thing, all roads lead to the federal funds rate and monetary policy, at least in the world I live in. And not for whatever it's worth, the NABE panel is a little less convinced that there will be a rate increase next year than the Federal Open Market Committee itself. I don't think I'm going back in time to 2002, so I think that's supposed to say 2022. I can call 2002 pretty accurately, actually. As for next year, the implied upper level of the target in the NABE survey is right where it's at now. And essentially in the summary of economic projections from the last FOMC meeting, the median is one rate hike. However, it's pretty spread in both the NABE survey and in the summary of economic projections. So for all of us folks out there who every once in a while want to think about confidence intervals, I'm going to call that one the same. So that's sort of a brief overview of the Outlook survey. Sara, I think you come to the floor next.
Thank you, David. I'm Sara Johnson with IHS Markit, where I'm part of the global economics team. And that usually means I can talk about any place but the United States. So it's a real pleasure to join you this morning for a discussion of the US economic outlook. Just reflecting on the broad contours of the NABE survey that David presented, I think our outlook is very consistent. We're a shade more pessimistic on the third quarter of this year, where we expect growth at an annual rate of 3.5%. But we're a bit more optimistic on the fourth quarter and progress through 2022. Like NABE, we've been revising down our US outlook in recent months, but I guess the good news is that we have also revised upward our outlook for progress through the year 2022. So we're currently anticipating 5.7% growth in the current year and 4.5% next year. And as a global economist, I couldn't resist putting up an outlook for the world to put the US in context. And what's quite remarkable about this cycle is the close correlation between global growth and US growth. Certainly the massive fiscal and monetary policy stimulus of the past year has helped to mitigate what was a very difficult COVID experience for the US economy. And so we're proving our resilience, and growth in the US and the world match up very closely through 2022. In the 2023 to 2025 period, we're anticipating 2.7% growth for the US, but 3.2% for the world. And I think that difference of about half a percentage point is consistent with our long-term outlook for the global economy and the US economy, whereas by the 2030s, US growth will be down around 2%, global growth around 2.5%. Now, just to give you an overview of our outlook, we're assuming and expecting that we will see diminishing new COVID-19 cases and hospitalizations moving forward. And certainly there's some positive signals in the past 2 weeks with new cases, the 7-day moving average down about 18%. We expect to see a solid but slowing growth. The easy gains are perhaps behind us, and moving ahead, we still see some supply constraints restraining growth through 2022. So a moderate outlook moving ahead. Diminishing inflation, certainly inflation has surprised a bit on the upside, but we do see a moderation. Our CPI forecast is for 4.2% this year, 2.4% next year. And I would say that there are some upside risks to that outlook, given the persistence of supply disruptions and problems in the global shipping market. We see interest rates rising very gradually. We expect to see tapering of Fed asset purchases before the year ends, and but no increase in the federal funds rate until 2023. We think equities are richly valued, but I guess the good news is the strong resurgence in corporate earnings, which puts the S&P price earnings ratio about 24 right now. And that's certainly a reasonable range, but we certainly won't see a repeat of the rapid increases we've seen in the past year. The outlook is kind of a balance between headwinds and tailwinds. Certainly the headwinds to growth, the continuing presence of the COVID-19 virus leading to consumer caution, extended supply chain disruptions. Our view is that housing markets have peaked. The sharp rise in prices has diminished affordability and will lead to a moderation in construction activity. We're also seeing the withdrawal of fiscal stimulus related to the pandemic, and a question about labor market supply, excuse me. On the positive side, that COVID-19 vaccinations are continuing to rise. Right now we have 65% of the US population vaccinated at least once and 56% fully vaccinated. I think the US benefited by being on the leading edge of vaccinations, which resulted in our very robust growth in the first half of this year. And we should see continuing improvement in the epidemiology. Release of pent-up demand. That process has been spread out, will continue into through 2022. Very accommodative monetary policies, low interest rates, ample liquidity, and a favorable environment for capital spending. Another big tailwind will be inventory cycle. Should note that about half of the growth we see in the third quarter, 1.8% percentage points, is due to a reduction in inventory decumulation. By the fourth quarter, we see inventories stabilizing and then rapid increases in inventory accumulation over the first 3 quarters of 2022. And then finally, commodity prices have turned down, and that will certainly help to ease the inflation situation. Just a few notes on consumer spending. We're projecting real consumption growth of 7.8% this year, 3.3% next year. Services are the major swing factor, along with durable goods. You can see this year that blue line shows, the strong increase in durables consumption. But moving forward, we will see a shift towards services. This chart shows the upper set shows services. The green is the cycle and our current outlook. The red is the trend as of our March 2020 forecast. So and so you can see a sharp shortfall in services gradually made up, and similarly a surge in durables subsiding a bit. But note that by the mid 2020s, the green lines in both cases are above the red lines, and that's largely due to excess savings of 2.3 billion, as well as the surge in both equity and housing values. Real household net worth is about 10% above where we expected it to be back in March of 2020. And certainly while that gain will be spent over a lifetime, there will be some benefits in the near and medium term. But over time, we expect to return to a normal relationship between spending, income, and wealth. We see the personal saving rate, which was about 16% plus last year, at 8.5% in the third quarter and 6.5% in the fourth quarter. Home building, we expect will decline. Here's the profile. You can see it's not a sharp decline, but it represents a kind of a reversion to a more normal trend. And the trend in our forecast is for housing starts to exceed the rate of household formation by a small margin, reflecting mobility of the population around the United States, and the fact that maybe the desired level of housing stock is shifting to different locations. In terms of capital spending, a fairly vibrant outlook. We're projecting business non-residential investment to grow about 7.7% this year, 6.8% next year. So a fairly vibrant growth rate led by equipment and intellectual property. In contrast, the investment in structures is still struggling, reflecting the closure of retail stores, the work from home trend, and therefore the reduced demand for office space. The fiscal balance will be, fiscal deficits will be narrowing as we move beyond the COVID-19 stimulus. But as a result of all of that spending, we are left with a fairly high debt burden at about 100% of GDP. I'll just say a couple words about the Infrastructure Investment and Jobs Act, the IIJA. We introduced that in our forecast in September. And as you can see, it has a fairly modest impact when you look at it as a percentage of GDP. Some of the outlays related to the surface transportation were already in our forecast. So the incremental effect is an additional 0.3% or so of GDP in the mid 2020s. The appropriations are spread over time, and then the actual outlays will be even more distant. So the impact on real GDP growth we expect will be positive through 2026 and negative in subsequent years. So I think we expect that we'll see about 750,000 additional jobs at the peak, but those additional jobs in the 2025, 2026 area will not be a permanent feature of the landscape. Oh, and here's a look at the jobs impact. First on employment, and then the next chart shows the impact on annual inflation rates, and it's a fairly mild effect. There are supply side benefits and as well as demand side increases. So just to close with a few words on inflation. Our outlook is sanguine. I must admit that I'm a little more bullish on inflation than some of my colleagues, but I'd say there's certainly a very strong case for diminution of inflation rates moving forward. One notable factor is commodity prices. Our materials price index peaked in May. It fluctuated a bit through the summer, but since the end of July, that price index has fallen 12%, led by sharp declines in ferrous metals and lumber. But we have seen, increases in other areas, like most notably natural gas. But we're beginning to see market adjustments on both sides. Buyers are resisting high prices, and supply is responding to price signals. On the caution side, we expect semiconductor shortages will persist throughout most of 2022. And similar with the shipping industry, the effects of all the disruptions have been cumulative. Our maritime and trade colleagues kind of expect the situation will actually get a little worse in the next couple of months before we see improvement. And that improvement will be a project for all of 2022. Crude oil prices, I should note that OPEC plus supply has been lagging behind the agreed upon levels. So despite the fact that demand has plateaued recently, we still see prices rather elevated. In 2022, we should see more of a supply side response with increases not only in OPEC plus, but in a number of other countries like the US, Brazil, Canada, Norway, Guyana. So we see prices settling down in the mid $60 per barrel range. I won't dwell on this, but note that chip shortages are having a major impact on the automotive industry. Our automotive experts recently marked down their production forecast for both this year and next year. And I think that will be a further drag on our US outlook moving forward. But we do expect that the sharp price increases in the vehicle market will be largely reversed. That includes the used car market. If you look at the price trend, it's fairly stable over time. So what we're seeing now is truly an anomaly. And then for overall consumer price inflation, this is measured by the personal consumption deflator. That dark green line on the chart is core PCE inflation. If you take out motor vehicles, you can see a more, maybe a less extreme pattern. If you look at core inflation versus total inflation, the drop in energy prices next year, the stabilization in food prices with some drops in agricultural prices should help the situation. So I won't spend much time on our Fed outlook. I think bottom line is that we see the federal funds liftoff occurring in the third quarter of 2023. We see term yields drifting upward fairly soon. And we don't see federal deficits having an immediate impact on Treasury yields, but eventually they will. And mortgage rates will rise from current relatively low levels. So, bottom line, it's still a fairly sanguine outlook for the US economy. We have more recovery ahead in the next year. And after that, we'll settle in towards 2.5% growth in the second half of the decade.
Let me remind everyone that questions can be submitted via the AnyConnect app. We will collect them up after John's done.
How are we doing here? So first of all, let me just say how grateful I am to be here in person delivering this. I'm really happy that everyone showed up. Not only are you here, but you didn't wear your pajamas. So we're really making progress, learning how to return to conferences. My presentation today, I think, is, complements the presentation that Dave and Sara just delivered, which is, if you look at the work that they are doing on surveying expert forecasters, let's say on a quarterly or a monthly basis, what we're doing at Morning Consult is doing daily global surveys, 20,000 people every day across the 15 largest global economies. And so what I'm trying to do today is sort of highlight what we see in terms of our high frequency data, bringing in some of that cross-country context, and then measuring not only perceptions and expectations, but also outcomes to sort of triangulate those sources. And in particular, focusing on many of the sort of same issues that our prior speakers discussed, which is looking at how the Delta variant is likely to impact consumer confidence and spending through the year, into the year, the permanence of labor market impacts, and then what consumers and clients are saying about supply chain disruptions and their impact on consumption. To sort of front run the end of my presentation, I'd say, the first point is pretty good. We see the downside risk of further falls in confidence and spending being heavily mitigated by vaccinations. I think the employment effects will be longer and more serious maybe than people would say, or at least that's what workers are telling us. And the supply chain disruptions pose some pretty serious challenges for businesses, but we are, after all, business economists. So that's sort of the purpose of this, is to figure out what this all means for businesses. So here we're looking at our daily consumer confidence measure. Every day we're measuring, we're asking 6,000 people in the US, the same 5 questions used by the University of Michigan, very clearly similar to, I think, what some of these prior panelists had said. We see July 7th as being the turning point. Confidence starts to fall very precipitously during that period of time. We don't have additional fiscal stimulus coming in as you did, let's say, earlier following the CARES Act. And then when you start looking at the change over time, very clearly you can see how negative it is. But what's pretty different is that the prior 2 periods, so if you think about March of 2020 or November and December of 2020, the impact of increases of cases on consumer confidence has slowed over time. And if you go to the right-hand side, you can see the Chicago Fed is now casting retail sales. They use our data along with others to sort of do a dynamic nowcast. And here again, the impact on retail sales of increases in cases is not as strong as it was previously. What's going on? Well, what we're seeing is, I think, the impact of vaccination. So if we track over time, the change in confidence across all of these countries relative to the share of the population that's vaccinated, we see very clearly that countries that have a higher share of the population vaccinated have had experienced a larger rebound in confidence. And in the case of the US, that has flowed through to spending. I think when we talk about the employment effects of the Delta variant, maybe my view or what I'm hearing from workers is slightly contrarian to a lot of the sort of upbeat measures. If you look on the left-hand side here, every week we're asking people if they lost pay or income at any point during the prior week. It's done a really good job of tracking weekly unemployment insurance claims, but you can see there are two sort of pretty distinct disconnects, both cases when the unemployment benefits expired. So I think right now what we're seeing is actually a more significant downturn in labor markets than you would see if you were to look at weekly unemployment insurance claims. And then on the right-hand side, very clearly, those pay losses are concentrated in the food and beverage and leisure and hospitality sectors. Again, though, if we contextualize this, these downturns are not nearly as severe as they were previously during prior periods of of COVID cases and COVID spikes. And then again, so trying to always contextualize what we see in the US relative to what's going on across the world. So this is 300,000 monthly interviews across all these countries, and we're asking people who did not work if they were looking for work, and we see very clearly that the US, unlike the case of consumer confidence, the US has not benefited from these vaccinations when it comes to encouraging people to get back to work. And the story that what I see in our data is one of sort of risk aversion, that we had a very strong shock, employment shock early on, and that's taken consumers a while to respond. And you've got a lot of people who are working and they still remain relatively unwilling to go look for new positions. If you look on the right-hand side, very clearly, we've got the Delta variant sort of easing that what was otherwise a pretty encouraging trend, that workers are no longer going out and looking for work. Or I should say the growth rate there isn't as strong as it once was. And then what does this all mean for consumers and workers? Well, we're looking over time, we're looking at the standard deviation of a lot of these expectations and outcomes to understand how differently people across the income spectrum are actually experiencing the economy. And what we see here very clearly is that in September, when unemployment insurance benefits expire, we get this spike in inequality, that low-income people are more financially vulnerable, and that without the extra $300 and with the, coupled with the expiration of the benefits more broadly, those folks are, disproportionately unable to pay their bills for a full month. So 31% in September. And then I think, this supply chain disruptions is a theme that we've heard from a few other folks today. What we're seeing when we go out and ask folks, how are they responding when they're unable to make a purchase? And first of all, I think what stands out is just how prevalent these supply chain disruptions are, particularly in the housing market, new cars, used cars. But also if you look on the right-hand side, there are a lot of folks who just flat out are deciding not to make those purchases, that this is deferred consumption, contingent on basic logistic issues. It's not, part of it is the pricing issue, but there's a lot of just availability and delivery delays preventing people from making these purchases. Over the past, a year and a half, we've been working with the Cleveland Fed to measure weekly inflation expectations, conducting 20,000 surveys every week. This is actually a happy byproduct of our last in-person NABE meeting, the policy meeting in 2020, where we got to meet President Mester and some of her research staff. So I've been working with them to track real-time weekly changes in inflation expectations, seeing this divergence. Again, there's a term structure difference, but the divergence between market participants and consumers And then we sort of just as a proof of concept, when we look more globally, we do see that in general, these expectations are tracking observed global inflation rates. And then I'll sort of wind this section down by just saying, this is not all negative. We actually, when we look at the category level changes in price expectations over time, what we're seeing is that a lot of those categories that were hit very hard during the pandemic, that those price pressures are easing, that consumers no longer expect prices to increase to the same extent that they did previously. I think new cars stand out really as driving that change, sort of all suggesting that the headline inflation expectations numbers maybe don't tell the whole story, that there's a lot of important category level differences. And so then I would just conclude, I guess, by saying, first of all, that, very clearly consumers are more resilient now than they were earlier in the year, that vaccinations are driving that resiliency. And so that provides a risk mitigation or against future COVID outbreaks. I think while the employment situation and consumers and workers, I should say, are not experiencing pay losses to the same extent that they once were, we also don't have the safety net in place that we did previously. And we see that showing up with a greater share of folks indicating they're unable to pay their bills for a full month, driving that inequality index. And then lastly, when we sort of take these results and figure out what they mean for businesses, I think President Evans spoke to this, that there's a lot of basics of, there's an opportunity here for winners and losers, that sales and profitability right now are driven by pretty basic execution and logistical concerns, and that businesses that are able to communicate with their customers and understand their expectations, not only for delivery times, but for prices, are going to be well positioned to capture that consumer demand. Thank you.
Okay, so at any point, of course, you can send in some questions. Got a couple here, but let me start with asking one question of both of you, which is, are your outlooks at this point still anchored, if you will, by the assumption that there's some point down in the future where we're going to return to something that looks very much like a pre-pandemic norm? Or are you building in some sort of substantial structural change, either in kind of potential growth or some other aspect of the economy? And what would it be if you are?
Well, I think the pandemic accelerated some long-range trends, particularly the use of technology. And so I would say that maybe our long-range outlook is not substantially different. We do see, for example, the shift in composition of spending reverting back towards services. We could see some permanent losses in the labor force as a result of maybe early retirements, lifestyle changes, just the shift to the shifts that have affected parents in the workforce. And I would say that most of the changes we see are somewhat marginal. Like we do see more mobility. So if you look down at the regional level, you might see bigger differences as a result of the pandemic.
I think, if nothing else, the pandemic should have taught a lot of economists how important like modesty and humility are, that this shock has resonated in ways that many of us could not have predicted early on. What we do see sort of real time is that, for example, we know people are going into the office less frequently. That's a change that's likely to persist. That has pretty profound implications for where people are spending their money. I think at the same time, there are certain sort of, longer term trends around labor force participation that I think what we're seeing is that's likely to also persist as well, where folks who have dropped out of the labor force due to childcare obligations indicate to us that they are not intending on returning as maybe other models would have expected.
So you both now have referenced some issues with labor supply. You both referenced some productivity gains, I think. So do you think it's a wash with respect to kind of what we can expect out of GDP growth, getting a little bit more in productivity and what we might lose in potential labor supply?
I mean, there certainly has been an investment in technology that one would expect to sort of generate some payoff in terms of, you know, total productivity. I guess there are competing factors there, right, around education and the role that the pandemic has played in limiting folks' ability to sort of optimize their high school and college degrees.
I think we are more optimistic about productivity, and you know, we've looked at ratio of our monthly GDP series, 2 hours worked, and there've been some upside surprises. So I guess that's another reason to be somewhat optimistic that inflation is transitory. Some of the increases in nominal labor costs have been offset by better productivity performance.
Okay.
I would just chime in there and say, clearly there's sort of a learning by doing, that people have learned how to be more productive by working from home over time. And we see that folks who worked from home prior to the pandemic had a pretty easy transition, indicating that they were as productive working from home as previously because they were working from home before. But it took a long time for people who previously worked in an office to move in to figure out how to work from home in a productive way.
So there are questions, and I've completely lost them on this thing. Tara, can you come up and help me? The first one was about the differential experiences and growth across countries, and a question about the source of those differences. So reaction and a capacity to handle COVID, is it something else?
Well, the waves of COVID have occurred in different places at different times. So for example, in the third quarter, a number of Southeast Asian economies went into contraction. Fortunately, COVID new cases are diminishing, and most of those economies' lockdowns are scheduled to end this week. So we should see a very strong pickup in the Asia Pacific region in the fourth quarter. In Europe, Europe had the double dip recession as a result of its winter wave of COVID-19. And that led to some lagging performance across Western Europe, where its full recovery is lagging in that region.
I mean, you know, very clearly, a lot of the cross-country differences have been driven by differences in their ability to fight the pandemic. I think going forward, as more and more emerging economies have access to a vaccine, we're going to see that it's not so much, you know, supply constraints limiting growth as much as it is sort of demand for the vaccines. We've already seen that in the U.S. largely, right, with this sort of leveling off of vaccinations, a slowing of the growth rate. We see that in Western Europe. There's a lot of vaccine hesitancy. I think, you know, what will drive that sort of long-term trajectory globally is going to be the ability and willingness of folks to take the vaccine.
There's a question that goes back to, that stays on this theme of references to the rest of the world, and goes back to this question about productivity. Are improvements in productivity offset by less foreign production as firms onshore activity? In other words, does the shifting away from the low-cost producer model change the way we think about U.S. productivity?
It certainly does to a degree, and to the extent that it's a less open global economy, we are not exploiting comparative advantages, and that implies a loss of productivity. So it's a concern.
Yeah, I would say it's a concern. I mean, I think everyone here knows how challenging measuring productivity can be. We're talking about a residual here that sort of moves around. So yeah, I wouldn't want to weigh in actually to see, I think time will tell. But, from a long-term perspective, I think there are real concerns around, like I said earlier, the inability of middle and low income people to go to school to get that sort of quality education that we know over time tends to drive productivity growth.
And, you mentioned low and middle income. That holds true on a countrywide basis as well, because certainly many of the developing and emerging markets have incurred a sharp increase in debt during the pandemic. And that will impede their ability to fund capital deepening in the medium to long term. So it can be a significant setback for some countries.
I mean, I will say that one of the startling things that we have been picking up the Atlanta Fed in our contacts with businesses is something that feels like a really fundamental rethinking about, I mean, the simple way of saying it is supply chains, but more generally it means the organization of production. And it feels very persistent, and at least in the language. Are you A, picking that up at all, and B, does it in fact influence the way you think about maybe the risk, but maybe also the actual projections?
Yeah, I mean, I think the way that I would handle that is, or sort of the mental model is thinking about of course, the efficiency gains, but those carry certain risk as well. So having these offshore production capacity boost efficiency in the near term. But what we've seen is when we have these sort of shocks, particularly supply side shocks, they carry very real risk for companies that aren't able to deliver on what consumers are expecting from them.
And it's not a new concern in that we had the rapid era of globalization from the mid-1980s up until the global financial crisis. And that basically stalled globalization. If you look at trade volume versus GDP, there was some flattening. And I think the future will not mean a reversion of that, of globalization, but a more cautious approach to globalization.
Okay, we're running down time here a little bit. So let's see if I can get these last two questions in. So this is speed round. Straightforward question. Why are vaccinations not helping to push up labor force participation in the US?
I think it's pretty simple. I think the people who have been vaccinated are the ones who believed upfront that that the virus posed a very real threat, and the people who have not been vaccinated are the ones who tend to believe that COVID is not a real threat. And so, the groups of people who are being vaccinated are very different than the ones who are not.
And it's probably a little too early to reach any conclusions because schools just opened for in-person learning, and the supplemental unemployment insurance payments just ended. So we could see a change in this dynamic in the months ahead.
And the final question is, are you building into your views about where inflation is heading over the relatively near term, let's say over the next year or so, the potential impact of rising housing prices working its way into owner's equivalent rent and creating a source of persistence that is yet to be seen?
I think it's safe to say that with inflation, the risks are on the upside.
What we know is that there's going to be a lot of people who have not been making their housing payments who are going to have to start making housing payments. So I think that that's going to really be a shock to the housing market, and you might see people who have held onto their homes all of a sudden having to start to sell to make those payments, which I think in turn would actually drive down prices. Yeah.
And we hit it on the mark. So join me in thanking the panel.
Let's see. Is my mic on? Yeah. So if we'll take your seats, we'll be ready to the next session. And Steve, we see you clearly. I don't know if you hear us either.
I do, great.
All right. If we're ready, we'll start. Hi, I'm John Lipsky, associate at the Johns Hopkins University School of Advanced International Studies, or SAIS. But I'm here today in my capacity as the board chair of the National Bureau of Economic Research. I'm here in lieu of our president, Jim Perturba of MIT, who had a long scheduled prior engagement. And I have the honor of sitting in on the annual presentation organized by the National Bureau here at the NABE conference. The topic is an extremely interesting one, and one that has come up I think so far in every presentation, and one you've been thinking about and worrying about and wondering about. And we have two wonderful NBER research associates who have been doing important work with colleagues on trying to examine persistent labor market effects of the COVID-19 pandemic, and have some extremely interesting presentations. Now, the presenters are first Stephen Davis, who is make sure I get it right, the William H. Abbott Distinguished Service Professor of International Business and Economics at the University of Chicago Booth School of Business. And with me is Stefania Albanesi, who's a professor of economics at the University of Pittsburgh. What you see before you is how one way in which the labor market has changed. Yesterday, a situation arose that prevented Steve Davis from joining us in person, as was the original plan. And without missing a beat, electronically, here he is, larger than life. And so we can see how easy it has become to bridge these kind of problems that previously would have been, I think, a minor crisis that would have left us all feeling quite perturbed. So without further ado, we have two great presentations. We'll have some discussion with the presenters, and then as usual, you'll be able to ask questions, and I'm sure you'll have lots of questions on an extremely interesting, extremely important topic. So without further ado, Stephen, the floor is yours.
Great, thank you very much, John. And you really hit it on the head there. The fact that I'm able to join all of you virtually is one illustration of the changes that the pandemic has wrought in terms of how we interact with each other, both in the labor market, of course, but also in sessions like this. And I regret that I'm not able to be there and see everyone in person, but I'm thrilled that I at least have the opportunity to speak to you and interact with you in this way. So I want to talk about working from home, why it will stick in part, and some of its implications. Let me start with just some evidence from a survey that I've been running monthly since May 2020 with Nick Bloom and Jose Maria Barrero. Among other things, we asked people how many full paid work days they're performing at home month by month. Those are the dots you see kind of in the center of the chart here, most of the chart, month by month. Roughly speaking, according to our survey, and by the way, I should say, these are people 20 to 64 years old who earned at least $20,000 in 2019. That's our target population. So we're missing some of the people who work part-time in fast food restaurants and that type of thing. But on an earnings weighted basis, though, that's a small share of the labor force. You want to keep that in mind, though, when thinking about our numbers. Before the pandemic, from other sources, we can see that about 5% of full paid workdays were performed at home. So it increased by a factor of 10 during the pandemic. But we also asked people in our survey how much their employers plan for them to work from home after the pandemic's over. That's the last number you see there, and that's more like 25%. So it's going to come way down from where it's been during the pandemic, but still an enormous increase from where we were. That's according to our survey evidence. Now, let me tell you why I think that, what the economics is underlying that stickiness in the shift of the pandemic. And our work documents 5 different reasons for why the shift will partly stick. I've listed them on this slide. I'm going to focus in my prepared remarks on number 1 and number 5 in the interest of time, but I'm more than happy to come back in the Q&A and talk about investments, attitudinal shifts, and changes in the direction of innovation that have also supported a shift to working from home. So item 1, mass experimentation and learning, and why that's led to a re-optimization of working arrangements. I think that's the single most important thing to understand about why the pandemic will lead to a persistent shift in working from home. So here goes. We all know that there was a huge experiment really forced upon us as a consequence of the pandemic. Moreover, there's 2 other interesting things about that experiment. It was done at scale. In other words, entire organizations abruptly shift their working mode. As you can see in this quotation from James Gorman at Morgan Stanley, that's something organizations are typically quite reluctant to do because the downside of a failed experiment is just too large. Now, there's another thing that's a bit more subtle. You can't really, you could experiment, you were forced to experiment during the pandemic in ways you could not before the pandemic. Think about a professional services firm. You could tell your own employees they're going to work from home 3 or 5 days a week as an experiment in your own firm. What you couldn't do before the pandemic was evaluate how well that experiment would work when your clients were also working remotely. So that's the more subtle aspect of the experiment. So compulsory, large in scale, and this, across different components of the supply chain, if you so to speak, in the customer relationship, all of that was happening at the same time. Experiments. Now, when you do experiments, you learn something, at least some of the time, and that's true of compulsory experiments as well. And our survey evidence says people learned a lot about how well they could work from home relative to their expectations. At least most people did. About a quarter of the people said, things worked out about as well as I had expected before the pandemic in terms of productivity. Okay, remember, these are surveys of workers. Some said it worked worse than I thought, but a good number, in fact, the majority said it worked better than they expected. Okay, so not only did they learn things on average, but it looks like the average worker, and other surveys suggest this was true for the average firm, had unduly pessimistic expectations about how productive people could be when working from home. Now, is this going to change behavior? We think so, and our survey speaks to that directly in the following way. What this chart does is relate what people say about how much they would like to work from home after the pandemic's over, say in 2022 and later, and how much their employers plan for them to work from home after the pandemic's over. That's what you see on the vertical scale. That's the percentage of the week. That's what you see in the vertical scale. What we see is that people who had positive surprises in how productive working from home was relative to working in the office are the ones who want to work more after the pandemic's over at home, and they're the ones that their employers plan for them to work more from home. So this is evidence that these productivity surprises, both positive and negative, influence both desired and planned extent of working from home after the pandemic. That's an important aspect of the mechanism that we think will lead to a persistent increase in working from home after the pandemic's over. There are other mechanisms that I briefly alluded to earlier, which we can come back to, but let me just point out one more thing, which you all are well aware of, but is important in this context. And that is the pandemic's endured now for about 18 months. And what I understand from epidemiologists, there's a good chance that this this virus will become endemic, and we may have repeated episodes with it. Maybe not as serious as we learn how to treat it better, as more people get vaccinated and have milder symptoms. And of course, there's also the possibility of other viral pandemics in the future. So there's an entrenchment effect that habit formation, both at the organization level, the individual level, attitudinal shifts, a lot of things becoming entrenched by the sheer duration of the pandemic. Now, let me talk a little bit about managerial challenges. And I'm sure some of you are already well aware of these. I want to give you kind of a broader look. Maybe you've thought about these challenges, maybe you haven't. I think many organizations are going to be confronting them in a serious way. First challenge, and you already saw this on my previous scatter plot about how much people want to work from home and how much their employers plan for them to work from home. There's a big gap between what workers want and what employers plan to give them, okay? I'll show you, I'm going to drill into the nature of that gap. When you see the nature of that gap and where it's biggest, you'll see that the challenges are even larger than they might appear at first glance. And that kind of, so then the question is what to do. Well, one possibility is just go back to the old norm, the status quo. Some organizations may do that or may try to do that. They're big challenges though, and I'll show you some evidence of those. Challenges about recruitment and retention and possibly a need to pay more. The other way to go, which in many organizations seem to be going this way, is embrace the shift to working from home, typically in a hybrid mode. Few organizations plan to go fully remote. Instead, it's part-time in the office, part-time at home, but that raises huge challenges about how to make that work for both the organization and for employees. So let me drill into these challenges a bit more. What you see in the black dots here are worker desires to work from home, the average by earnings group. And the basic point is it's flat. Pretty much all across the earnings spectrum, people want to work about 2.5 days a week at home if you gave them their unconstrained choice, okay? What employers say though is they're willing to go for that at the top end of the earnings distribution. So basically people at the top end of the earnings distribution will sort of get what they want with respect to remote work. But as you move down the earnings distribution, this gap gets wider and wider. Now, I'm not going to show you evidence here, but employees also place very high value on the option to work from home 2 or 3 days a week. It's something that they see as equivalent to a 7 or 8% pay increase. So everybody wants to do that, but not everybody's going to get to do that. And that will lead to increased tensions, fairness, perceptions about inequality, because obviously the folks at the top end of the earnings distribution are already getting a better labor market outcome in the earning sense. And this chart suggests that they're going to get a better outcome in the sense of working arrangements as we go forward. Moreover, when you look across demographic groups, there are two things that stand out. First, people of color want to work from home more than white Americans. And the gaps are reasonably large, especially when you compare whites to blacks. It's about 0.4 of a day per week. Okay, so that raises questions about why. Why is that the case, which we're trying to explore now. But it also creates challenges, again, if you let people choose, do what they want, sort the way they like, either within firm or across firms, and there are career differences that follow from your choice about how much to work from home, then these can play out in ways that people might be concerned about. Then the right side of this chart shows you something I think you could have guessed, but it's nonetheless an important phenomenon, especially when you look at college-educated women with children, and not surprisingly, they want to spend more time working from home than their male counterparts. So again, lots of managerial challenges flow from that. You can try to accommodate that desire, but then that leads to other issues about people being fully included in the office culture, in the decision-making, in career advancement opportunities, and so on. So big challenges there. Another challenge, according to our survey, more than 40% of all employees say that if their current employer, if these are people who are currently working from home at least 1 day a week, which is most people actually, according to our survey, if their employers tell them they've got to go back to the office full-time, 5 days a week, more than 40% of them say they're going to start looking for another job, or in some cases, quit immediately. Okay, so there's the retention challenges, and of course there's recruitment challenges that are kind of the come along with that as well. So employers have strong reasons to try to accommodate the desires to work from home part of the week of their employees, even though that presents a number of management challenges. So here's kind of a summary of what I see as some of the most important trade-offs. For many jobs, you basically can't do the job without engaging customers, clients, patients directly for part of the time, so you need to be on site. Obviously, bringing people together can be good for company culture and cohesion, and there's a long-standing view that creativity flows somewhat spontaneously from in-person interactions. Advantages of working from home, big obvious one, savings in commuting time. And I just take a moment to say that's a really big deal. If you're spending 60 to 90 minutes a day commuting, and you can get that time back by working from home 2 or 3 days a week, you can do a lot of things with that time. Spend more time with your kids, do some housework, leisure activities, but you can also spend it on your main job. And our survey evidence says people spend about 1/3 of the time they save from not commuting on their primary job. There are other advantages of working from home, which I'll just let you glance at there. So all of this has led many firms publicly to announce, and I'll just run through a few of them in a sec, that they're going to move to some kind of hybrid working arrangements with many for some or all of their employees. But of course, that creates a whole bunch of challenges. Now you have to think about, well, how do I foster culture, creativity? How do I create a cohesive culture? How do I mentor the less experienced? How do I monitor the remote workers when they're working remote? How do I coordinate remote and on-site workers? A whole bunch of challenges there. And I think it's going to take some while to work out. So here's just a few examples to make the point. Citigroup, Google, HSBC, Amazon are among just a few of the very prominent companies that have already said we're going to a hybrid working mode for many of our employees. Now, one possibility is you just let the employees choose. And an attraction of that is there's huge variation in what people want. Some people hate working from home. They really want to be back in the office every day of the week. They thrive on that kind of energy and in-person interaction. But there's a lot of people who never want to, who basically would be happy to work from home 5 days a week. And there's a very large number somewhere in the middle. When we ask, and this is in another survey that I co-designed with people at the Atlanta Fed, when we ask employers directly, what do you plan to do? What we see is that a good chunk, nearly 40% of small businesses say they're basically going to let their employees choose. But when you move to larger businesses, you really see a considerable reluctance to let employees simply choose which days of the week they'll be in the office, which days they'll be at home. Instead, there's much more focus on some kind of planning decision, often typically at the team level, where the team decides who's going to work from home on which days. And obviously that helps address some of the coordination issues I alluded to earlier. Now, on societal and economic consequences, again, I'm happy to talk about any of these that I've listed here. I'm just going to say a few words about the productivity aspect right now. So according to our estimates, using the information that we learned from this compulsory mass experiment, we estimate there'll be about a 4.7% gain, one-time gain in labor productivity after the pandemic's over. Now, it's important to understand where that's coming from. We're not saying that working from home is more productive on average than working in the office. Instead, where this productivity gain comes from is some organizations, some people have learned that certain activities can be done as productively or more productively at home. Those are the activities. So we'll select into those activities. We'll do those at home. The ones that can't be done at home as effectively as at the office, well, we'll continue to do those at the office. And remember, there's this savings in commuting time there. That's actually about 3/4 of the gain in productivity, according to our estimates, just coming from this simple, you don't have to spend 60 minutes, 90 minutes a day commuting. Now, one additional point about productivity. Since we're going to be living in a world where people work remotely, and as we see in this conference, there's more remote virtual interactions in general, it behooves us as a society to make sure that we've got high quality internet access widely available throughout homes when it comes to remote working. And so we estimate in separate work that universal access to reliable high-speed internet would boost productivity by about 1% on its own because so many people will be working remotely. And those gains are pretty obviously much bigger during if there's a future, God forbid, pandemic-like disaster where we suddenly can't commute to work, we can't work remotely. Let me end on a whimsical note. We asked people about their willingness to shake hands and how they would greet people when they go back to the office. We asked this last month in the survey. What we see is an enormous shift away from handshakes, not surprisingly, but it's especially concentrated among women. So when you go back to the office, you see your female coworkers, they're much more interested in a wave and a verbal hello than a handshake or even a fist bump. And I'll stop there. Thanks.
Thanks, Steve. Excellent. You didn't ask what's going to happen to the air kiss greeting. But now, thanks very much. And now, Stefania, we have your presentation and then we'll
here we are.
Discuss. Thanks.
So I'm going to take a complementary perspective and talk a little bit about the prospects for women's employment and how that matters for the aggregate. And so here's a plot of the change in employment to population ratio from the start of a recession 3 years out for the last 4 recessions in the United States. And as many of you know, in a standard recession, women lose fewer jobs than men, but during the pandemic recession, the pattern was quite reversed. So the reason why usually men lose more jobs than women in standard recessions is twofold. On the labor demand side, men tend to be employed in construction, manufacturing, very cyclical occupations and industries, but also on the labor supply side, importantly, exactly because men tend to lose more jobs, we see that in standard recession, women increase their attachment to the labor force. So they're less likely to leave their jobs, perhaps, in anticipation that their partners, might lose earnings or might lose a job. Now, if we think about the pandemic recession, and why women have lost more jobs than men, we can go back to the same factors, demand and supply. And on the demand side, we have that women are exactly overrepresented in the sectors and occupations that were most exposed to the pandemic in terms of risk of infection from co-workers or customers. And on the labor supply side, there was also the challenge of school closures, childcare closures, and so on and so forth. So let's look at occupations. So we categorized occupation based on the degree of contact with coworkers or customers, that's high and low contact, and based on the possibility of working from home, consistent with Steve's presentation. So flexible is ability to work from home, inflexible, you can't work from home. And so we have 4 occupational categories where the inflexible high contact occupations are the ones that are most exposed to the pandemic because it's hard to work from home and there's high contact. And those are mainly healthcare and service occupations. And you can see they employ only 17% of employed workers, but the female share is 73%. And then we have the flexible low contact occupation, mainly professional and managerial occupations. Those are the safest from the standpoint of COVID. They account for about half of all employment in the United States pre-pandemic and also half of female employment. And then I'm also highlighting the inflexible low contact occupations, which are all these construction, production, transportation occupations that are the ones that are usually very hurt by standard recessions. They account for 25% of all employment, but they're highly male dominated. So if we look at what happened to men and women in these 4 occupational categories, you can see that in all occupational categories, women lost slightly more jobs than men, but other than these inflexible low contact occupations, the gender difference was quite small within occupation. And in fact, controlling for age and education, the occupational distribution accounts for about 1/3 of the gender gap overall in the loss in employment during the pandemic. Now, to bring in the labor supply side a little bit, what we can do is look at gross job flows. In particular, if we look at the employment to unemployment flow, that's the one that's most related to labor demand, people just getting laid off or furloughed. And on the other hand, the employment to non-participation flow is the flow that is more linked to labor supply. So workers voluntarily deciding to lose their job and quit the labor force. So what you're seeing here is just a plot of the gender gaps in the employment to unemployment and employment to non-participation flow by demographic group, where the demographic group is characterized by marital status, married versus non-married, and the presence of children, with and without children under the age of 12 present in the household. And if you look at the EU flow on the left panel, you can see that in phase 1 of the pandemic, that's March, April, and May 2020, women lost more jobs than men, meaning there was a larger E2U flow in all demographic segments. And by the time we get to phase 2, which is the rest of 2020, so June onwards, you can see that there's only a sizable gender gap that remains for single workers with children. So single moms, had much bigger E2U flows than single dads in phase 2. When we get to the EN flow, and all of these numbers are controlling for age and education, you can see that in phase 1, the bigger gender gap is coming up for single parents once again. So single moms experience, much larger E to N flows than single dads. And in the rest of 2020, so June onwards, we can see that that gender gap still remains for single parents, but also comes up for married with children individuals. So after the peak phase, of the pandemic, we see sort of this persistence of relatively high employment to non-participation flows for mothers, particularly single, compared to fathers, both single and married. Okay, so there's another element that contributed to larger losses in employment for men compared to women, which is that women have lower wages. And in this pandemic, lower wage workers were disproportionately affected by job loss, whereas higher wage workers, had their hours reduced, had perhaps their earnings frozen, and so on, but they were not laid off to such a high degree. And on the labor supply side, also the fact that women have lower earnings is really connected to what we refer to as the child penalty or motherhood penalty. So women, when they become mothers, their earnings really fall, whereas the opposite happens for fathers, and that's controlling, for what we can observe. So if you're a mother and the pandemic hit, you're quite likely to be earning less than your partner, the father of your children. So from an opportunity cost perspective, if schools close and childcare is not available, you're the one that's most likely to have to reduce your hours or leave the labor force. And what you see here is just a simple counterfactual of the ratio of employment loss for women versus men. So the blue is the actual in the peak phase of the pandemic, and the orange one is the counterfactual that we can obtain if we give women the same earning distribution than men. And you can see that the blue, the actual, suggests that women lost more jobs, as we saw, than men. And the orange is actually smaller than 1, which suggests that if women had the same earning distribution as men, they would actually have lost fewer jobs than men during the peak phase of the pandemic. Now, will employment for women and overall rebound? So if we go back to the last recessions since the 90s, as you're all aware, there was this phenomenon of the jobless recoveries. So aggregate demand, GDP recovered, but employment growth was very sluggish, in the aftermath of the last 3 recessions. And on the labor demand side, one explanation for this was just firms adopted labor-saving technologies such as automation, software, and so on. And so as demand recovered, they just didn't hire back, the workers. And so we looked at whether the occupations that were most affected by the pandemic, were susceptible to the adoption of labor savings technology. So the inflexible high contact occupation, which were the ones that experienced the biggest drop in employment, actually have a high degree of susceptibility susceptibility to automation. 34% of all workers in those occupations have jobs that have a high routine content, which means that it can easily be performed by machines, be they robots or AI or software. And that's a pretty high number. And after this pandemic, there's a couple of reasons or additional incentives for firms to adopt labor savings technology. One is that obviously machines don't get sick, and there's a persistent risk of infection. Vaccination is not high as it should be in the US and in many other countries. So obviously that gives us an incentive to adopt labor-saving technology. And also, in this recession, we've had this permanent shift, for example, to work from home, which has persistently reduced demand in certain sectors, including leisure and hospitality, which falls in this inflexible high contact category as well. So if demand is lower and unpredictable, it probably gives firms an even bigger incentive to adopt labor-saving technology. Now, on the labor supply side, one reason why we saw jobless recoveries prior to the pandemic was actually the fact that starting in the 90s, female participation stopped growing. So in the 70s and 80s, female participation growing 2-3 percentage points per year. And around 1993, it stopped. It kind of flattened out. If you look at employment behavior by gender, Tend to have lower wages and earnings, even if they have the same educational requirement as some, male-dominated jobs. And for example, healthcare is a big example of that, right? That has become, a very important during this pandemic. So, for example, the fact that we've all realized that healthcare is so important, may lead employers to finally pay healthcare workers like they need. But another area is the investments that employers make in their workers. So I talked about retraining as a possible, policy lever or option, sort of encouraging retraining for both men and women who have lost jobs in occupations that we think are going to be permanently downsized after the pandemic. But in the data, what's really interesting that in the past or up until now, men mostly retrain because their employers provide them with retraining programs or funds to take an executive MBA program or a master's degree. Women who retrain out of their own pocket and, get master's degrees or finish college just out of their own initiatives. And that's another way where women might be undervalued. So employers, invest more resources in retraining their male workers at all ends of the spectrum and less so at low end. So I think, the fact that women have dropped out of the labor force, which is causing, to some degree, labor shortages in some really key occupations and sectors, may finally, give an incentive to employers to invest a little bit more equally, not only to retain workers, but also attract, female workers, including offering perhaps, education on the job that would save, women from having to spend, their own money to get continuing education.
Thanks. I'm sure the audience is listening closely and we'll take that message back. Stephen, now you look like you're actually live and with us.
Yes,
Thank
I
you.
am. Good to be
Great.
back.
The one of the points that you made that struck me the most was that the productivity gains were mainly explained by the savings on commuting time. So that has a couple implications, right? Namely, the benefits of that increased productivity accrue in the first instance to the workers, not to the employer. And secondly, that that this is not going to be included in the formal productivity statistics in the first instance. Output won't have changed, but inputs from the point of view of the worker will have been reduced by the savings in commute time, other things being equal. Do you think that's going to have some, assuming that's sticky, and although your presentation suggests there's still going to be some jostling between what employees and employers want post-pandemic, but assuming that work from home is going to end up sticky, is that going to have an impact on wage levels? Since real incomes will have increased without an increase in money wages. Is it going to have an increase in participation rates if it remains sticky relative to what there was before? And do you see any potential distribution effects that might be long lasting?
Yeah, thanks for that, John. Let me start with your productivity, your point about measured productivity, which I think is spot on. So when we try to mimic what the statistical authorities do, instead of a 4.7% productivity boost, we come up with a 1% boost. So just as you suggested, we think most of the gain that comes about from the reoptimization of working arrangements will not show up in the standard productivity statistics. Doesn't mean they're not real, they're just not measured. And if you think about it for a second, in the past, it didn't really matter much whether you measured worker time inclusive or exclusive of commuting time, at least for purposes of cyclical productivity movements, because commuting time just kind of moved with regular working time, number of work days you went to work. So you can see why the statistical authorities might have done it the way they do it, but it does have this implication that the actual gains will be bigger than are measured. So that's important to keep in mind. And as you also suggested, in the first instances, these benefits are going to flow to workers. So that's why I said the people who get to work from home more, they are benefiting relative to those who don't, or aren't going to have so much opportunity to participate in that. There's a real question about how it plays out over time. And it's quite appropriate to think about, since the implicit compensation associated with working from home is concentrated at the upper end of the distribution, to recognize that in wage gains going forward, and also recognize that people at the lower end of the earnings distribution, not only are they not experiencing this benefit, but in some cases in these high contact jobs that Stefania talked about, they may and have been experiencing increased exposure to infection risks. So there are some real distributional consequences to consider here. They're just not the measured income distributional consequences that normally occupy our attention.
Exactly. Very interesting. Thank you. One final quick question. I'm sure you're familiar with Bob Hall's recent work showing that his claim that if you look at the data correctly, that the post-recession increases in unemployment occur in the United States economy at a steady pace, irrelevant or insensitive to the macro policy setting. Do you think that the pandemic is going to mess up his results?
Possibly, and it partly depends on what you mean by the macroeconomic policy response. So we tend to think of that in terms of monetary and fiscal policy, but I want to broaden that a bit. And this also ties in indirectly with some things Stefania said. There are some real opportunities to bring people into the labor market, or bring them into the labor market more effectively than they have in the past. And let me mention two things. There are some people who don't work because it's just too inflexible. Their work opportunities are too inflexible. They might be willing to work if they could work mostly at home. Might not be the most high-powered job, but that might be enough to draw them into the labor force and let them be at home to look after the kids or whatever. It's also important to remember that not everybody lives in urban areas with thick labor markets. There are a lot of people in the country who live in places where there are very limited opportunities to exercise some of the skills they have. And as a consequence, they either might not work, or they work in jobs that don't fully use the skills they have. If these people have the opportunity to now maybe work 4 weeks out of 5 where they live, and 1 week where they have to go to the big city that's 100 miles away, that might draw some talent into the labor market that's currently not being exploited very effectively, or not at all. And I don't mean that's not a bad word. There are people who don't have good opportunities to exercise the talents they have by virtue of where they live. And they may live there for family reasons, personal preferences, that's where they grew up. So there is an opportunity to draw on an underutilized talent pool over the coming years. Policy will influence the extent to which that happened. I came in at the tail end of your conversation about healthcare. Another aspect of healthcare that's kind of important and was drawn to the fore during the pandemic is these somewhat ridiculous restrictions on the ability to supply healthcare services remotely for kind of routine consultations. You can imagine someone who's a registered nurse who lives in a more rural part of the country. Well, imagine that they could do some of their consultations remotely rather than having to drive 100 miles to the clinic or the hospital. That would be a more effective way to utilize that person's skills. So there are some real opportunities that I hope we take advantage of in the coming years as these technologies for remote interactivity get better, and and as organizations and people learn how to use them more effectively. And hopefully also as the regulatory environment responds in a productive way. That's the most obvious policy aspect of this.
Thank you very much. Sadly, our time's come to an end. I think we should thank our two speakers for some really interesting and challenging. Just note, in drawing the obvious conclusion, they're wonderful advertisements for the kind of work done at the NBER. And hopefully that you are all, this audience is well aware, for example, of the enhanced website of the NBER that makes the wonderful working papers of which you could have found this work available, more easily accessible. But thank you again, and thanks to our presenters.
Thank you, John.
Of NABE, who unfortunately, due to COVID restrictions, can't be with us, but he will be joining us virtually this afternoon for the presidential address. I am still Dave Altig, Director of Research at the Atlanta Fed and the current Vice President of this wonderful organization. And it's my great pleasure to, at long last, invite everyone back to the first in-person conference, hybrid as it is, since I think we were basically across the river back in February 2020, right before it hit the fan. So we really appreciate everyone who showed up here in person. I know everyone had to get back their muscle memory on travel a little bit, how you navigate TSA, find the right Amtrak train, put on pants, all the things that have sort of atrophied over this time. And thanks for making the effort. And I also do want to thank everyone who's joining us virtually at this hybrid event. This works because we have a wonderful planning committee chaired this year by Julie Dawan, Mike Drury, and Neela Richardson. If you will stand, if all the members of the planning committee will stand, and if all the chairs of the economic roundtables will stand. A great job. But of course, that job is made possible, not just easier, possible by the fantastic staff of NABE. Everybody who's ever done anything with NABE knows that it works because of the NABE staff, the best damn band in the land. So Chris, Colette, Michelle, Melissa, Suzanne, Tara, and Tom, I'll stand up and let yourself be noticed. And on behalf of the NABE board, I do want to thank our conference partners who've stepped up to support this first ever hybrid conference. The Peter G. Peterson Foundation, KPMG, McKinsey Global Institute, Morning Consult, Haber Analytics, Woods and Pool Economics, the Census Bureau, FedEx, Remy, Morgan Stanley, Amazon, IHS Markit, Refinitiv, and Abbott, who gave us probably the most useful tchotchke you will ever receive in our welcome bags. So right now, we're going to do a little business. So I'm going to yield the podium to Levon. Where are you? Yeah, Levon Henry, who is going to say a few words about the NABE Foundation.
Thank you very much, Dave. Really appreciate it. And also, I would like a longtime contributor, John Godfrey, Mr. John Godfrey, to join me here on the stage. And while John is coming here, what I'd like to do is to say, my name is Dr. Levon Henry. I'm chair of the NABE Foundation and a longtime member of our NABE family. And what I'd also like to do is say thank you to all the NABE scholars, the diversity scholars, and all others who are attending today. And I'd ask you to stand because you are our organization and our industry's future. Please stand. Thank you. Okay. Thank you each and all. You know, it's one thing to get up here and ask for their hard-earned dollars, but it's a better way to do it is to talk to the people who actually benefit from them. And there we have Sonny Rod over here from CBE, Truist Financial Corporation. He said becoming a part of the NABE diversity program is an amazing way to catapult his career. Thank you, Sonny. We also have Edgar Reyes. I'm not sure where Edgar is sitting. Right over there. Thank you, Edgar. From the University of Texas at Arlington. He says being a diversity scholar provides a great opportunity for me to have a front row seat at these all important discussions. Well, thank you so much, Edgar. And sometimes seeing them and letting them tell their words themselves is even more important. And there, I would like to share a brief video with you from Sophia Abderrizak. Sophia, if you wouldn't mind. Thank you. Chris, okay, there's.
Hi, my name is Sophia Abderrizak, and I'm an economist at the Bureau of Labor Statistics. I want to thank the NABE Foundation for giving me the opportunity to be selected as one of the 2021 Diversity Scholars. This opportunity has awarded me the chance to attend a number of conferences this year and has allowed me to hear from a wide network of leaders in the economic, business, and academia sectors. Attending these conferences, especially during a pandemic, enabled me to hear directly from experts about the impacts of policies that affect several industries, as well as hear discussions on where the global, financial, and economic sectors could be headed. I'm grateful to have access to a brilliant network of people that are able to come together and have insightful conversations. This scholarship has opened the doors for me to be a part of the NABE community and to share my experiences and encourage other young students and professionals to learn more about NABE. Again, thank you so much for this incredible honor.
And also, please allow me to thank you, Sophia. We truly appreciate your presence here today. Now, I want to communicate that your donations to the NABE Foundation made what you just saw possible. From the very start of this pandemic, the foundation has found ways to expand its efforts, from creating the Diversity Scholars Program to working with AEA Summer Program in their inaugural year here at Howard University, to launching our first endowed scholarship program for the CBE. It's these efforts that are, in addition to continued support of CBE scholarships, conference scholarships, and the all-important economic measurement seminar. But my friends, times have been hard. You know that. A lot of people out of work, people not attend conferences in person. So the need for continued funding, for up funding, is always there. The foundation expanded its efforts during the pandemic, and it has had the opposite effect on our fundraising. It's gone down, but we expect it soon to go back. To be blunt, we need to pull up our efforts. And one of our longtime NABE members and contributors has taken it upon himself today to announce just that effort. John?
Thank you. NABE meant a great deal to me when I first joined it back in the late 70s. Some of you weren't born then, but that's when we were getting started. And because of that, when the NABE Foundation started, I was on the board, and one of the things I said is, you'll never be able to have a foundation if you just try to raise money at the luncheon. If you're going to do serious work in the world, you have to raise serious money. I had nothing to do with printing this little brochure up, but my wife Flavel and I are delighted today to be able to make a pledge of $10,000 for the NABE Foundation.
Thank you so much, John. Thank you so much. It's these type of donations that when we receive them, takes us so much further down the road to educating the next generation. Thank you again so much, John. And we also need everyone else's help out there and on the videos. And how can you help? Well, a lot of you are wearing purple ribbons. We know that means you've already donated, but everyone can donate more. And how to do it? You'll see this card in your seat. If you could fill it out exactly how John filled it out with $10,000, that's all we're accepting. But anything you can offer, okay? And turn it in, drop it at the registration desk. That would be most appreciated. And also, being the age of technology, go online with the NABE app, the Connect app, and the link will be at the top of your newsfeed, okay? We ask for your support because it is well used and much needed. And we look forward to having you at all of our upcoming conferences, also supporting us there and beyond. Thank you very much.
Now I want to call up Charlie Steindl to join me to announce our Business Economics Awards winners. Charlie?
Okay, thank you, Dave. Every year in business economics, we have two sets of awards which we present at the annual meeting. One set is the Adolph Abramson Award and Scroll, which goes to the, as judged by the editors of Business Economics, not by myself, by the editorial board, the two best articles that were published over since last July. And this year's winners, the first one I think illustrate, they're very timely and illustrate some of the strengths of what we do. The first one is by somebody I think is familiar to all of you, Ray Fair of Yale University, who I have to admit, some people do run economic models here, or economic modelers. Ray Fair's probably been doing his as long as all of you had it together, been doing it for quite a while. And of course is known for his forecasts on popular votes in presidential elections. Ray sent in an article last May, incredibly timely, what do price equations say about future inflation? And so that was published in the July issue this year. The Abramson Scroll winner was also timely. Last October, you may remember, we had a special issue which consisted of contributions by NABE members about how they were dealing with the effects of the pandemic. I have to thank Diane, who did the lion's share of getting people in to do this. And the winner of the Abramson Scroll was Carolyn Evans of Intel, the coronavirus and the technology sector. Neither Ray nor Carolyn are here to accept their awards, unfortunately. The Edmund Mennis, the other sets of awards are from a contest we run, a competition we run every spring, where we ask people to submit proposals for papers for business economics. There's a panel I select, which goes through the proposals, solicits the papers, and decides on two awards in them. The Edmund and Mennis Contributed Paper Award and the NABE Contributed Paper Award. And these papers will be presented later today at a session. I hope many of you will attend. And they both are on timely topics. The Edmund A. Mennis Contributed Paper Award is by Molly Bosso, Shu Chen, and Frank Nothat, all of CoreLogic. And since it's from CoreLogic, you can guess what it's about. Housing preferences during the pandemic, effect on home price, rent, and inflation measurement. The NABE Contributed Paper Award is also very timely. It's by Azar Iqbal and Sam Bullard. By the way, Levon was just up here. He won this award a few years ago. He was a winner. Was Azar Iqbal and Sam Bullard of Wells Fargo, estimating the economic cost of the COVID-19 pandemic. And I believe the Mennis winners are here. We can make presentations to their plaques, so they would come up. That would be, I think, Molly and Frank, Shu, all three here. Okay, all three of you.
One more, Chris. Am I supposed to be photobombing this?
Azar and Sam, I think you're here. Are they? Oh, there they are.
All right, now I get to give out a few awards. To the NABE Fellows. NABE Fellows are individuals recognized by the association for their outstanding performance as a professional business economist, contributions to the field, and service to NABE. Candidates for fellows are identified and proposed by NABE's nominating committee, and they require confirmation by the NABE Board of Directors. So for all of you about to get rewards, please come on up and join me when you hear your name. I'm presuming it won't be a surprise. Our first NABE fellow is also today's lunch speaker, Lael Brainerd. Lael is obviously going to get a better introduction than I'm going to give a little bit later on from Elaine. But everyone knows that she's a member of the Board of Governors and former Undersecretary of the Treasury Department. Lael's been deeply engaged with NABE and has been an active participant in annual bilateral exchanges between the NABE board and the Federal Reserve Board of Governors. Lael has dedicated her career to public service and is universally respected by economists and policymakers alike. Hand award, take picture. Charlie Evans. Charlie and I actually began our careers in the Federal Reserve almost exactly at the same time. And we both met each other early on in our careers. I think the lore is it was at some macro system conference in St. Louis. And our careers have sort of kind of moved together through about 30 years, I guess. Now, one of us rose to the heights of the institution and has become an extraordinary influential member of the community of monetary policymakers. The other one is me. So Charlie's been a frequent speaker at NABE events. He keynoted the very first international symposium at the Bundesbank and the more recent international symposium in Stockholm. Charlie hosted the 2014 NABE annual meeting attendees and was supposed to do it again in 2020 before COVID hits. We're going back to Chicago in 2022, so there's always that. Charlie's always been an enthusiastic supporter of NABE and has encouraged his staff, importantly, to engage intensely with the NABE activity. So thank you, Charlie. This is the point at which everyone wishes they were getting their picture taken with Manuel instead of me. John Gottfried again. Oh, there we go. John has been a member and leader of NABE for more than 4 decades. He was elected to the NABE board in 1982-85 and was a director of the NABE Foundation from 2014 to 2017 and is much appreciated by the NABE Foundation today. John was a research officer and senior financial economist at the Federal Reserve Bank of Atlanta, before he shifted to the private sector as Senior Vice President and Chief Economist at Barnett Bank of Florida in Jacksonville. He then formed the Florida Economic Associations. John helped organize the Atlanta Economics Club, which I can tell you is still going on strong, and was president of the Economic Roundtable of Jacksonville and a member of the inaugural class of certified business economists. Thank you, John. What? Frank knows how. CBE. Frank is a senior vice president and chief economist at CoreLogic and was formerly chief economist of Freddie Mac and economist at the Federal Reserve Board of Governors. Frank served on the NABE board from 2015 to 2018 and has co-chaired 2 policy conferences and 2 annual meetings. Frank's a big supporter of NABE, both at CoreLogic and at Freddie Mac, and encourage his teams, once again, kind of a theme, to be active in leadership in the organization. Frank was also in the first class of CBEs as well, and was a 2018 winner of the NABE Outlook Award, and he's just spending his career collecting NABE awards, I guess. So. Thanks, Frank. Chris Swan. Chris, there he is. Oh. Chris is well-known as an enthusiastic NABE member. He has always been passionate about getting young people involved in the association. He served on the NABE board from 2005 to 2008 and was the driving force behind the Get Connected initiative, an effort to expand NABE's networking opportunities and outreach to young persons, both in person events and social media. He helped with the development of the CBE, also in the first class as well of that group, and is a longtime member of the editorial board of Business Economics. Chris began his career at Bell Atlantic before joining WEFA, then the Bureau of Economic Analysis, and is now an instructor at Temple. Thanks, Chris. And last but not least, Manuel Balmaceda, who is not here, as you know, but I have the honor of serving with him as an officer of NABE this year. Everyone knows, I think, Manuel is the chief economist for CEMEX and was previously the chief economist for Spain and Europe at BBVA. He earned his PhD from Northwestern. Manuel has a long affiliation with NABE, serving as a board member from 2014 to 17 and now from 2019 to 23. Importantly, Manuel has been instrumental in expanding NABE's activities on the international stage and into Europe. We will have lots of time to blow kisses to Manuel later on today, and look forward to doing that. So with that, that concludes the awards for this particular meeting. And now I'm going to yield the stage for the main event. Please join me in welcoming GM Chief Economist and incoming NABE Director, Elaine Buckford.
Good afternoon. It's my great pleasure to welcome to the stage Federal Reserve Board Governor Lael Brainerd. And Dr. Brainerd took office as a member of the Board of Governors of the Federal Reserve System on June 16th of 2014. Prior to her appointment to the board, she served as Undersecretary of the U.S. Department of Treasury for International Affairs. She was also an associate professor of applied economics at the MIT Sloan School, and I've had the privilege of knowing her since those days. And she received both an MS and a PhD in economics from Harvard University as a National Science Foundation scholar. Please welcome Governor Brainerd.
Well, first of all, thank you for the kind introduction, Elaine. It is a great honor to join the exalted community of NABE fellows. And I want to thank the board of directors, Dave Altig, Connie, and Manuel in particular. And it's always nice to see Levon Henry. Given the unprecedented nature of the pandemic shock, it should come as no surprise that the recovery is not proceeding in a straight line. The economy continues to make welcome progress, but the Delta variant has been more disrupted than I think most people expected. The headwinds from Delta are a reminder that the virus continues to pose downside risks. Delta has disrupted both the demand and supply sides. Many forecasters have downgraded consumer spending in the second half of the year. Delta's limited the acceleration that had been expected in services, which had been expected to help offset the drag on activity from the shift in fiscal support from being a tailwind to being a headwind. Although the retail sales print for August was stronger than expected, the level of spending in August wasn't much changed from June. And high frequency data indicate that consumption of discretionary services, restaurants, travel stalled or may even have moved lower in some categories. And those trends don't seem to be very sensitive to regional variations in vaccination rates or COVID cases. Delta has also prolonged supply bottlenecks. Single family home construction permits declined again in August, despite very high demand because of materials constraints. Auto production was again paused at a number of North American plants in early September following COVID-induced shutdowns of semiconductor plants in places like Malaysia and Vietnam. And industry contacts continue to highlight the unusually low elasticity of global shipping chains, such that a COVID-induced port closure in China can ripple through and magnify backlogs. In recent months, private sector forecasters have revised down growth projections for the year by over 1 percentage point. But even with that downgrade from Delta, I expect that growth this year and next will be sufficient such that by the end of next year, average annual growth since the onset of the pandemic should exceed pre-pandemic trend growth. And Delta has finally also slowed progress on employment. Payroll gains in leisure and hospitality unexpectedly fell to 0 in August, following an average monthly pace of 375,000 in the preceding 3 months. Delta-induced spending declines for travel, recreation, and other discretionary services that I mentioned earlier likely reduced the intensity with which employers searched for workers. And in fact, we see that the number of households in the current population survey saying that they were unable to work because their employer closed or lost business due to COVID ticked up again in August after it had been falling significantly through July. As of the end of August, payroll employment remains over 5 million below pre-COVID levels and about 8.5 million below where it would have been in the absence of COVID. Roughly 1/3 of that gap is concentrated in the frontline leisure and hospitality sector. And while the headline unemployment rate declined to 5.2% in August, the unemployment rate adjusted for COVID-related non-participation remains elevated at 7.5%. And the employment to population ratio, the EPOP ratio for prime age workers remains about 2.5 percentage points below its pre-COVID level. So the labor market is making progress, but at a slower pace than we had hoped earlier in the year. Relative to December, payrolls have closed nearly 50% of their gap to pre-COVID levels, and the prime age EPOP ratio has closed around 40% of its gap. In contrast, labor force participation has shown little progress. Some observers argue that labor force participation has moved permanently lower so that the labor market is already tight. But the decline in participation appears to reflect COVID-related constraints that have been prolonged by Delta rather than a permanent structural change in the economy. So if you look, for instance, at the number of respondents to the Census Household Pulse Survey indicating they weren't working due to either being sick with COVID or taking care of somebody who was sick with COVID, That more than doubled just between late July and early September. While I'm hopeful for further improvements in the September employment report with a return to in-person education, even here, the effects of Delta have made themselves felt. Last week, there were just over 2,000 school closures for COVID across nearly 470 school districts and 39 states. While the disruptions last just about 6 days on average, nonetheless, the prospect of further unpredictable disruptions may well be delaying some parents' return to work plans. And of course, COVID has reduced the availability of daycare, preschool, and after-school care, further complicating that return to work decision. With record high job openings and an unemployment rate, a headline unemployment rate just above 5%, that headline vacancy to unemployed ratio has risen above 1 vacancy per job seeker and is now at pre-pandemic levels. Some people point to this ratio as indicating we're close to full employment, but that headline ratio may not be as informative when there are substantial lags in participation. It's instructive to think about that period in 2017 to 2019, when the vacancy to unemployment ratio was very similar to where it is today. It was very stable throughout that period. And during that time, prime age unemployment declined by less than 0.5 percentage point. But underneath those numbers, we saw a 2 million increase in the prime age labor force, which raised the prime age EPOP ratio 1.5 percentage points. So as I think about what to take away for today, lagging participation is likely to be particularly important currently due to COVID constraints, such as fears of contracting the virus and caregiving responsibilities. These constraints have been prolonged by Delta, but they're not permanent and they're not structural. Therefore, it's more informative to rely on a ratio of job openings to job seekers that adjusts the unemployment rate for pandemic-related non-participation. The pandemic adjusted ratio of job openings to job seekers was only about 0.85 in July. That's nearly 1/3 below that headline number, and it's quite similar to what we saw back in 2014. So that assertion that labor force participation has moved permanently lower as a result of a downturn, that's not new. In fact, it's a regular feature of the early stages of recoveries. But research demonstrates that the labor force participation rate cycle lags that of the unemployment rate by some years. So it's important to consider indicators beyond that headline unemployment rate when assessing progress toward maximum employment, as participation gains may come quite late for some groups in particular. So for all these reasons, I see no reason employment shouldn't reach levels as strong or stronger than we saw before the pandemic. So let me turn next to price stability. Inflation is currently elevated. This is creating challenges for consumers and for businesses. But the high inflation readings from the spring and early summer were disproportionately driven by a few sectors experiencing specific identifiable supply bottlenecks. In May and June, new and used vehicle prices accounted for half of the outsized monthly increases in core CPI. Those categories became lesser contributors in July, and in the August CPI, their joint contribution declined to essentially zero. I'm closely monitoring incoming data for any indications that the breadth of inflation pressures might be rising. 24-month core PCE inflation expressed as an annual rate provides one approach to smoothing through some of those individual disruptions associated with COVID. If you look at that, it's estimated about 2.5% in August. The Dallas trim mean, another approach, provides an indicator that came in at 2.0% in July. So the currently elevated level of inflation appears to be driven by COVID-related disruptions. As those COVID-related disruptions subside, most forecasters expect inflation to move back down towards our 2% long-run objective on its own. That's the sense in which currently high inflation is likely to be transitory. In that regard, the August monthly CPI reading was the first month with a notable retrenchment among COVID-sensitive categories like hotels and used and rental cars. So I do expect inflation to decelerate and pre-COVID inflation dynamics to return when COVID disruptions dissipate. But with Delta disrupting the rotation from goods to services and prolonging supply bottlenecks, it's very uncertain just how fast inflation will decelerate over the remainder of this year and into next year. So I'm monitoring carefully a few upside risks. First, while rent and owner's equivalent rent both rose at a fairly moderate 0.3% in August, if housing services inflation moved up substantially more than expected, of course, that could provide durable upward pressure on inflation. Secondly, there's a risk that goods prices may not decelerate and return to their pre-COVID trends, as is widely expected. And third, of course, I think we're all watching for any signs that wage gains are feeding into higher inflation more broadly. But the evidence so far suggests that wage gains are broadly in line with productivity and that the labor share of income remains relatively low. Finally, I'm vigilant for any signs that the current high level of inflation might push longer-term inflation expectations above levels consistent with the 2% target. Market-based measures of inflation compensation, such as the TIPS five-year forward measure, suggest those inflations are in fact well anchored. But survey-based measures also suggest that longer run inflation expectations remain well anchored. Recent analysis of the survey of consumer expectations concludes that in August 2021, consumers' 5-year ahead inflation expectations were as well anchored as they were 2 years ago before the start of the pandemic. And of course, the longer run measure in the Michigan surveys and the Federal Reserve Board staff's common index of inflation expectations similarly. So what do these developments imply for the path ahead? Well, one clear lesson is we need to be humble about our ability to correctly anticipate future economic conditions, given the unpredictability of the virus. While inflation has been well above target for the past 6 months, affecting both consumers and businesses, it previously spent a quarter century below 2%. There are good reasons to expect that because underlying structural factors like a relatively flat Phillips curve, low equilibrium interest rates, and persistently low underlying inflation are unlikely to have changed, that we'll see a return to pre-COVID inflation dynamics. And it's always important to remember that while the playbook for guiding inflation back down to 2% following a period of moderate overshooting is well known and has proven effective, experience suggests it's very difficult to guide inflation up to target from below. In addition, we had expected a smooth rotation from goods spending to services spending during a complete reopening in the fall, but of course that too has been slowed. Partly as a result, employment gains flatlined in August in the critically important leisure and hospitality sector, where most of those losses are concentrated. And as a result of Delta, the September labor report may be weaker and less informative of underlying economic momentum than I had hoped. So employment is still a bit short of the mark on what I consider to be substantial further progress, but if progress continues as I hope, it may soon meet that mark. Once COVID constraints recede, I see no reason the labor market shouldn't be as strong or stronger than it was pre-pandemic. And I would emphasize that no signal about the timing of liftoff can be taken from any decision that may come on announcing a slowing of asset purchases. The forward guidance on maximum employment and average inflation sets a much higher bar for the liftoff of the policy rate than for slowing the pace of asset purchases. In implementing policy step by step, we have to remain faithful to the new framework and attentive to changing conditions in order to ensure there's sufficient momentum when those fiscal tailwinds shift to headwinds to sustainably achieve our goals. So with that, I'm going to wrap up and we can have a discussion. Thank you.
Well, thank you very much, Lael. And I think you hit on the two top topics on every macroeconomist's mind, what's happening in the labor market and inflation. But in addition to all the sources of goods inflation and broader inflation you talked about, The stock market and real estate prices have found new highs during the pandemic. And a number of commentators question whether equity prices have departed from fundamentals. Does the Fed consider asset price inflation in its decisions about normalizing monetary policy?
Yeah, so we have a pretty well-defined framework about what we look at in inflation. I think it's well understood what the sets of indicators that we are targeting in our monetary policy framework. Outside of our monetary policy framework, we have a parallel process that monitors for signs of financial imbalances that might be growing over time. And in that work, which we review every quarter and which we share publicly every 6 months or so, we do look very carefully at asset valuations, and we look for signs that risk appetite may be stretched. And of course, we look for other channels which, combined with those stretched asset valuations, might lead to vulnerabilities. And those reports have been showing that, in fact, asset valuations across a range of different asset classes are in fact stretched. And you need only look at things like the meme stocks episodes or Archegos to see that, in fact, there's loads of signs that risk appetite has been somewhat elevated. That said, the framework makes clear that we have other tools that are the first lines of defense. They're macroprudential tools, they're prudential tools. In circumstances where those asset price valuations may be looking stretched in combination with some other vulnerabilities, that's a good environment to think about turning on the counter-cyclical capital buffer, which I tend to favor. But monetary policy really is not seen as an effective tool in that regard. And that's why it's so important that we are really active in using our macroprudential and prudential tools.
Thank you. Central bank digital currencies are a big topic. China and Sweden are actively moving towards developing theirs. The EU or the ECB is formally exploring the merits of a digital euro. Can you tell us where the Federal Reserve stands in terms of considering a digital US dollar and what your thoughts are on a digital dollar?
Yeah, so it's a really big topic, and it's become much more kind of salient in recent months, in part because, as we saw during the pandemic, there was a continued acceleration of the move to contactless digital payments. So that becomes more and more the path of the future is fully digital payments. It's also the case that in the pandemic, we saw how important it was to be able to get payments to households. And it turned out that the nearly 6% of American households that don't have bank accounts, it was hard to get those payments to them. And so that's a second motivating kind of consideration that I think has been more pronounced during the pandemic. But perhaps the most important recent development has been the proliferation of digital assets, cryptocurrencies that are called stablecoins, which are intended to reference some kind of traditional asset class, in some cases fiat currency. And I think they bring, if they are widely adopted, risks associated with fragmentation of the payment system, potentially associated with risks of runs, because they are not fully regulated in a systematic and uniform way. And so the importance of making sure that consumers continue to have direct access to a safe form of central bank currency has really risen on that radar screen. And then the final thing I would say is, as you mentioned, if other major jurisdictions are introducing CBDCs for purposes not only of domestic payments, but international payments, it's just very hard for me to imagine that the US, given the status of the dollar as a dominant currency in international payments, wouldn't come to the table in that circumstance with a similar kind of an offering.
So you already touched on stable coins. The Economist a week ago talked about that as part of a broader movement towards decentralized finance happening outside of the banking system. Can you tell us a little more about your thoughts on the merits and risks of that?
Yeah, so I think that the term covers a huge diversity of efforts that are underway, and some of them may in fact provide value and be very important innovations. But it also includes a number of activities that have no regulation around them, and where you're seeing much more engagement by not just retail investors, but also institutional investors, with some lack of clarity about what kinds of safeguards might back those. And so if you look at the area of cryptocurrencies or crypto assets generally, you've seen just explosive growth in that area, increased interest in terms of bringing those into the sort of core financial system. These are assets that don't have intrinsic value and that may be subject to risks that are different, like hacking, for instance, than traditional assets. So what I think is very important there is the regulatory framework has to catch up to that. And then within that broad class, of course, stablecoins get special attention because some of them have characteristics that really lend themselves to run-like behavior. In particular, the promise of instant one-for-one redemption backed by assets that are far less liquid in some cases and potentially much less certain than traditional money market funds even. And there is a set of additional concerns that if those become very prominent in payments, you could see some consumer risks as well as investor risks.
Another question that's at the top of everyone's mind is debt limit brinksmanship. And we in 2013, the last time it got so close. So can you tell us what tools the Fed would have to support the economy and financial markets in the unfortunate but real possibility that the debt ceiling is not raised before Treasury runs out of its extraordinary measures?
Yeah, so I think this is really not a Fed issue. This is really a question. Congress knows what it needs to do. It's done it before. It needs to step up. It has responsibilities. I think, the American people have had enough drama over the last 2 years. I think, it's really important to just move forward, get this resolved. And there are a lot of really important things we need to get done for the health of the economy.
Thank you. And okay, now I've just completely lost our fancy app, but I encourage those in the room to take the opportunity to ask Governor Brainerd questions. And we have one. It's going to be a very technical question. The Fed chair has mentioned base effects in measurements of consumer inflation, especially in comparing, that 2019 might be a better baseline than 2020. Do you still see base effects as a factor now that we've gotten out to August and September?
Yeah, so I think base effects, at least in our calculations, were very prominent in those first few spring months, where we were seeing prices that were coming off the year earlier, the most severe part of the pandemic. Now, of course, we don't know where some prices are likely to go. In some cases now, you've had prices you sort of have one-time increases, whether those come back down a little bit this time next year, whether that one-time price increase holds and the normal inflation process takes over from there. I think those are some of the things that they're not easy from where we sit to predict. But what does seem very important to me is just that where we have seen the large majority of those upside surprises has been in, really a handful of sectors where the constraints and price distortions are
very clearly and identifiably connected to disruptions associated with COVID. And so again, there's good reason to expect those to dissipate as COVID constraints themselves dissipate on their own. And that's the sense in which I'm thinking about the term transitory. Don't know exactly when those effects are going to recede, because we don't fully know when the pandemic is going to fully recede. But those seem to be driving those outsized increases.
How are you thinking about the potential growth rate post-pandemic, whatever that means and whatever it is? Do you see it having changed either upward or downward as a result of this disruption?
Yeah, so I think there too, I've seen a variety of different estimates. You know, it's possible that we will see some productivity acceleration associated with the some of the shifts that we've seen during the pandemic. Those were probably an acceleration of existing trends, but certainly, you know, remote work, telework is likely to be more widespread, I think, on an ongoing basis. A shift to contactless kind of approaches to certain businesses may be a long-lasting trend as well. And so perhaps we will see some productivity increases there. Don't know what's going to happen on some of the fiscal being debated, but infrastructure investments and changes that could lead to greater labor force supply over time, those too could also result in an improvement to productivity growth. But at this juncture, I think it's just a little too early to tell, because we still are seeing the effects of the Delta variant, and you know, it's still a little unclear where the pandemic is headed.
The Atlanta Fed put out a paper a couple of weeks ago about the impact of the pandemic on labor force participation of women, especially women with young children, and the link back to childcare, which you touched on earlier. What are your thoughts on how women's labor force participation in the long run may have been affected by the pandemic, and has it peaked, or where's it going?
Yeah, so, you know, there, I think we just see in survey evidence, we've seen in research, that those additional caregiving responsibilities really have disproportionately affected parents, disproportionately affected mothers, disproportionately affected mothers with young children, and in particular, minority mothers with young children. And so, you know, those seem to be, again, very tightly connected to COVID caregiving responsibilities. Certainly, there's now sort of broad-based return to in-person school, but even there, as I mentioned earlier, 2,000 closures over the course of a week. They may not last very long, but if you're thinking about going back and searching for a job, it may cause you to postpone a little bit longer, because you might be thinking, you know, my children may have to be virtual schooled again for a week or two here or there. And similarly, aftercare, childcare has been much more constrained as a result of COVID. So I don't expect those to be permanent changes, but they have been long lasting. And I believe they are having a material effect on labor force participation of parents.
So we have a question on tapering from the audience. And can you speak more to what risks in general you're looking at the housing sector, and how tapering might affect housing prices?
Yeah, so in general, there's been a real mismatch there between stronger demand that may have been supported by obviously very supportive financial conditions, but also more associated with fiscal support. People have been able to accumulate savings as they've engaged less in discretionary services and gotten more support. And they also may be looking for different kinds of housing as a result of the pandemic. So demand, very strong. Supply constraints also very strong. We've seen materials shortages, and they've been associated
clearly we saw it with lumber prices, but we've also seen it with certain metals prices. And so those have been constraining construction and purchases. Now, in terms of the connection to our policy framework, I think what we've seen is that accommodative monetary policy does have effects on affordability of housing, certainly is a boost to the housing sector, but it doesn't have differential impacts that are specific to the actual composition of our purchases. And so I wouldn't expect to see any differential impact as our policy path continues.
So let's come back to the labor market because we have some more questions about that. So you talked about prime age labor force participation. And then another issue that keeps coming up is to what extent labor force participation has persistently dropped for adults over 55, whether that's some combination of short-term issues with fears of COVID or early retirements. So tell us your thoughts about how you weigh labor force participation at different ages and thinking about the labor market.
Yeah, so as I was emphasizing earlier, I just think it's very early days to start concluding that there's been a structural shift in the desire and necessity for prime age Americans of participating in the labor force and working. I think Delta has been a really important prolongation of the constraints that we had been seeing earlier associated with the virus despite widespread vaccinations. And participation generally lags in severe recessions. We've seen that. We certainly saw that in the last cycle. There's no reason to expect it to be any different this time around. And it doesn't lag by weeks or months. It can lag by years. So, again, I'm a little bit confounded by stories that would suggest, we're in a very tight labor market akin to what we saw pre-COVID. And I would think that, as we look out across the likely evolution of the labor force supply, we'll probably see people coming back in only for some groups, only when the labor market really does have an extended recovery. In terms of early retirements, for some people, that may in fact be a slight acceleration by a year or two of plans that they were going to retire anyway. So those are likely to be permanent, but that wouldn't cause a permanent change in my views about labor force participation because those retirements are simply being pulled forward by a year or two.
Right. And so we have a follow-up question on central bank digital currency. And we have a question about what would either be the can you give some guidance on timeline for consideration or kinds of milestones that might happen along the way?
So we are currently engaged in developing a report that will be soon shared and intended really just to gather public input on this issue about a central bank digital currency in the US context. Now, a lot of our peer central banks have done similar things in their jurisdiction. And I think it's vital for us to solicit a broad range of views on what the possible benefits and risks associated with introducing a central bank digital dollar might look like. So that paper, I think, will be a very important milestone for us. Our colleagues at the Federal Reserve Bank of Boston are also engaged in very important research on the core processing technology for a central bank digital currency and looking at different questions associated with throughput, for instance, and they'll be able to share some of their early research before too long as well. So I think that is also in parallel a really important track so that we understand sort of what a digital currency would look like from an operational and technological perspective.
I know you've done a lot of thinking about the relationship between digital payments and financial inclusion. Can you share some of your thoughts about that?
Yeah, so one of the things that we are doing right now across the Federal Reserve System is working to build a new instant payments system that all banks would have access to, which would allow banks of all sizes and all parts of the country to provide to their customers instant payments. And instant payments tend to be really important for cash-constrained individuals, cash-constrained businesses. That ability to track cash flows in and out on a kind of instantaneous basis allows households that might have to prioritize which bills to pay when to have much better insights into and control over their household finances. So from a financial inclusion perspective, we think the digitalization of payments, real-time payments in particular, could make a material difference, as I noted earlier. For those, some households that are really balancing their cash flows the most carefully, they may be the ones who don't currently have bank accounts for a variety of reasons, and that it's hardest to reach in crisis moments. And so for all those reasons, I think as we think about real-time payments, digital payments, we really want to make sure that we do so in part through a financial inclusion lens.
Another question, has the size of the balance sheet as it's risen through repeated crises in any way limited the Fed's capacity for future downturns?
Yeah, so I think what we have learned and what other central banks around the world, advanced economy central banks, have learned is that in an environment where the neutral interest rate is low, there's simply less room in our conventional toolkit to cut the policy rate when there's a shock to the economy, particularly when there's a big shock to the economy. And so our toolkit has simply expanded so that when the policy rate is essentially coming to its effective lower bound, we transition much more smoothly to use of asset purchases as a supplemental kind of amount of policy space, which continues to provide accommodation by pushing out the yield curve. And so that's proven to be quite effective. It's also proven to be quite effective that we are able to see that balance sheet roll off or shrink when the economy gains momentum. And so I don't see any reason that we wouldn't see that same kind of process here in the US, given that, you know, under most expected forecasts, we should be seeing quite robust growth over the, you know, the next few years.
So you've been very involved with financial regulation. What are some things you'd like to see considered for additional financial regulation measures?
Well, I think the biggest areas that are kind of new are the whole crypto arena. We've already talked about that, but I think it's really important to have all of the regulators come together and really think hard about whether the current regulatory guardrails are adequate, whether they need to be moved in order to be able to better safeguard consumers and investors in this space. And stable coins, I think, you know, is front and center there. And so the President's Working Group is working on an important report in that regard. I think that is essential. Another new area is the area of climate-related financial risk. It's an area where a lot of our largest banks who are internationally active are already being supervised in other jurisdictions to make sure that they are measuring, monitoring, and managing climate-related financial risks. And it's an area where the US has been behind, and we need to catch up because, of course, we know that the nature of climate change is such that there could be important nonlinearities. It could pose significant risks, both in terms of sudden changes in asset prices, but also to the financial system more generally. So that's a second important area. And then, you know, the sort of bread and butter is to make sure that our core financial institutions are sufficiently well capitalized in managing their liquidity. And so in that regard, making sure the stress tests are really strong and don't get whittled down over time is important. Making sure that banks build counter-cyclical capital, I think, is important. So there's a pretty good, well-known agenda there.
Great, thank you. So a superb institutional question from the audience. Can you comment on the importance of Fed independence in the light of some political attacks previously and recent well, let's just leave it there.
Yeah, so of course, we have a very important accountable relationship to Congress and to the American public. So I think it's really important. The fundamental principle for the Federal Reserve is transparency and accountability to the American public in carrying out the various very important missions that Congress has entrusted to us. Within that, we are subject to a lot of oversight, very important oversight by Congress. We are audited, and we do have accountability. There is one narrow area where this is where people talk about independence, and that's really just in the judgments that are made about specifically how to deliver on Congress's price stability and maximum employment objectives. It's a very narrow area, and I think it's well understood why that one narrow area really the financial system and the economy, working Americans in particular, benefit from the Federal Reserve being able to carry out its narrow monetary policy responsibilities with the ability to interpret the data as best we can to deliver on that both price stability and maximum employment.
Well, I want to thank you for joining us today, for your remarks on the top issues on the mind of every macroeconomist, and then taking so many questions from this audience. Let's all please give Governor Brainerd a hand. Thank you.
The next sessions will be starting momentarily outside. Everyone will need to clear this room. So please take your laptops with you. As a reminder, we'll also have a 9/11 tribute video in salons 1 and 2 during the next break.
September 11th, 2001. It was a day of horror, chaos, and ultimate terror that still lives on in the memories of many. September 11th, 2006. 5 years after the infamous terrorist attacks on our nation, most of America is back to normal. New York City remains a vivacious city that truly never sleeps. Naturally, though, the country has become more cautious and careful, taking extra measures to ensure national security. On 9/11, New York City lost its famous emblems, the Twin Towers. As the 5-year anniversary of the attacks appears over the horizon, one can see that the heart of New York is still broken. NABE of the September 11th, 2006. 5 years after the infamous terrorist attacks on our nation, most of America is back to normal. New York City remains a vivacious city that truly never sleeps. Naturally, though, the country has become more cautious and careful, taking extra measures to ensure national security. On 9/11, New York City lost its famous emblems, the Twin Towers. As the 5-year anniversary of the attacks appears over the horizon, one can see that the heart of New York is still broken. NABE and ABER meet annually. In 2001, the World Trade Center was the choice spot for their upcoming conference.
Being there because in 1998 I chose the World Trade Center on my ascent to the presidency of NABE as our location for that particular meeting.
Diane Swank and Carl Tannenbaum were at our table, and there were several students who were new members of NABE.
I was a student member of NABE at the time, and we were meeting with the past presidents.
First thing I noticed, the lights blinked. I looked up and I could see the chandeliers waving back and forth.
NABE members were feeling the effects of the first plane crashing into the North Tower. However, they assumed it was something else.
When the plane hit, we were in an enclosed space, so all we did was feel what happened, didn't know what had happened.
All of a sudden the lights went off and it came back, and right in that moment I thought it was just, you know, a blackout, something temporary.
I was standing there, all of a sudden I just felt the building shake. And I'm like, instead of earthquake, it's like, you know, there was like stuff falling, but the first thing I thought of was it had to have been an earthquake.
I thought at the time might have been a subway crash or something like that, this vibration.
One NABE member, Chris Varvaris, had not yet made it to the breakfast. He too felt the effects of the first plane from his hotel bedroom at the World Trade Center Marriott.
Sat on the bed and turned on CNBC or Bloomberg to see what was going on in the pre-market activity, and I heard this, you know, boom. It was like almost like I thought of thunder actually, because there had been a thunderstorm the night before. Although, you know, almost immediately I remembered I'd already looked outside the window and it was a clear blue day.
As debris began to fall outside the building and alarms rang within, it became clear that this was much more.
Commentators were speculating that it was a small private plane that had run into the tower.
And then the building began to tremble and people said it's a bomb, it's a car bomb, because many people remember the previous experience in '93.
A fire alarm went off and then someone said, "Get out of the building."
Outside, people were rushing in various directions to flee from the World Trade Center. However, NABE members faced complications in escaping.
The problem was because people were already falling and glass had imploded in the front atrium of the hotel, which was connected to the World Trade Center, that we couldn't leave quickly.
I had gone behind the World Financial Center and there met a bunch of NABE people back there. When they told us to move, the police came along and told everybody to move and go either north or south. There were people laying in the street. There were cars that were sort of in a jumble, so to speak, in front of the hotel.
Seeing all of the emergency medical entry teams and the firemen going into the area right next to the towers.
Groups of NABE members soon pushed their way through the crowds and were able to begin their routes from the World Trade Center.
When we got out of the building, we discovered what that a plane had hit the first tower, but at that point thought it was an accident. As we walked away from the building, a group of us walked south towards Battery Park.
And you're telling me the foreign students that we had and some of the foreigners that we had with us to towards the lady, which was the Statue of Liberty, because I thought it would be safer to be in a place where there weren't tall buildings.
To some, the worst seemed over, but it was hardly from it.
I saw this airplane coming from, I spotted around above the Statue of Liberty and coming in and coming down, and my thoughts was that it was probably doing some form of reconnaissance over lower Manhattan to see what was coming in. And when it got closer, I thought, well, maybe it's not a great idea to have a jetliner to do reconnaissance over a populated area.
And I noticed some people across the street who were looking up to my right and pointing up,
and then it kept coming down, and at one point you had to realize, it's really a matter of seconds, but you had to realize in those moments that it's not going to move up.
I happened to look up just as the other plane came in and crashed into the World Trade Center. I saw the plane, I saw it crash through in the ball of flame, and it was at that moment I realized that what had happened before wasn't an accident, but obviously an act of war or terror. And of course the whole mood and mentality changed.
The second plane made it clear that this was no mistake. These were acts of terrorism. Soon news would reach the members of other attacks on the country.
A couple of people had radios and had heard that there was another plane, several planes in the air. We heard about the Pentagon and heard there was at least one additional one. Well, obviously it became a lot more frightening at that point than it had been initially.
Those with loved ones in New York became concerned and wanted to find out if they were all right. Bruce Cradaville was uneasy about his wife and daughter that had accompanied him to New York.
They had lingered in the hotel room, were still there, but ran down 18 flights of stairs, happened to go out the same door I did, saw people with name badges, followed the trail, and we found each other within about 5 minutes.
Bruce and his family soon boarded the first ferry they could, headed for Staten Island.
Most unusual thing was that probably for the first time ever, as people got on the Staten Island ferry, they reached underneath, took out the moldy old life jackets and strapped themselves in.
Also, Stuart Hoffman was not with his wife Jody that morning and worried if she had been able to escape.
She ended up in Battery Park where she found her, as we call him, her guardian angel, Dave Weiss, who's one of our NABE members, and she happened to recognize him. And Dave lives in Manhattan, and she clung to Dave like Velcro. And they walked, I guess, the 4 hours up the east side in throngs of people to his apartment, where by about 1:15 she arrived and called our niece's apartment, where I was at by then, and told me she was okay and where she was.
As people headed away from the buildings, emergency vehicles headed towards them. Firemen and police alike were going in as rescue teams for those still trapped inside.
So probably 24 or more firemen were coming through, and you could see, they were absolutely silent. They weren't saying anything, and you could see that there was fear.
Impending danger awaited the unfortunate rescuers.
Stepping out from behind the building on the World Financial Center campus onto Vesey Street when I heard what I thought was another jet engine. I mean, it's just the sound it made, as if you're standing on the tarmac and you hear that engine revving up.
My instant reaction was, oh no, a third plane had hit, a typical terrorist type activity. Wait for a crowd to gather and attack them again.
What I realized was that was the South Tower collapsing, and it was making that sound. It was pushing that much air.
The fire from the jet fuel had melted the structural steel beams, and the South Tower collapsed under its own weight, destroying the Marriott Hotel as it fell. Minutes later, the North Tower suffered the same fate.
I hope I live. I hope I live. It's coming down on me. Here it comes. I'm getting behind a car.
After these events, dust, debris, and wreckage lay over the decimated area. After only a few hours, what had once been the World Trade Centers was now an empty void.
And shortly thereafter, the second tower collapsing, knowing at that point instantly that they had collapsed all of those people who were down there.
I think for me, everything was like in slow motion. Was that for you? It was
Oh,
like
and it was very
like
quiet.
Yeah.
There was no noise.
It was very quiet because when I got outside, it was very quiet. Almost like, you know, you watch those movies and it's the end of the world. All you see is like the smoke in the air and there was nobody around.
However, other parts of New York were still bustling, having not yet recognized or known what had happened.
Walking into Midtown around Times Square, a group of us were pretty much covered in, our clothes were covered in dust. Some of us still had dust in our hair. And yet, when we walked into Times Square, people were milling about as if it were a normal day. They were heading off to have lunch because it was about noontime that we arrived, and the feeling was of being from a different world, walking almost like we were invisible because people didn't.
That evening of the attacks, NABE members graciously accepted hotel rooms or hospitality from friends and family.
Unfortunately, through my bank PNC, I was actually able to get a room at the Waldorf because we had no place to stay. And my niece's apartment, being a typical New York apartment, had enough room for one person, let alone about 6 of us.
I finally went back to one of the hotels at 79th and Amsterdam and sat down in their lobby. About an hour later, because my feet were killing me, an hour later, a manager came over and asked whether I'd been with them the previous night. And I said, no, I've been down at the World Trade Center Marriott, and my bags were still there in the rubble. Oh, at that point, they had a room for me, in spite of having been told twice that they didn't.
I have a goddaughter who lives in New Jersey, and the plan always was to try and find some way across the river to take the train out to hole up with her and her family, who we've known for years. You remember that Manhattan is an island, though. You don't really realize that until you're trying to get off of the island. We finally made our way out there, and the wife of the family, who we've known for many years and spent many New Years with, I had never seen her take a drink. And when we walked in the door of their home, covered with the dust and detritus from the tragedy, she went straight for the liquor cabinet.
All of my friends and colleagues who were with us at the conference were able to safely get home eventually. Some of them by very circuitous routes, but they all did safely get home.
Indeed, all members were extremely fortunate for this. And after 5 years, they still believe that.
You know, you wake up every morning, you take a breath, and you're thankful for it.
We count ourselves lucky and blessed to be able to talk about it.
However, images on the news of the attacks were a constant reminder that the world had changed.
It was tough. I was living in Washington, D.C. There was a psychosis about terrorism. We had the sniper in Northern Virginia that was adding the anthrax scare. So it was a tough 6 months to 1 year to live in Washington, D.C.
But not just the world is different. Many members' lives have become altered as well due to the attacks.
I made my peace with God. I wear my crucifix everywhere I travel. Sometimes slows me getting through security.
I think I've gotten much closer to my family. And of course, I think I'm a lot more jumpy about things.
I must admit there were a couple of times when I had momentary concerns about hearing planes flying low.
It was difficult at first. You know, I always kept myself, well, I didn't have a cell phone then. I bought one, a flashlight and a radio, and kept them by me for at least 2 years after the incident. I don't carry all those things right now, but loud noises, planes flying overhead, something that made you stop and think what's going on.
Since the attacks on September 11th, several members have found their paths crossing with New York City again.
I went with friends a couple of times, just doing bus tours. It was actually about 2-3 years later that it felt more odd than it did the first few times because the experience seemed so totally unreal at that point.
I rewalk exactly the same path that we walked with the group at the time. After filtering and seeing those images on TV so many times, I lost a little bit the memory and the perspective of the actual distances. So when I went back to ground zero and I walked to Battery Park, all of a sudden I realized how close we were. Somewhat my memory had filtered and I would, just expecting the distances to be a little bit more. It was really a matter of 4 blocks, 5 blocks. It was right there.
It happened to be around the period where they had found quite a number of firemen recovered their bodies in the southeast corner of the pit. And while we were up there, we could see them taking out a couple of stretchers that were draped in flags.
Ground Zero is also a key area that NABE members have returned to since the attacks.
Most incredible thing was just the emptiness, just the void. There was nothing there. It used to be so, so vibrant, so energetic, so, full of life, and it was just dead.
And I found that going back to the site, which at that point, 5 weeks on, was still barren, was very hard, but in many ways cleansing. And that night I had my first good night's sleep.
And as for the rebuilding of the trade centers, or even a memorial, NABE members have mixed views.
I think there should be a memorial there, but by the same token, there should be commercial buildings should be rebuilt there.
The taller the better.
I think there will be some space for a memorial for the victim of the days, those who lost their life, and those, as many of us, who have their life changed in the experience.
This nation stands with the good people of New York City.
Think about it.
I cherish moments more. I cherish friendships more. I think in a strange way it's added a quality that I didn't have before.
I think it's important to keep the memories of that day alive because, again, sometimes going back to the routine helps, going back to your work really helps. It helps to move on, it helps to go back to normalcy in your life. At the very same time, there was something exceptional we lived through and we learned on those days. And I think it's very important never to forget what we have learned then.
first introduce our panel. I am Stuart Andreessen. I work at the Atlanta Fed. And I want to introduce our panelists today. We're going to talk a little bit about business career progression and job progression pathways, ways that companies have been looking at creating opportunity and making their work accessible. We're joined by a number of people today that have got some really unique perspectives on that, both with us here in person as well as on virtually. We've got Zoe Baird joining us from the Marco Foundation. She's CEO and president of the Marco Foundation, where she oversees all the actions of the foundation, but particularly today, work related to the Rework America Alliance, the Rework America Business Network, and Skillful, a number of their programs that they've started over the last several years. Michael Fors, who's the executive leader of workforce development for Boeing, Jesse Haynes, who's director of Grow with Google, and Nikhil Patel, who has been a close partner on the Rework America Alliance work, and a partner at McKinsey. We've got a lot of stuff to share and a lightning fast amount of time to do it. So we're just really going to jump right in. I'm going to start with Zoe, where I'm hoping, Zoe, that you can talk with us a little bit about changes that you've seen in the pandemic, coming out of the pandemic, ways that you've seen firms look to address creating job accessibility, creating career progressions, and how firms have been thinking about some of their practices as they come out of the pandemic to create economic opportunity.
Well, Stuart, thank you for having me with you, and I'm sorry it's virtual. I'm desperate to get together with you and everybody else. And everyone on this panel has been a wonderful partner in the Rework America Alliance, but you in particular in the Atlanta Fed have had an extraordinary degree of commitment. As we all have looked out over the last 18 months, we've seen not only mass unemployment from COVID, but also a real acceleration of the transition to a digital economy that had started before that. And both of these things have exposed structural inequities, creating a disproportionate impact on women and people of color, and in general have been disruptive for most people without a four-year college degree. So the challenge that we've been confronting and the challenge the nation confronts is how to get those workers back into the labor market in better jobs that lead to greater engagement in the digital economy. Because if people only come back into the jobs they left or ones like them, we're going to be missing a great opportunity to address the economic inequities that have developed in our economy over the last few decades. So at present, and actually as of today, around 4.2 million or 87% of unemployed workers are from low and middle wage roles. And of these, 27% are Black and 25% are Hispanic. So that really captures the challenge and the people that we need to serve through both government policy and actions by business executives. When COVID hit, we had already been working on a lot of these workforce challenges, but we really ramped them up with this extraordinary coalition of partners who stepped up, appreciating the crisis that people were facing. And the Alliance brings together employers, but also civil rights groups, tech companies, labor unions, educators. It's a really remarkable coalition. I mean, people who rarely have the opportunity to work together on a broad scale are working to try to develop marketplace respect for the experience people have, and to couple that with what is often modest training, often training that can be done on the job in order to get people to succeed. This is obviously important as employers are looking for workers who have the experience and skills that they need, but it's also really important to get people into better jobs. And employers over the last probably 12 years have been overlooking people who have this kind of experience and don't have the credentials. Employers have gone a very traditional route. If you look at your own organizations, people have increased the requirements for a bachelor's degree. And, you know, it's become a norm, for example, to require a bachelor's degree for an executive assistant, whereas 80% plus of executive assistants don't have a bachelor's degree. So in order to ramp up the kinds of skills employers want, employers have gone toward these traditional credentials. And in the work that we've been doing, in a very practical, operational way, looking at the experience of people who've moved from one kind of job to another, we're identifying people who've been overlooked. And, you know, 2/3 of workers in the US don't hold a college degree. This is not a minor tilt in the wrong direction in the workforce. So this is the heart of what we're trying to do. And I'd be happy in this conversation to get into this in any depth. We're also working with governors. At Marco, we have a bipartisan group of 30 governors who are committed to this work. So I'd be happy to get into it in any detail, but Nikhil, I know because McKinsey and the Atlanta Fed have been doing this deep work looking at job histories and occupations that are real springboards to change. And I know that they'll dig into that for you.
Thanks so much. I want to just encourage you all. I'm interested in trying out your questions that are going to come to me on this iPad, and we're planning on taking them. So I'm very interested in this hybrid version of an event. I look forward to giving your questions to all of our panelists. So I encourage you to add those as we get going. We're going to get to some of the analysis that Nikhil was just referenced on. I want to first turn to Michael. Boeing's got a long history of thinking about development being a learning corporation. As you guys have gone through and watched a lot of these changes come, as Zoe just talked about, what has been your response? How have you all been thinking about internal progression, skill development in the company?
Yeah, thank you. I just want to thank NABE and the Federal Reserve for having us here. And I appreciate all the hard work you do. It's a challenging job that you all have and role, but it's important. Just from a Boeing perspective, you know, I had originally worked at Intel Corporation and Microsoft, and you know, companies coming through crisis, CEO Andy Grove used to say, you know, bad companies would fail, good companies would barely survive, and great companies will come out stronger. And famous quote from Andy. And so what we're trying to do is come out stronger. And you know, we've had a history of strong, you know, skills development and tuition reimbursement, that kind of thing. But we're really focusing on certain levels now coming out. You know, revamping the culture of Boeing, really with an emphasis on diversity and seek, speak, and listen. Really having people be able to speak up more within the culture. Leaders and managers, revamping how leadership and management development is done, much more experiential around a set of 9 skills. And we're also working on our own CEO succession because we have a limited time with our current CEO. Then down at the enterprise level, really looking at digital transformation skills that reshape how the culture's done, how the work is accomplished. And then one layer down from that is really within the divisions and the business units, looking at workforce development. So what do they need from workforce capacity planning? What are the pivotal roles and skills and teams that need development? And then finally, at the external level with our customers, partners, and suppliers, and really looking out globally at our ecosystem. So we're working on all those levels, but just real quickly, one piece I wanted to emphasize was in this talent crunch, we're trying to develop certain roles and going after what Zoe said, which is COVID unemployed diverse individuals. And so we're seeing a need for a pipeline in certain technical skill areas that we just can't find. One of them being cybersecurity. And we need cyber not only for IT systems, but also for product cyber. You know, think of a rocket going to Mars with humans being hacked. That would not be good. So anyway, what we're doing is creating our own pipeline and creating an apprenticeship program for cyber folks, non-degree, COVID, diverse, unemployed, and putting them through a stackable credential, more a certificate program for content from a university, and then providing them hands-on training to be job ready with a startup that specializes on cyber. And so in that way, we're creating our own pipeline. The individuals can go through, can get some credit, maybe lead to a degree, but we give them an apprenticeship at Boeing. And so that's just one creative way we're trying to work in the current structure post-COVID to develop our own pipeline. We see that program being replicated for other roles that are critical within the company. So those are just a couple of the ideas, and I'll let others go and take questions.
Well, so kind of staying on that, Jesse, can you talk a little bit about what Google's done to create opportunity both for employees, but also other small businesses? Can you talk a little bit about that from your guys' perspective?
Yeah, sure. And thank you, Stuart, and panelists and NABE for having me here today. I run Grow with Google, which is really about creating economic opportunity for everyone. And kind of in the real world, that translates into helping small businesses get the skills they need to succeed so that they can use the web to grow, and working with job seekers to help them succeed in the digital economy. And all of those trends, Zoe, that you mentioned in your great sort of, setting of the stage here are the things that we were paying really close attention to. The fact that 2/3 of Americans don't have college degrees, the fact that there's this big skills gap, which is making it difficult for prospective employees and employers who are really worried that lack of essential skills among their employees is limiting growth. And of course, the pandemic accelerated all of that. We had a sort of proof of concept before the pandemic with something that we call the Google Career Certificate. At the time, it was just one certificate program in the field of IT support. And I can explain sort of how we got into that. But this was a program that was helping people without college degrees or any experience in the field get prepared for jobs in IT support. And it was really working. We had 50,000 graduates from the program. 82% of those were seeing a positive job impact, which meant getting a job, getting a raise, getting a promotion. And the sort of makeup of our graduates was also really encouraging because we were trying to reach out, to everyone. 59% of our graduates have no college degree, 46% in the lowest income tertile, 53% Black, Latino, female, or veteran. And then the pandemic rolled in and we said we got to do more. So we built certificate programs in user experience, in program management, in data analytics, places where Google could bring some expertise to the table, and have expanded the program and are really building a whole sort of ecosystem around it with other employers, with educational institutions, with nonprofits, workforce development boards, et cetera. And so that's really become a centerpiece of the Grow with Google work. We're doing, small, I could talk all day about small businesses and so forth, but I'll leave it there for now.
Sure,
hand it over to Nikhil.
Nikhil, can you talk a little bit, so Zoe mentioned some of the work that we've done collectively, looking at job progressions and post-COVID job opportunities, but I actually want you to touch on that, but also touch on some of the work that McKinsey's getting into. We've just heard examples of how big firms are working to build career pathways and economic opportunity. Question that we always get is what can small and medium-sized firms do? You've been thinking about that a little bit. Can you talk about that as well as just some of the overall trends that you've seen?
Sure. I of course, I have some wariness about talking about data to a room full of economists, but I'm gonna dive into the deep end and just you'll be merciful. So I'll touch on both of those pieces quickly, and then we can dig into any particular one that is helpful. But on the analytics we did, the Rework America Alliance, which we're all a part of, and Zoe explained so clearly in the beginning. Part of our goal as a group of institutions is to expand employment and economic mobility opportunities for lower wage workers without four-year degrees. And there have been a lot of efforts to try to do that. But one of the challenges has been groping the dark, meaning like we can keep throwing resources at the goal and we can keep trying institution by institution in a fragmented way. But is there a way to use data to help focus our actions? And the data is going to be dirty. It's not going to be perfect, but can we use it in a smart enough way that it'll crystallize what are the few types of things that are really going to be high value to go do? What are the barriers that are worth really going after to expand opportunity? And then what does that mean for all of our institutions that reflect different parts of the labor market? And so just to give you some of the highlights of the analytics we did, we looked at millions of data points across and cross-referenced different existing data sets. So data on real job progressions taken by real human beings from groups like MC and Burning Glass that scrape the information from across the universe. CPS survey data, other BLS sources, McKinsey Global Institute, the Fed, range of others. And we tried to find what are the hidden job progressions where real human beings have been able to move from a lower wage job to a job that's good in and of itself, that has higher income, better quality. And then that job ideally has been the gateway to opening up a range of even better jobs, all without having to add a 4-year degree. So this predominantly through work experience, maybe with some skilling interventions, but not requiring a 4-year degree, which has become more and more the barrier to people being able to access opportunities. In a nutshell, we found that there are indeed these hidden job progressions that real people have been able to take. They're credible. There's been enough of them that it's not just vapor, but there's a there. And if we take some interventions, we could expand the number of Americans that have the chance to take advantage of them. We found in particular, there were 77 of these gateway occupations where people can access them based on experience and skills. They're good in and of themselves, and they open the door to a range of what we call target occupations, which are the better and better jobs across the economy. We found that, and take this with a grain of salt, but when we did an analysis of what could the recovery look like, this is working with our McKinsey Global Institute and some other partners like Oxford Economics, we found that it's possible that about 20% of the jobs that are coming back will be of the type that we're calling good, viable jobs, meaning these gateway jobs and other good jobs that have different levels of economic mobility associated with them, but can be accessed by lower wage workers based on their experience and can be a springboard to something better. 2 more data points for you to consider, and then I'll get into very quickly into small, medium business. The data also helps us pinpoint a few things. One is, what are the types of skills that really matter? So we found that 70% of these hidden job progressions really depend on interpersonal skills. And these are not just soft skills, the way people talk about that in a casual way, but in particular skills that are best learned through experience rather than an academic curriculum, and that are actually hard to learn. So you wouldn't get it in a week of experience. You actually need to go and build judgment, get the mileage, and that's what builds your ability to do it. And we can actually pinpoint those things, which helps targets the actions we take. The other thing is it helps us to understand sector opportunities and barriers. So when we see where a lot of the likely job growth is going to happen, cross-reference with these good viable jobs, the big areas are going to be healthcare, which accounts for the biggest proportion of the growth, as well as industrials, manufacturing, construction, and so forth. But when we look at these gateway jobs, in healthcare, there are lots of them, but they're notoriously hard to access. There's certification requirements, state by state differences. So what do we need to do to be able to make those viable? And in industrials like construction and so forth, a lot of good jobs, historically, and not a lot of them were gateways to further economic mobility. So what do we need to do to make them more gateways, bring the digital aspect of how these jobs are changing into the equation to make them more attractive? So that's on the data, and we can talk more about that. Quickly on the small, medium business piece. We're just starting to get going. We didn't talk about this, but the Alliance is starting to make available a set of tools and resources and on-the-ground support to intermediary institutions and job seekers around the country. And there's a national level and also in specific MSAs. We're starting to work in those MSAs with small, medium businesses, which will be 50% of the opportunity and 50% of the challenge when it comes to hiring over the next year and a half. And the things we're trying to tackle now are, I would say at least twofold, probably tenfold, but for now twofold. One is how can these businesses actually take on skills-based hiring in a way that's practical and sustainable, because they don't have the same resources as big companies that can take on big programmatic attempts to change the way they hire. A lot of it is opportunistic. So how do we empower them to be able to take advantage of this broader talent pool in a way that's efficient and takes account their limited resources? That's one. Two is, how do we build the capability of the intermediary institutions that can help provide scale? Because another issue is the fragmentation. These businesses are, they can be less than 1,000 employees, sometimes less than 50, right? Depending on how you define them. And to actually get the benefit of experience-based hiring, there needs to be some way to provide scale support. And so part of the task of the Alliance is to try to figure out how we support those intermediaries. Sorry, I went on a little long, but you know me, it was bound to happen.
Yes, we unfortunately, he's in person, so I can't hit mute on him.
Yeah. That's why they put me third in line, though.
But so actually, Michael, I want to jump in on that, because in conversations that we've had, you've talked a little bit about that. Boeing is thought of as a manufacturer. Can you talk a little bit about the digital transformation that you all have been going through and how you dealt with that? What are the skills that you have been looking at and feeling like you all need to build?
Yeah, I mean, Boeing has been seen as a large manufacturer, #1 exporter in the US, but really we assemble planes, and we're going back to the roots of, hey, we're really an engineering company. And I would say even before that, we're now becoming a high-tech company. And it's those digital transformation skills. When I was at Microsoft, the holy grail was to put everything in the cloud. And that's happened. And so what that does is it just doesn't allow, Google and Microsoft documents in the cloud, like Excel and PowerPoint. It's the transformation of what you can do in the cloud around AI and machine learning and quantum computing, which is coming, that transforms everything. And so when I was at Microsoft working with customers, it was a big deal for one customer's division to digitally transform. Now you have companies across the board digitally transforming, and Boeing's one of those. So how do you transform how you engineer and design, develop planes in the cloud? Model-based engineering, digital twin. How do you do that effectively? How do you transform your supply chain? How do you transform your finances, your HR division? All that's happening at once. And so those skills are all really important that are emerging, those fourth industrial revolution skills. So, cyber being one, but also, artificial intelligence and machine learning, quantum, you go down that list of skills that you see and hear are coming, and they are happening real life. And so how do we find people that have good expertise in those spaces? Sometimes it's through degree programs, but a lot of times those people don't have maybe as much real life experience, and it's not experiential enough. It's more theoretical. And cyber is a good example. We just decided we needed to grow our own, because you could have someone with a cyber degree or computer science degree with a specialization in cyber, but they can't do anything. They can't do anything around cyber to protect products and systems, because they just haven't had the real life hands-on experience. And so that opens a door for non-degree folks to have stackable credentials and have it be skills-based hiring, not degree required hiring, that allows for COVID unemployed who have aptitude to have an opportunity. And that's where with, Rework America and the Alliance, we've been able to say, hey, who needs this? How can we come together and cooperate as a group of companies? Toyota being one. We've talked, with Google, with Zurich Insurance, Duke Energy, people from different industries who are interested in driving foundational skills together. And then you can add on the specializations like aerospace cyber or aerospace software development on top of it. So that's how we're thinking about it, is driving those skills. It could be degreed, could be non-degreed, and really growing people around skills and roles that are stackable as much or as important as maybe experts who have degrees.
Thanks. Jesse, as you all were conceiving of Grow with Google, what were some of the things that you did to kind of think about how that added to Google's competitiveness, how it added to the firm's kind of placement in the marketplace, and then also how do you kind of think about the outcomes of those programs? What are kind of conceptually the things that you're thinking about to evaluate that?
Sure. Well, I think that with this career certificate program that I was mentioning before, the way that began was because we couldn't hire people to our help desks. We were requiring college degrees, and there was a Googler, that's what we call ourselves, who was running what we call Tech Stop. And she was like, I think we're going about this the wrong way. And she built a training program. She rewrote the job description. She teamed up with Europe. They piloted a series of internships and residencies, and the results were really good. And then we said to ourselves, hey, like, if this is working to help Google solve our hiring challenges, maybe there are other companies who are in need of this. And so we built out the curriculum and made it available to everyone. And now we are using that curriculum to upskill our Googlers, not just in IT support, but also in project management and some of these new certificates that we are building. So that's been interesting. I think from the, and what was the second part of your question?
How are you all thinking about the outcomes? Like, how do you, what are the things that that matter to you all as you kind of evaluate and continue programs?
Yeah. I mean, I think, as you're getting going, so it's you got to look at those sort of output metrics. How many people are you training and engaging with? And now it's all about the impact. I talked about the 82% of people who have experienced a positive job impact, a job, a promotion, a raise. I mean, those are the transformative metrics that really matter. It's really not about training. It's about giving someone a pathway to a job. Similarly with our small business efforts, we look at, again, whether that small business has hired a new employee, or whether their business has actually grown. And those are the metrics that I think are most impactful and important and the hardest to measure. Mackenzie, can you help us with that?
Let's chat. Zoe, I want to turn back to you. We've heard a lot about developing internal training programs, but that's not the only way that firms can create economic opportunity and create progressions for workers. Can you talk a little bit about some of the other ideas that you have that you've seen in the Alliance or kind of broadly in Marco's work of where employers turn outside their walls to create opportunity?
Apologize, I was having trouble getting off mute. I'd be very happy to do that. One of the things that we heard very early on as we started forming the Alliance was from Mark Morial, the president of the National Urban League. And he made the comment that if we really want to create diversity in the workforce as part of the change we are seeking, and we want to bring in Black and brown workers and women, we need to connect into different networks. That it's not just a matter of getting rid of the college degree or trying to address the cultural barriers or having people be aware of these jobs, but rather that sourcing people really requires connecting into very different networks. So the kind of thing we're doing with the Alliance that other companies may find very useful, or other policymakers working on workforce, is we're trying to connect employers to new sources of talent within their communities by connecting them up with worker serving organizations in those communities. So the National Urban League has branches all over the country, serving particularly the Black community in those cities and regions. Unidos US has affiliates all over the country serving Latinos. Goodwill has fabulous networks into both those communities and others, the disability community, others. And we have women's organizations like the National Partnership for Women and Families, also with networks. And so what we're trying to do in a very practical way, and others can do in their own communities, is to partner with those local networks with a direct connection to job seekers to use them to find new sources of talent. And then if you couple that with the kind of know-how that Nikhil talked about in terms of the data that is freely available on our website and the Fed website and the McKinsey website. But if you look at where you might source workers for jobs that you're pursuing, and you make that information available to these worker serving organizations and partner with the coaches and counselors that they have and that your community colleges have, there's a tremendous opportunity to have people see that the experience they've had out of these diverse communities is the experience that you need for your job. And this is an enormously important collaboration that needs to happen at the community level. As Nikhil alluded to, all of us have been creating different tools that, again, are all available on our websites, but the Rework America Alliance page on the Marco website and the links there will take you to things like the tool that Google created that enables employers to identify how to post a job, and the tool that we developed with MZ for workers to create without having to do any of the work. They put in the jobs they've had, and MZ translates that into a skills-based resume for them so that they can see what their experience produces into the marketplace. And there are tools for employers to learn how to do this kind of hiring, tools for coaches to learn how to pursue these opportunities for people. So that's what I would encourage you to do. Think about what's out there that you can deploy that will enable you to connect up effectively with the networks and communities that you're in and where you're looking for workers.
Thanks. I'm actually now, this app is nifty. I'm turning to your guys' questions, and I'm going to actually combine a couple. One is about the accessibility to programs like you're talking about from a geographic perspective. To what extent does geographic inequality play into some of the things that we've been talking about? So like a couple of things that the audience members wanted to know about is particularly how available are some of the Boeing apprenticeships available to rural Americans or Grow with Google? How can people in smaller parts of the country reach some of these programs? The other question in here that I think is important to talk about at the same time is to what extent could labor mobility play a role in addressing some of these challenges? Have you all seen that? Those are the couple questions right now.
Well, from a geographic standpoint, the beauty of online learning is that this training is available for everyone because it lives online. But I think as we all learned, especially this year, like online learning is hard, especially for some of the populations that we're really trying to reach. So we're also partnering with, as I mentioned before, nonprofit organizations, community colleges. We are in 100 community colleges and counting in a wide range of urban and rural locations across the country. So I think there's the accessibility from the learner standpoint, and then where are the jobs? Some of the remote learning is on the rise, and I'd love to hear if there's more data that you have on that. But I think that is something that is why we have built a hiring consortium with over 160 employers who are hiring all across the country and are using technology to try to match our graduates with those actual job openings to create the path. So I think online helps a lot with that geography issue, and it's something that we're really cognizant of.
Stuart, if I may jump in on the answer to that question.
Yeah, please.
Okay, just very briefly, two things. One is that there is a possibility that if this infrastructure bill passes Congress, that there will be a real explosion of jobs around the country and in remote and rural areas. And the challenge there will be to get people the opportunity for the better jobs there, not just standing on, the woman who stands on the side of the road holding a flag, but the challenge will be, to get people into the better jobs. And today, if you knock down a cement wall as part of a construction project, you're no longer doing it with a sledgehammer. You're much more likely to be doing it with a robot. And those robots can be operated by people who are strong and people who are smart and people who are weak. And so getting people into those higher paying jobs is going to be a really critical part of the effort that's going to be needed, but it is something that can help communities all over the country because these projects will be all over the country. The other comment is that, and I bring this back to our colleague from Boeing because they're the best example of it, manufacturing is changing and it no longer needs to be done in a US steel plant in one location. It's not just moving from a big steel plant to mini mills, but it's actually moving to distributed manufacturing closer to the source of use and closer to the time of need. And part of what I think we need to do there too is, when Boeing is now manufacturing aircraft engine parts, some of those parts they're trying to manufacture using additive manufacturing or 3D printing. Those 3D printing machines are much more precision and they can be anywhere in the country. The only constraint is that some parts of the country, like in West Virginia, don't have the roads and the infrastructure for the internet to download the plans for them and to distribute the materials. But if you have roads and if you have the internet, and if there's a broadband build as part of the infrastructure bill, that will help solve that problem too. But you can be anywhere in the country and manufacture a part for Boeing, and they'd be happier to have it near the place where they have to repair the engine than to have it in a singular place. And you see this with all the supply chain problems that we're having now. It's not just semiconductors, it's really comprehensive because we're good. And that's going to drive us shifting how we provide supply chains.
I was just going to jump in quickly. Zoe, thanks for that. I think that's right on. And also in terms of the apprenticeship program that we've been talking about, we see it as very much online and virtual as well. I think COVID accelerated this. We used to fly people into St. Louis a lot at this Boeing Leadership Center and have week-long programs, instructor-led. Now it's much more online, virtually taught to anywhere around the world. And then you have Boeing centers around too. It's Huntsville, Alabama, it's Louisiana, it's Pennsylvania, it's Seattle, it's all over. So it can be more regionalized, but more importantly, it's online and virtual. And that's how we plan these apprenticeship programs as well.
Great. Our other very popular question is around early exposure to career education. Some of our audience members are wondering about kind of the desperate need for skilled work and what role early high school level or earlier career-based education can play as a complement to academic tracks in high school.
Yeah, I mean, I could say a little bit on that. We were just talking, we have a Boeing global engagement team that focuses on STEM K through 12, and it really starts pre-kindergarten. And so we're really getting better at saying, hey, our strategy is from pre-kindergarten through 12th grade, giving internships to high school kids, and then a very large internship program, not only at high school, but also at university level. Then taking care of our own workforce, also pushing learning out to suppliers, customers, and partners, and then even phasing out retirement and bringing back retirees as gig workers. Part-time projects. So you've got everything from pre-kindergarten all the way through to retirement, but big emphasis on STEM and K through 12 and internships in high school. Programs like robotics, programs in that STEM field, starting earlier and earlier, middle school and high school. But that's been a big emphasis for Boeing, at least in the aerospace industry.
Great.
Yeah, I might add one thought on that, and then one thing on the labor mobility question too.
Yes.
So on that point, we're seeing across our client base this idea, like that the experiential learning is so important to pair with the curricular learning. B, that the earlier the better, as long as you're not, like, maybe we don't want to go to a system that's sort of determinative where you're 14 and you decide your future, but getting exposure to the doing is important. C is giving people in high school a better understanding of what jobs actually are that are in front of them. So if you were to ask our colleagues in the Alliance who work in the building trades, they would say, we're really struggling and focusing on helping people who are 16, 17, 18 understand that construction jobs are actually quite varied in the nature of the work. And a lot of them are not only good in and of themselves, good pay, good quality, but could be springboards to good careers. But most people have no clue, especially at that age, but even older, have no clue what is actually entailed in these different sectors. So getting that exposure, that understanding, the experience earlier, I think is relevant and is on a lot of people's minds. On the labor, just a quick addendum on the labor mobility point, that one of the, I'd say a good thing coming out of our analysis, but also a challenge. The good thing coming out of our analysis of these good viable jobs for people, lower wage workers based on their experience, is that a lot of them are the types of jobs that are geographic agnostic. So like there are healthcare roles that are going to grow across the country. And we've already seen from the Fed's analysis using these, taking the gateways and then plotting them against geographies around the country, that there's a broad base of need. Similarly on manufacturing type jobs of different types. And if you have the infrastructure bill, that could also become widespread. I should also have digital roles. So IT administration and support. These are roles that are cross sector and cross geography. So that's a good thing from the mobility point of view. I think the challenge is there will be mismatches. And I have this debate a lot with my colleagues who also work on economic development, that sometimes we're a little bit, we meaning the whole ecosystem who care about this, are naive about what it takes to actually develop a region. So on one hand, I think we shouldn't have hubris about, if there's no economic base in a place and no natural reason why you could sprout one in a place, then you need to be careful to assume that you can do a bunch of interventions and create an economy where there isn't a foundation. Similarly, if you're too optimistic about labor mobility, it's dangerous, because even if you were to give people a lot of resources and ability to move, we shouldn't underestimate how rooted we are to our communities. Most people have only been to a certain radius beyond where they grew up, and they care about staying where they've been. So, in our debates internally with my colleagues in McKinsey, we talk about, well, if you can't develop, if certain regions won't get the kind of development and job opportunities you're hoping for, instead of treating, remote work as just an accidental outcome of the pandemic, could we actually be more proactive in thinking about how to use it to create opportunity? And there are all sorts of investment requirements that come with that.
Great. Well, I'm seeing this light turn red, but I'm going to ask everyone one last question. So it's lightning round, but we're going to go into overtime really quick. Closing thoughts. If anyone's kind of heard something and is interested in building an internal training program, is thinking about wanting to reach out to a new partner, what's one piece of guidance that you would give them to help them take their first step? Who should they talk to? What are some first steps? Let's start with Zoe, and then we'll come on back down my way.
Sure, I'll be really quick. First of all, there are excellent union training programs, and whether or not you're a union shop, some of the unions are prepared to come in and train the workforce or provide apprenticeship programs or training. And that's, happening more and more. And some of the state economic development initiatives are great places to connect up to the community colleges and other trainers that provide very practical experience. But I really encourage employers to think about how to train within their own building, their own workforce. I was talking to somebody who had done this, been an executive at GE earlier today, who was talking about how they brought in conjunction with the union and the state center, they brought in the trainers into the workforce so that the employer didn't have to organize it, but the employer just had to open the door, and their workers were able to learn more about the materials and, you know, the kinds of things that affected their capability to execute against the manufacturing responsibilities they had. So there are a lot of resources like that that employers can take advantage of.
Thank you. Nikhil.
Adding on to that, which I totally agree with, I would also encourage everyone here to, and your colleagues in your institutions, take seriously the effort to understand what skills are actually required for the jobs you're hiring for, and then try to find the best people based on those skills. And it sounds simple, but it's actually, I think it's yada yada too much. It's taken too casually, and it's leading to a lot of people that could do that work that are being kept out of opportunities for economic and personal advancement.
I was going to say something similar. But we've started with what we know. Googlers are the ones who are teaching the skills, and we have built also from the job back. We've talked to employers who are hiring for these roles, and we've made it rigorous, which benefits everybody, because the learner, graduate wants the credential to matter, and the employee wants to know that this credential stands for something. So I think that's been important. And I think also keeping in mind, we've been working a lot with our behavioral science team. It's not just about the skill, but I think also getting people to work through it. So we have Googlers telling stories about imposter syndrome, telling their own personal journeys at drop-off nodes where we've seen people leave the curriculum, and being mindful of that piece of the work as well has really enabled a lot of success.
And I would say, consider not going it alone. Find an alliance, find some partners. We were at the World Economic Forum sitting in the aerospace committee, and we were looking at each other saying, this is really about co-opetition. Let's cooperate where it makes sense. None of us can afford to keep up with these technologies as rapidly as they're changing and provide all the workforce development around them. Let's create a foundational partnership where we can get what we all need together, and then we can add on to that our own specific things. When we have so many companies in the US alone, let alone globally, and over 1.5 million nonprofits in the US, we should join forces more and not try to do everything on our own. I do some volunteer work at the UN, and one of the ambassadors said, it's not about resources, it's about leadership and vision and the resolve and discipline to get results and have impact. And so how do we come together better in this complex milieu and create something that can really have practical impact? I think that's what we should all be thinking about.
Well, thank you for having us today, and please join me in thanking the panelists for coming and sharing their ideas today.
Establishing the live uplink with Madrid, Spain. Manuel, can you hear us?
Yes. Cannot
Okay,
see
great.
you, I
We
can
will
hear.
start the next session. Manuel, take it away.
Okay. Even though I cannot see you, it's a pleasure to be here with you. In particular for this great opportunity. I'm truly delighted to present the 2021 NABE Adam Smith Award to Professor Hal Varian. Dr. Varian, distinguished career in academia and business, embodies the spirit of this award, which is NABE's highest honor. For those of you who don't know, Professor Varian is the chief economist at Google and is emeritus professor at the University of California at Berkeley. And he has also taught at MIT, Stanford, Oxford, Michigan, and he holds honorary degrees from a number of universities. I won't go any farther into his CV because, first of all, you all know him well enough, and second, it could take all day. But probably, as for many of you, the first time I heard of Dr. Varian was actually as a first-year graduate student. His textbook in macroeconomic analysis provided a wake-up call of what to expect of graduate school, and actually the reason for more than one late night. Notwithstanding his textbooks in both macroeconomic analysis and its use in real-world scenarios, have been staples of graduate and undergraduate level economic programs for decades. His research has been key to driving many business decisions at Google, and his widely regarded role as the first tech economist has inspired hundreds, if not thousands, of other economists to follow on his footsteps. His contributions to NABE's efforts to cultivate the community of tech economists speaks to his generosity and his willingness to give back to the economics profession, and also to guide the next generation of industry economists. With his support, NABE Tech Economics Meetup, which eventually evolved into the NABE Tech Economics Conference, has grown exponentially in recent years. Last year, it achieved a record attendance of over 1,000 virtual participants, and it continues to flourish with Dr. Varian's engagement. Hal, Professor Varian, the floor is yours. Thank you for accepting the award.
So thank you very much for that kind introduction. I thought what I would do in the next 20 minutes or 30 minutes is talk a little bit about how Google came to have a chief economist. So it's an interesting story. You're getting a double dose of Google this afternoon, it looks like. All right, so you have to understand I'm a microeconomist, and this is a picture of microeconomists. We have that furniture at Google. It makes us all be suitably humble by having that outsized chairs. Now, these days it's not unusual to have a tech economist, but back in 2002, I would say that's rather rare. I think the only example I know of is Intel had a chief economist. So how did that all happen? Well, let me give you a timeline here. In 1995, I moved to California, became the founding dean of the School of Information at UC Berkeley. There's a whole interesting story about how that happened itself, but I don't have time to talk about it. I worked with my colleague, Carl Shapiro, who some of you may know, wrote a book called Information Rules, which was a surprisingly big bestseller. It was basically the economics of technology industry, and believe it or not, 20 years later, it is still widely read. Now, the folks at the New York Times read some of the Information Rules, and they liked what they heard, so they invited me to write a column for the Times, which I did for about 7 years while I was acting as the dean at School of Information. And in May of 2002, I bumped into Eric Schmidt, who I'd known from other reasons. He was a graduate of Berkeley computer science. I said, what are you up to these days? He said, I just joined this cute little company down in the South Bay, and it's called Google, and maybe you'd like to come give us a hand. So who could resist an opportunity like that? My intention was to work there for a year and then write another book about how it was life at a startup in Silicon Valley was like. That's 20 years ago. I don't think I'm ever going to write that book, but at least that was the initial aspiration. And finally, in 2007, I became a full-time chief economist. Before, I was just a consultant and worked on whatever they asked me to work on, but I decided I was having more fun at Google than I was at Berkeley, so I shifted, I became a permanent employee, or a full-time employee. Now, in June of 2008, I got a phone call, and they said, Dr. Varian, I'm from this large tech company, I won't mention their name. We're thinking about hiring a chief economist. Tell me, what exactly do you do? This is a true story, not embellished. And I described what I did, and she said, oh, that sounds interesting. So what do you know? They ended up hiring a chief economist, and another one, another one, another one. So now there's quite a few. In 2017, we had the first NABE tech meeting in Seattle, moves back and forth between Seattle and San Francisco. And there's a lot of people out there who are working as economists in technology industries. And that brings me down to today, where I want to tell you a little bit about some of the details of what I've done and others have done in this area. So when I asked Eric, what should I work on? He said, why don't you take a look at this ad auction? I think it might make us a little money. Now that was the understatement of the millennium, I think, but it turned out it was a very, very successful product. I came, it was turned on, or first started functioning in February of 2002. I came in May of 2002, and it was clear that the auction was showing very interesting signs of life and looking quite promising, but we didn't really know exactly how or why it worked, and that was what Eric asked me to look at. So when you do a search on Google, you'll see organic results, search results, but you also see these ads. You can tell they're ad because they're labeled there with ad in the upper left-hand corner. And this was a search for frying pan, I think, and those were the ads that came back. So why did you need an auction, or why did they run this as an auction? Because they had this kind of advertising before, but the prices had to be negotiated between the advertiser and Google, and that really doesn't scale. And to say something doesn't scale at Google is like a cardinal sin. There is no way that you could run this market if you had to have humans in the loop. And they looked around a bit and they found out this idea of using an auction, because an auction works great for these kinds of perishable commodities like flowers and fish, and it turns out ads as well. So I'm going to sketch a very, very simple model, oversimplified model of how that ad auction can be looked at from the viewpoint of economic analysis. So the idea is the advertiser supplies a keyword. That's when they want their ad to trigger. When the user types in that keyword, they have a creative, that's marketing language for what the ad says, and then a bid of how much you're willing to pay per click if user happens to be attracted by the ad and clicks on the hyperlink that's embedded there. So that's what, in the simplest way, in the simplest form, that's what the auction looks like. And I'm going to have a little bit of algebra just to show you where the analysis goes. I know it's dangerous having algebra at 4:30 in the afternoon, but I'm going to try anyway. All right, so the value of a click for the advertiser in slot S is some number, VS. That's how much they're willing to pay for a click. And the number of clicks on slot S, that's given by XS. And the bid is how much the advertiser is willing to pay to be in that position. And I should mention that not all slots are created equally. An ad at the top of the page is worth a lot more than one at the bottom of the page because they attract more attention, like any other advertising. Okay, so in equilibrium, what needs to be the case? Well, it turns out that each advertiser must prefer the position it has to any other position it might bid for and receive. So the left says value minus cost, that's the left-hand side, has to be at least as big as the value minus cost of any other position you might choose. Okay, Pretty simple, reveal preference. And if you just manipulate those inequalities a little bit, you get this nice little formula at the top of the page that says the difference in expenditure between slot S+1 and slot S divided by the difference in clicks between slot S-1 and slot S has to be at least as big as the value. And then the right-hand side says the same thing in a slightly different language, gives you a lower bound. So you get this lower bound and the upper bound of the value. So by observing how much people are willing to pay for these clicks, you can infer how valuable those clicks are to people. Not too surprising because that's how ordinary economics works as well. And in fact, you get these nice bounds on revenue. You can write down, again, just by pure algebraic manipulation of those slots, you get this expression on the lower bound for revenue and on the upper bound for revenue. So again, by looking at equilibria of the ad auction, you get this nice understanding of what revenue looks like. And when you're proposing some changes to the auction, you can see how those changes would impact revenue. And that's very, very handy because you can either do an experiment or you could do a simulation, or here you can apply a formula. They don't all agree perfectly, but they all line up pretty well together. So how much is a new advertiser worth? Well, we can take those formulas I just had on the page as inequalities, and you look at how total revenue changes when you add a new advertiser into the mix. And why is that interesting? Because you have this sales force that's going out and trying to encourage people to try this product so you can get a reasonably good idea of what their performance will look like even before they actually engage in the auction. And how do you compensate the salespeople? So, you know, as everybody knows, you compensate salespeople with these bonuses of one form or another, and the bonus is supposed to reflect how valuable their actions are to the employer. And so how do you figure out what that looks like? Again, you can use this in the model I just described to get an idea of how valuable a new advertiser's worth, how much revenue they get together, and then how much you would like to compensate the salesperson for bringing this new source of revenue into the company. And one kind of interesting feature is that there's a big difference between auctions that are undersold, that is, there are more space than is actually used, versus ads that are oversold, where there's more people who would like their ad to be shown, and they compete with each other to get the position that's coveted by the advertisers in question. So we developed tools at that time for analysis, one for doing A/B experimentation, the other for doing the bid simulation that I just referred to a few minutes ago. And you can run these kind of in parallel, run a simulation, see what things look like. If it looks pretty good, go out and run a real test and see what the revenue increase is. And so you've got a nice loop going for increasing revenue. That's pretty much what I did for the first year. I was at Google as a consultant. Now, one day, one of the Googlers came up to me and said, "Can you help us in forecasting query growth?" Now, at that time, the queries were growing very, very rapidly. I said, "Well, what do you do now?" And she said, "Well, I highlight this number in Excel and I click on the button that says forecast." So I said, "Perhaps I can help you with that." And I was really faking it a little bit because I didn't know all that much about time series forecasting. I had an office next to Rob Engel at one point, and I heard these words coming about ARIMA and Kalman filters and all of this kind of thing. And I said, well, maybe I should go look those up on Google, of course, and see if they offered some help in estimating the query growth. Now, remember, this was a non-stationary problem. A lot of the methods are out there to look at stationary problems, mature industries and so on, but this was one that was growing rapidly, so it was a little harder to do than in most cases. There was very complicated seasonality over hours of day, days of week, weeks out of months, and so on. There were moving holidays all over the place. And it was something that was a non-trivial problem, not so much that the math was non-trivial, but there was all of these issues to take care of to really get a reasonable performance. So we did it. We built a forecasting model, and that's been proved. And Google looks very much like a utility. You know, utility has hours of day, changes, days of week, all this kind of stuff. Google looks a lot like that. Now, one thing we noticed when we were doing this, when we built the machinery that would track all of this stuff, is one day in June, all of a sudden traffic just dropped off. It's terrible. You lost all of this traffic in the next few days. And what was going on? So I took a look at it and said to the person who was handling this, why don't you plot the log of the traffic, a log of the visits to Google? And she did. And then by gosh, it became quite clear. What was happening was Google was dropping in the same percent amount that it had done last summer. But of course, it was a much bigger absolute amount because we'd grown so much in the last year. So she said, wow, that's neat. How did you know to plot the log? And I said, well, you know, that's what they teach you in econometrics. All right, let's see. That's what they teach you in econometrics, famous words. All right, so finally, I want to talk a bit about Google Trends. Now, Google Trends, let me just ask for a show of hands. How many people in the audience know what Google Trends is? Okay, so that's at least a third of the audience, maybe a little more. I'm glad you know that because I think it's a tremendously useful tool for answering certain sorts of economic questions. Now, if you became unemployed, what would you do? Well, not this audience. If an ordinary person became unemployed, what would they do? Well, they go to Google and type in unemployment office, or how do I file for unemployment benefits, or where's the unemployment office? What are its hours? What do I need to bring? All this information that people would amass if they were in fact intending to go to the unemployment office and try to collect some benefits. Now, what that means is those queries that are related to unemployment benefits then are likely going to be pretty well correlated with what happens to the actual government metrics on initial claims for unemployment benefits. So we think the searches would be predictive of those actual metrics. And this goes back to something that John Battelle said in 2003, Google is a database of intentions. When people are thinking about doing something, what do? They enter it into Google and they see if it's advisable to do what they're contemplating doing. And this is a really nice example. And I think on the next slide, what do I do here? Press this one. No, I pressed the wrong one. All right, this one. There we go. So here I've got in the dark line, I think is the Google queries on initial claims, and the gray line is the actual. And you can see those series are very, very well aligned. And this is true for lots of other things as well. When you look at events that are happening now, it's just that you don't see them because they aren't going to be reported until the end of the month or the end of the week or whatever the reporting day is. And so it's a form of nowcasting. And again, nowcasting was a widely used term 20 years ago, but now everybody's using it because you're looking at all sorts of metrics, mostly online in some form or another, and then using those online metrics to predict what's happening on the real side of the economy. All right, try one more. There we go. Now you can do other things with trends as well. You can disaggregate over time and space, which is pretty handy. So you could estimate a model of initial claims at the national level, that is what queries in Google Trends are most predictive of the national reports on initial claims. And then you could use that model that you estimated at the national level to do forecasting for regional or even state levels. So nowadays we have state level for state level reports on initial claims. But back when we started doing this, I think they came out every 2 weeks, and the regular initial claims, national claims came out 1 week. And so we could actually see how well this worked, because if it worked for the case where you actually have that state level data, that's fantastic. But if it's something that you don't have the state level data, you might find that this technique is a helpful proxy for what that might look like. You can now cast current events, things that are unfolding over time. And I remember we tried looking at the Gulf oil spill, so again, decade or more ago, and you could just watch people changing their vacation plans from the west coast of Florida to the east coast of Florida. I mean, you could really see this happening in real time. Initially, not so much, but then as it began to break in, that they may end up with not as pristine of beaches as they had hoped, and they started shifting their choices. And so you could get a forecast of that, what people were planning to do in August, and you get a forecast of that whenever the spill happened, I think sometime early on in May or something, in the spring at least. And you generally can do this for all sorts of nowcasting events. Other people have done it for elections and things like that. But there are cases where you can really forecast the future. So it's not just a nowcast, but a true forecast. And that would be where you're planning something now. You have the intention to go places on a vacation in July or August, but you're scoping out the possibilities now. And by looking at the form of the Google queries that are made now, you get an idea of what's going to happen when people actually take their vacation several months later. So a number of tourism boards for different countries and different locations have been doing this to get an idea of what they might expect in the future when all those tourists actually arrive. And that's one of the most popular uses, in fact, for Google Trends. But other things like that, where the decision process to purchase is spread over time, like the vacation planning, like housing purchase, that can take, of course, several months of search. And you can look at the different aspects of that, because you can look at terms like real estate agent. So I need a real estate agent to get started. And then you look at things like maybe a real estate lawyer, or you look at things like a house appraiser, or you look at other things of that sort, which would be queries that would be sort of stops along this way from thinking about buying a house to actually purchasing one a few months later. And same thing with automobiles, there's usually some planning there. For much of what we purchase, the idea says, oh, I need some new shoes, and then they're purchased within a day or two, online maybe within an hour or two. But there's still some things that are spread out over time, and those are ones where you get the initial intention, and then you can look at what the actual outcome is. And I just got from a colleague of mine at the OECD a GDP tracker that's tracking GDP that uses entirely trends data. And I think this is a very, very clever and interesting application. What happens is you look at GDP, which in the US, as we know, comes out quarterly, and then you try to infer what it would look like on a monthly or conceivably even a weekly basis. So you're trying to look at the low frequency data and then use correlates of that from Google Trends and use those correlates then to look at what the high frequency data looks like. So here's a little example. Oh, I see, I'm pressing, that's what I'm pressing this wrong. There we go. All right, there's the tracker by country. They've done this for all the OECD countries and a few others. They've got the actual GDP, the black dots, which show up on a quarterly basis. And then they've got this estimate of what the tracker looks like on, I believe, a weekly basis. So it's really nice. And it uses only the Google Trends data. That's the kind of cute part, that you can learn a lot about these components of GDP simply by downloading some data and doing this kind of analysis. All right, now let's see, one more. Oh, there we go. Oh, that's the last slide. So I will leave it there, and thank you for your attention. Am I on the right seat?
You get to choose.
The hot seat.
So thanks for the presentation. I want to talk to you a little bit about your journey from
yes
academic economist to business economist. You said at the very outset you were having more fun at Google than at Berkeley. Can you expand on that a little bit?
Well, remember, I was at that time a dean at Berkeley, and there's this old saying that what is it? As the fire hydrant is to the dog, so the dean is to the faculty. It wasn't that bad, but it was a case where I wanted to do more research. I wanted to do more active work and didn't really like the administrative role that much, although I was very pleased with what I accomplished while I was dean at Google. But all good things must end.
You presumably could have backed off of your dean position and gone back to just academic. So it must have been something about being in the fray at Google that attracted you.
Well, it was really the fact that I didn't intend to remain at Google. It just happened that I shifted this consulting from that I was doing for them. I found it really exciting and interesting. We're using the real-time data to do these sorts of things. And that's what made me decide that I should probably retire from Berkeley and go full-time at Google.
So was there anything difficult about that transition from one type of life to another type of life, or?
Well, there's this, we sometimes say Google is like a university, but with money.
And so I'm just sort of interested that Google, so I mean, obviously one of the characteristics of you think at least, one of the characteristics of an academic career is you get to choose whatever the heck it is you want to think about and work on. Is it the same environment at Google, or are you more kind of confined into the set of questions that you need to spend your time on?
So that's an excellent question, because it's a mix of both, as you might imagine. Lots of people are interested in economic issues in the course of utilizing their product, one form or another. And they will come to you and to my team and ask questions. And then we want to provide answers. And sometimes we can provide answers right away because it's something that's been studied. Sometimes we have to have a project to understand those issues ourselves. And then, you know, in other cases, we decide that it's better to consult outside expertise or something of that matter. So we do have to, I mean, we're supposed to be able to answer a lot of the questions that people come to us about economics, whether they require just citing something in the literature or looking at the looking at a longer analysis. But as long as we're satisfying those conditions, then we have a lot of freedom in terms of working on other things. Another thing I've used sometimes to summarize my role, as I said, I'm trying to answer the questions that management is going to ask us next month. And if you can do that successfully, that's a really valuable contribution to the company.
So you're, you know, one of the, I guess that one of the satisfying things about your position is you actually get to see the things you work on get applied materially in
absolutely
business practice. I mean, were you already able to do that in your previous life, or?
Well, as dean, you could do it. There are a lot of constraints, but I did start this information school. It's turned out to be a big success, and so I'm proud of that accomplishment. But it is much more difficult than getting something done at a young, growing startup, because by its very nature is exploring these new options. Should I do this? Should I do that? Let's try this. You could conceive of an idea on Monday and it would be running by Friday. I mean, it was that fluid. Today, Google's a bigger company. And so when you come up with an idea, it can't necessarily be deployed in a few days the way it was 20 years ago, but instead you have to go through various reviews. Now those reviews are absolutely necessary because when you're a young company and you screw something up, nobody notices. But if you're a big company and you screw something up, then it's front page news. So of course, reviews are inevitable and necessary, but still I have a nostalgia for the earlier days when things were much, much more flexible.
So I have a couple questions from the audience. So here's what is the weirdest thing that Google Trends has been used for?
Huh.
And I think this probably has to be G-rated. I'm not.
Yeah, well, there's certainly, so I can suggest this by, I can answer this question by describing a book. It's by a guy named Seth Stevens Davidovitz, and the book is called Everybody Lies. Okay, so you can get an idea of where this is heading. What happens is people will ask things to Google that they would never ask to a human being, not to mom or dad or your spouse or your best friend or your minister or your psychiatrist or tax lawyer or whatever, right? They'll ask questions that they would hesitate to ask any of those people. And Google, by and large, gives them pretty good answers, okay? Pretty good answers, because it's a situation where there are all sorts of potentially delicate issues of the sort you referred to, but people go to Google and say, how do I know if I'm gay, for example? That's a very important question, okay? And you get a pretty good answer from Google. And I think getting answers from just randomly chosen people would not be of the same quality. So there are serious questions of that sort. What happens if I don't declare this income on my taxes? You know, blah, blah, blah. So people are thinking about things, and it's a case where you have a lot of responsibility to try to give people accurate and helpful answers.
So I've only heard that people use Google to search for some things that are bad. I've never done it myself.
Yeah.
So we're running short on time, so I do want to ask this question. You've been very helpful to the organization in sort of helping us pivot in the direction of providing job opportunities for young economists. What advice do you have for either someone just beginning to study economics, or maybe someone who's even already on the path, if they think that your career might be interesting to them?
Well, they should definitely work on their computer skills, because you have to know how to program, you have to know how to use databases and so on. So that's number one. It's probably a good idea to take a course or two in machine learning or related topics. Try to get this breadth of the deep economic knowledge and, of course, the computer science, computer engineering component, because you're not going to have when you start a job, you're not going to have your own personal data jockey who's going to pull data for you. You are responsible for that. And if you wait around hoping that you can talk somebody into doing it for you, that's not going to be good for your job prospects. So I would say that is important. You don't have to be an expert, because a lot of this stuff is mundane or running something that you've run dozens of times before, but that's definitely a requirement.
And your first example was, I guess, an illustration how nothing better as well than good old solid microeconomic.
Oh, that's true. Absolutely. Absolutely. And things come up all the time. So think about impact of taxes. The French were intending to pose this tax on online platforms, and what would the consequences of that be? Well, as you know, economists have studied this issue about instance of tax for a long, long time, and we were able to offer some suggestions on this issue.
Professor Varian, thank you very much, and congratulations on the award.
Thank you. What happens? What should I do? Stand up here?
Stand up.
Yes,
and give
okay.
it to-
All right, great. Oh, thank you.
Congratulations.
Well, I will hang this in my office at work if I have an office at work. All right, thank you. Thank you.
Okay.
All right. You know, it was inevitable that if I came up here enough, I was going to really mess something up, and I just did. So it is my honor to represent Manuel Balmaceda, Chief Economist of CEMEX. You all know him. You all love him. And because I don't have the notes that Tom wrote for me, that's all I've got to say. Manuel, the floor is yours.
Thank you very much, Dave. Hello, everybody. The truth is that it is a pleasure to be with you, even though it's only virtually on my part. But I wish I could be there with you, but you know the saying, right? Man proposes and God disposes. Or in this case, actually, the US immigration authorities. When thinking of what to give my remarks on, the obvious first thought was to speak on what we're all talking about, the world post-COVID. However, there is very little I could add to the great lineup that we have assembled in this conference. So I opted to share my views on the role of a global business economist in these tumultuous times. I would like to focus on the double dimension of being a global economist. First, on the global economist bit, but second, on being a business economist. The world economy has experienced two black swans in little over a decade. Black swans were something that were only supposed to happen once a generation. But the truth is that there are very few similarities between these two crises. The global financial crisis had economic underpinnings, and as such, economists had a lot to say about its causes, its consequences, and the probable ramifications. The excesses in the residential sector were clearly anticipated, and what was not, except for a very few economists, like come to mind, Bill White and Rajan, very few anticipated were the global interconnections of financial markets, the contagion, and the meltdown that ensued. The COVID-19 crisis, on the other hand, was not caused by any previous economic excesses. It was the measures taken to curtail the spread of the virus that led to the economic downturn. All economic policy could do is react to the evolution of the health indicators, trying to minimize the economic fallout from the restrictions enacted. Business economists' job was first to speculate as to the depth and breadth of the recession. Remember the alphabet soup, it was going to be an L, a V, W, whatever, turning later on to the analysis of the impact of the aggressive policy initiatives in our businesses and the speed of the recovery. The metric being how quickly we would recover pre-COVID levels. Things look better than we had anticipated, and now the focus has turned to the evaluation on what the new normal will be like. Or should I say the new normal? The new normal was already coined for the new economic reality after the global financial crisis. As after the global financial crisis, the question is how new and how normal. We tend to think of new normals all the time nowadays. If in the aftermath of the global financial crisis, central banks' heterodoxy became the norm, Or as Constance put it last year in her presidential address, the quixotic has become the quotidian. In the aftermath of the COVID crisis, we may encounter a few long-lasting, maybe structural changes. For example, increasing the role of governments and greater toleration for fiscal deficits, a new work from home culture, increased protectionism, etc. Sorry, I couldn't help myself but to talk a little bit about the world post-COVID. But in any case, these past crises have a clear common denominator, the global nature of the crisis. That's quite obvious in the case of the global financial crisis, but not quite as obvious in the case of the pandemic. However, COVID-19 has shown how interconnected the world really is. Closing borders could not prevent the spread of the virus. And in spite of a little policy coordination, most countries followed similar approaches to combat the pandemic and implemented, to the extent that they could, similar policies. In spite of the protectionist rhetoric, the world is becoming increasingly global. Back in 2010, Lynn Riser, in her NABE presidential address, already brought up the fact that our analysis was, in her words, too US-centric, and the need to pay more attention to the actions and interactions with the 20% that is moving to 40% or 50% of the world. And that was 10 years ago. The US share of global GDP, according to the OECD, has dropped from 25% in 2000 to 20% now. And it is expected to continue falling to around 15% by 2030. But not only that, the traditional large global economies of the old G7 are yielding the leadership positions to the likes of India, Indonesia, Brazil, Mexico, Nigeria, not to speak of China, the second largest economy already and a global player today in its own right. These economies present a big challenge for business economists. They do present higher growth rates, but are much more volatile and unstable. Their economic models differ to a smaller or larger extent from the market economies of the West. In such a world, events outside our borders will have an incremental, larger impact on the US economy. And even more dramatically so in each or on their specific sectors. As a business economist, we need to be attuned to these interactions and incorporate global dynamics into our analysis. Recent trends would seem to suggest that there may be a retrenchment in the globalization process. Let me disagree, or at least let me qualify that statement. There may be a growing push towards renationalization of production, particularly manufacturing production, and the shortening of supply chains. The realization that during the pandemic, that 84 of paracetamol, the most widely used drug ingredient in America, came from China and India, with China accounting for 2/3 of it, or the recent supply bottlenecks in semiconductors and other intermediate components, seems to give validity to these initiatives to curtail global trade, as is relative self-sufficiency were the solution, or even possible. The highly interconnected nature of value chains limits the economic case for making larger scale changes to where their links are located. With thousands of companies involved, supply chains as they are offer specialization, economies of scale, and access to consumer markets around the world. In any case, when we speak about globalization, we seem to be only referring to trade, more specifically to trade in goods. But even if there is some pullback in goods trade dynamics, the same is not the case for services. Service trade continues to thrive globally, in spite of the lapses caused by COVID. And on the wake of technological advancement, an increasing portion of the service sector, traditionally considered non-tradable, could become tradable. But globalization goes well beyond trade. For once, financial markets are clearly global. As a matter of fact, the deep global interdependence of financial markets was at the core of the Great Recession. And this interconnectedness among financial markets globally seems to be advancing, not retreating. Also, in the last year and a half, the pandemic has led to the establishment of a growing culture of work from home. While employers seem to be reticent to it, there is a growing demand from employees. It is not clear whether work from home is here to stay indefinitely, will revert to the previous norm, or whether we will settle somewhere in between. But in any case, work from home could boost the globalization of the labor market, one of the traditionally more protected markets. So not only is globalization not likely to be derailed, I would argue that it is a force that will continue evolving. Besides, globalization and technological advancement go hand in hand. But regardless of globalization trends, being aware of what's going on globally and the interaction among economies allows us, business economists, to better understand shocks and to anticipate evolving dynamics. In the auto sector, for example, there are multi-layered connections between US and Mexican suppliers and assembly points. A car produced in the United States, for example, can have thousands of parts that come from different US states and various Mexican locations. The place of final assembly may have little bearing on where its components are made. Or being aware of the political and economic outlook in Central America may give us some indication of migratory pressures in the US border. Or similarly, recognizing investment retrenchment in some countries and the global accumulation of consumer savings in the last year helps us understand the strength of consumer demand today and the ensuing supply bottlenecks. Also, there are significant lessons to be learned from past experiences in other areas. For example, an understanding of sudden stops and contagion prevalent in Latin American economies in the 1980s and 1990s would help us understand other similar events, such as the Asian crisis in the late 90s or the Euro area crisis of 2010-2012 following the Great Financial Crisis. It is quite clear that global dynamics are increasingly important to understand our businesses and adopt appropriate strategic decisions. This is the case not only for companies that operate internationally, but also for domestic businesses, as we're all exposed directly or indirectly to global competition. Without a global view, we would be half blind, missing one of the key ingredients in good decision making. Having a global perspective is a must for any business economist. In 2015, Lee Symes-Mattingly, in her presidential address, The Business Economist Toolbox, spoke of the aspects that define the business economists. She identified business economists as anyone who's interested in looking at empirical information and trying to understand how the world works. I love that definition, but let me relate to you how I see the job of a global business industry economist. I'll give you just some quick bullets. I tend to differentiate between economists that take the world as is and those who look at how it ought to be. As an academic economist, the first thing in my mind is what should be done or what would I do different if the decision were mine to take. The role of a policy economist is to aspire to a world as it ought to be, implementing policies and making decisions to bridge the gap between the is and the should be. However, as a business economist, the question is not what should be done, but what will be done. We must become mind readers, predicting how others, policymakers, will interpret the data and what they may conclude from it, regardless of whether we agree or not with the policy decision. As economists, we all have an opinion on how policy should be. However, our decision-making should be guided by how the world is, not by how it ought to be. In the same spirit of is versus ought to be, for political analysis. As business economists, we need to be aware of the interaction between political economy and economic policy. One must include politics into the economic analysis, particularly if you're examining emerging economies. Although nowadays it seems that it has become more relevant everywhere. As politics will drive economic policy that affects our businesses. remember that sometimes the wrong policy may be positive for your particular industry, at least in the short run. The danger is allowing our individual politics to cloud the analysis. One risks not only making the wrong assessment, but also losing one's credibility. And that is the most important asset of a business economist. As mind readers, and this is something that Professor Ryan just mentioned, a business economist needs to be preemptive, up to date on economic events globally, anticipating what your clients might need, and working on the things that your clients and bosses will be interested in tomorrow. Our approach to forecasting should be multifaceted. On the one hand, obviously, we have models. The more, the better, and not just one modeling approach. Remember, however, that people behave the way they do, not the way they ought to behave, the way that economic models used to predict their behavior. Models should guide our analysis, but high church orthodoxy in economics is by far the most dangerous thing in our industry. In our role, it's important to look at all the different perspectives when we start making decisions. Those are not my words. Those are Lisa's words, and I agree wholeheartedly. Also, models are only as good as your data. As a global economist, that may be one of the tougher restrictions. You don't find the same data everywhere or in every country. In the US, we're lucky to have a very well-rich data, which we should fight to maintain. However, it always amazes me that when we model, we let our junior colleagues collect the data and set it up for us. We do the modeling, not realizing that the data is probably the angular stone of our analysis. Out of that data comes wrong conclusions. Also, we need to add on-the-field analysis, discussions with local experts, policymakers, business people, etc., etc. Reading cues telegraphed by the words, emotions, body language of the other person. These exchanges will enrich our analysis and will allow us to understand and foresee events that our models cannot capture. When one gets used to having this source of information, when this information is not able or one cannot access it, like over the last year because of the pandemic, because of the travel restrictions, one feels that it does not have the whole picture, regardless of the wealth of models that one has at his disposal. In this respect, NABE conference and the whole club of NABE friends and colleagues is the best or one of the best sources of information that we can aspire to have. Also, one needs to read into the tea leaves, the crystal ball, or whatever other tool at your disposal to anticipate what the future will look like. Anything that helps you guide the analysis is welcomed. As an old colleague of mine used to say, visiting a country and seeing whether the coffee shops were full or empty would tell you more about the state of the economy than your models. Sometimes just a sparkle of experience and common sense can be a lifesaver. For me, as I said before, NABE conferences and the interaction with you guys, with all of you, with NABE economists, has always been one of the most fruitful sources of information and ideas. In analysis, the devil hides in the details. As economists, we learn to go beyond the first derivative, direct impact, and examine indirect impacts of policies or events. For example, the unintended consequences of policies, whether there be shortages, retaliation, etc. To achieve this, nothing beats education and the knowledge of the tools needed to master our jobs. NABE also excels in this respect. The CBE program is specifically designed to fulfill the educational requirements and the necessary tools for business economists. Finally, a business economist must be able to communicate these findings clearly, particularly as our audiences are not economists most of the time. Stuart McIntosh, in his presidential address in 2016, made reference to economists being storytellers. He made the reference in the context that business economy should be a repository of collective memories and stories. I also like to refer to economists as storytellers, but with a different connotation. As important as our forecasts is the story behind it. We know that our forecasts are not precise. They're likely to be wrong. They're probabilistic estimations, but our clients, bosses, they may not relate to that. Our forecast ends up in a cell in Excel as if it were a very precise estimate. That is why the story behind the forecasts becomes so important. As long as the story doesn't change, the forecast remains valid or close enough. And when our forecasts are wrong, mine not very often, it gives us a way to explain where things have gone astray. Also, the story makes it easier for us, for our different clients, to understand and follow our logic. Economics can be quite dry at times. Telling a story makes it more palatable for non-economists. So to conclude, let me just say that business economists need to wear multiple hats. On the one hand, we must advocate for policies that enhance welfare and growth. We should also analyze policies, choices, and their impacts, particularly in our businesses, taking into account the prevailing interactions in the global economy. We must remember that we're paid for our expertise, our credibility, our independence, and telling it how it is, with our best analysis, popular or not. Finally, I say trust your guts. It usually reflects your experience, but trust your analysis and your team much more than you trust your gut. Let me close by thanking the NABE staff for a very, very special year. I do not have words to thank them enough. So it is always a pleasure and an honor to work with a team like this. Thank you for your attention, and I hope you enjoy the rest of the conference. With that, as long as Tom, who is the boss, tells me so, I guess I should move on to the president report. Correct?
No, we're going to hold up your plaque real quick, Manuel, but we'll mail it to
great.
you.
Thanks. I cannot see it, so thank you very much. Actually, I can see everybody now. It wasn't here a second ago. Thank you. Thank you, Dave. Can you check that my name is spelled correctly, given that you don't know anything else? How about me? Just kidding. Thank you, Tom. Thank you, Dave.
We're going to move right into the business meeting, so don't everybody run for the door. We have some packets being handed out, and Manuel is going to be conducting this remotely as well, and Dave will have a few things to do, and then Constance has a quick report too. But we think this whole thing will take about 10 minutes, unless there's lots of questions. So stay put, drinks are to come, hang in there, we're at the home stretch.
Okay.
Okay, Manuel, we'll call the meeting to order.
All right.
And it's your show. We need an approval of the minutes.
Anybody motion? Second? I cannot hear from here, so you have to guide me.
All in favor?
I
think that was everybody.
Yeah.
We'll have the nominating committee report from Constance.
Thank you. Thank you, everyone, for being here. So as chair of the nominating committee this year, I am pleased to announce that Dave Altig will be the president of NABE when his term starts in a few days for 1 year. We have a new vice president, Julia Coronado. And we have 4 outgoing directors, so we have 4 incoming directors, and this is old news, but you learned earlier today who our NABE fellows are, and I'm just gonna repeat them. Thank you to Manuel Balmaceda for your amazing service to NABE. A very tricky year as president. I know part of my year included this pandemic, and pretty much all of your year included the pandemic. And so you're so missed. We wish you were here, and we can't wait to see you soon. We also have Lael Brainerd, Charlie Evans, John Godfrey, Frank Nothaft, and Chris Swan. And that, so do I need to, this nominating committee roster, oh yeah, okay. All right, so that's it. Well, I can announce who the other members of the nominating committee were. So obviously Manuel Balmaceda, the president, is always on the nominating committee. Lisa Emspo Mattingly, Jack Kleinhens, Stuart McIntosh, David Burson, and Rosemary Marcus. Thank you all for your participation in the nominating committee, and thank you all for being here for this business session.
Thank you.
I think we actually didn't give Dave a round of applause when we announced your vice presidency, so we got to do that too. Somehow we missed that. You're my boss in a few hours. I got to stay on your good side. So, okay. Next up, we have the annual report of the president and the report on membership from Manuel.
Thank you, Tom. Actually, it's been a very good year for NABE despite the pandemic. Unlike 2019-20, when COVID struck mid-year and we were forced to quickly cancel or shift everything to virtual as quickly as possible, we entered 2021's board term in October 20, knowing that we would be all virtual for much, if not all of the following 12 months. Actually, I did expect to be back in Washington at this point in time, but guess what? For the record, my first official conference as president was the Virtual Tech Economics Conference, which was the largest NABE event ever, with over 1,200 attendees. Despite the clear downside to being all virtual, this format has allowed NABE to increase the scale of its offerings and cut registration fees. So in essence, we are delivering more content, albeit virtually, to more people at a lower price. It is no surprise that membership is at a nearly 25-year high. You can see the membership report in your package. As much as we're all sick of Zoom, it is the great equalizer. And lots of folks who couldn't afford the time or money to travel to conferences or trainings are now engaging with us. One of my primary goals this year was to better connect with international economists. The virtual format of everything allowed our international folks to engage just like everyone else. Hopefully, when international travel returns, they will continue to do so. Our board is already thinking about how to integrate all that we have learned about virtual and hybrid over the last 19 months into our strategy going forward. Without a doubt, the undertaking drawing the most enthusiasm from NABE leaders and members is the Diversity Initiative. Launched in 2019, the committee's work has really begun to ramp up and bear fruit this year. First, we launched and recently expanded the Diversity Scholars Program so that these scholars will receive free access to all NABE conferences going forward. For those of you on site, make sure you take some time tonight or tomorrow to meet some of the scholars. They'll appreciate it, and I bet you will too. We have also partnered with Howard University to support the AEA Summer Institute and are on the cusp of launching a pilot program with the Federal Reserve System to nudge more students toward economics in HBCUs and MSIs. We also had a breakout session produced by our Diversity and Inclusion Committee at this conference. And I would really like to thank Rosemary Marcus and Lavon Henry for leading on efforts on the diversity front. Probably it would have been hard to do this without them both. I'd just like to wrap up by thanking the board, in particular my predecessor, Constance Hunter, and the many past presidents and new leaders who continue to step up for NABE. And the staff, they really have done an amazing job, as I mentioned before, keeping us on track. They have not missed a single bit since the onset of the pandemic. They've been flexible and able to cope with all the new challenges that we had, and with a smile on their faces, which is always great to see. I'd like to thank Tom for leading this great group, and hopefully with them here, NABE's got a long track ahead of it. I also want to give my sincerest thanks to Dave Altig, our NABE's VP. Dave, you have been a great partner this year, and I really, really appreciate your willingness to pinch hit for me on site this week at the conference. I am so optimistic about the future of this organization and the future of our profession. I know you and Julia will keep us moving forward. Thanks. And now I will hand it to Dave to talk about the finances and his goal for the next year. Dave, the floor is yours.
Thanks, Manuel. And I think it's only appropriate that given the year that you've had to preside over, you had me mess up your presidential address introduction. So now it's complete. So quickly on the financial report, both NABE and the NABE Foundation are in a solid financial position. As Manuel mentioned, when the pandemic hit, NABE had to pivot quickly to virtual everything, conferences, CBE courses, webinars. Revenues dropped, but the good news is that costs dropped too. So we not only survived the pandemic, the association actually thrived. We lowered registration fees for everything, and our tent got a whole lot larger in the process, as evidenced by the membership numbers. The assets for the NABE and the foundation, which are invested in fairly conservatively. No comments about Federal Reserve portfolios, have also grown. The full results for 2020 and the first half of 2021 are in your meeting packet. And now I just say a few very brief words about kind of agendas for the year ahead. And this is very easy because Manuel, Constance before him, and the whole set of initiatives that have been implemented in the past several years really provide the roadmap. One of the most exciting things will be the review and refresh of the CBE program next year. The success of the tech initiatives and the opening up of opportunities for jobs within the tech industry, it's just astounding. I mean, it really is. So it's time to really sort of look at that and see how it can be made bigger and better. And I look forward to participating in that. The diversity initiatives that Manuel mentioned are very exciting. The Diversity Scholar Program is getting its feet underneath it. I think that's the right expression. And I'm very excited personally about the Fed and NABE collaboration. I hope probably a lot of you don't know a whole ton about it, but I hope you will learn much more about it in the next year. But it's really designed to pull young students initially sort of at the undergraduate level into interest in the careers in economics. And the hallmark of it is we're not just talking about getting people into the usual sort of PhD programs, but rather folks across the board who might find careers using the tools of economics, but not necessarily sitting in a cubicle at the University of Indiana University, which is where I started before I moved on. I think that there's a third agenda that we're all going to kind of try to wrestle to the ground next year, and that is to figure out what our meetings going to look like when this mess is in the rear view. We learned an awful lot thanks to the strong efforts of Manuel and Tom and the rest of the staff about all the options that we might be able to exploit to do things like draw more people and provide more opportunities for activities within the organization. And finally, Manuel, as I've sort of alluded to, really got the short straw by having his presidential year during the pandemic. And one of his passions has been to globalize in some ways NABE. The pandemic made that nearly impossible to pursue. But Manuel will still be on the board. He'll still be with us, and I'm going to commit to working with him to try to see his vision sort of come to fruition once we can all get back to life as normal. So with that, thanks very much. It's time to drink.
The last item on the agenda is new business. So anybody with new business can raise it now. Otherwise, we can head down to the reception. So motion to adjourn. Jim Smith, second. All in favor? All opposed? Okay, I think we can leave.
Great. Thank you all. Have a drink for me.